Good morning and welcome everybody. My name is Kelly Clement. I'd like to welcome you to today's MetaStock Traders Conference. This conference is going to be amazing. We have 39 speakers, I think, lined up over the next 5 days to help you learn more about the market, trading stocks, options, futures, Forex, cryptos, whatever it is you're trading. This is going to be a great opportunity for you to learn. So as you come into the room, make sure to say hello in the chat. Tell us who you are, where you're coming in from. We're here in beautiful Salt Lake City, Utah. Well, it's a very windy Salt Lake City, Utah. We have winds going on about 45, 50 miles an hour today. So it'll be a nice blustery day for us. So let us know where you are, where you're coming in from. Again, it's great to have you here for a great day of learning. I'm just going to go check in, make sure everything's running technically here really quick, and then I'll be back with you in just a minute. Okay, again, welcome everybody to the Stocks and Options Traders Conference. We're actually covering more than stocks and options. We'll be talking about futures, Forex, cryptos, whatever it is that you're trading over the next 5 days. So we look forward to a lot of learning from a lot of different speakers. Our first speaker this morning is Steve Bigalow. Always a great presenter, always a great way to kick off a conference with Steve. Lots of great information and also very entertaining. So looking forward to that as we get started. Now, one of the things that is happening today is we are giving away lots of free prizes, and we are also, all the presenters are giving away something free typically. So if you want to, go up to metastock.com, that's metastock.com. Let me just show you that here, if I can get my mouse working.
Hi there,
right,
Greg
so
Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you.
Well, that part's not working for me to show you this morning, so I'm going to go
MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the power tools. The power tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels of interest. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the Armo.
Okay,
as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems.
We are very excited.
And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data.
Click on the conference banner right at the top.
Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years.
You know when the presenters you want to listen to are going to be speaking.
To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Yeah, John, I apologize. Audio was a mess for just a second, and it looks like it may be for just a second more until we get started, and then everything will equal out. So I'm sorry, you're probably hearing a couple things. So let me go ahead and get everything started, and we'll smooth everything out.
Hello, everybody. I hope you're doing well. My name is Jeff Gibby. I'm going to be reading a legal disclaimer and getting everything kicked off for you today. It's good to see you. Thanks for coming. If you're here on YouTube, do me a quick favor real quick. You're going to love today's video. In fact, I am going to make a bet that you're going to like it already. So you might as well just slam the like button and then subscribe to the channel. We're always doing really cool summits and conferences and webinars, and we'd really appreciate it. So with that being said, let's go ahead and kick today off with a legal disclaimer, something you're sure to enjoy. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information in connection with the company. So there we go. Want to say very quickly thank you to Stocks and Commodities for sponsoring today's event. We really appreciate Stocks and Commodities. They've been promoting, they've been publishing their newsletter since 1982. And they've got about 1.3 million subscribers, 17,000 articles. But they've also been great partners for us in terms of helping us with the events and kind of get the word out on the events. And we really appreciate all the work that they've done with us. And Thank you for sponsoring today's event, Stocks and Commodities. Also, CMT is a new sponsor today. Actually, they've been sponsored with us for about a year for all of the events that we do online. CMT is a very, very well-reputed organization, have a great reputation. You can find out more about them at cmtassociation.org. And then there's us. We're MetaStock. We're going to be talking a lot about MetaStock over the course of the next several days. If you ever want to get an extended trial of MetaStock, go to metastock.com/conf promo and sign up. Also, I'm going to ask Kelly to do this. This is for the YouTube link, if you would, Kelly. Go ahead and put in the conference registration page. I just realized that I want to have a note in there. So if you go in and register for the conference, we're going to be giving away prizes all day long today and all week long. You actually don't even have to be present to win. But if you go to metastock.com/ Kelly's going to put the link in the YouTube description. We'll actually be able to kind of get you registered for today's event, and you'll be eligible to win all the prizes as well. So I'm sure Kelly's, I didn't tell her, I just thought about that. But if you are watching on YouTube, make sure to get registered, and that way you can kind of be eligible to get all the prizes. So without further ado, there it is. metastock.com/traders conference. If you're listening in GoToWebinar, you don't need to worry about it. You're already registered. So Tom in GoToWebinar is saying that he can't hear me. Tom, can everybody else hear me? I just want to make sure it's Tom. I'll give you some instructions in just a minute. You can't hear me, so it doesn't matter. But I just want to make sure that you guys can hear me. A myth. We are going to send you a link to the presentation. Recording, actually to the YouTube broadcast later on. So thank you for that question. So I'm going to assume everybody can hear me but Tom. But if you can, I'd assume we'd just let me know if you can hear me. I'd appreciate that. So our first guest today is Steve Bigalow. Steve's a good friend of mine. Steve's been working with us for well over a decade. Thank you, Michael. I love kind of the feedback that he's had, the patterns that he uses, all that kind of stuff. Thank you, Anesta, Neil, Michael. It's good to hear that you can hear us. We've developed and worked with Steve for a number of years. His patterns are awesome. He's a really, really good teacher. I'm going to get out of the way and let him go. So how are you doing today, Steve? Good morning.
Good morning. Can you hear me?
Yeah, you're okay. Coming in
okay.
Loud and clear.
Do I need
Tom,
to hit?
I'm glad you can hear us now.
Do I need to hit the start broadcast?
No, I don't think it'll do anything for you because we've already started the broadcast.
Okay, can you see? Oh, do you need to see my screen?
Yeah.
Show screen.
All right, yeah, everything's coming in great for you.
Okay.
I'm going to go ahead and get out of the way. It's your turn. Go.
Okay. All right. Good morning, everybody. Yeah, they like to have me on first because I always kind of profess that candlestick signals, whether you use candlestick analysis on its own or if you're trading somebody's strategy, if you put candlesticks on your charts, you're going to see much more clearly what's going on in price movement. Let's get that. So I've got the question box up. If you have questions, feel free to ask anytime. And the people on YouTube, Jeff, obviously, if they ask a question, go ahead and yell it out.
I'll pop in.
So what I started candlesticks by accident over 30 years ago, and it's a great charting technique. But what I've discovered is that not only is it a technical analysis, but it's kind of a hybrid of fundamental analysis put into a graphic depiction. And the reason I say that is because 90% plus of all investment decisions are based upon somebody's interpretation of what's going on in the fundamentals of that company. The graphics just tell us what's going on in the fundamentals of that company, or whatever the chart is. So what we're obviously looking for is identifying breakout situations, which tell us that there's a brand new investor sentiment in that entity. And I'm going to use the word stock because that's most of the entities. We also do what we call a rare evaluation, and that's research analysis, reverse engineering. Basically saying, if we see a breakout, let's go see what the news was that created that breakout to tell us whether this is going to be something that's going to go or continue as far as that investor sentiment. Now, we've got the scans already set up for MetaStock. There are 12 major signals. Now, this is important because there's a total of 50 or 60 candlestick signals out there. However, through the years, because I was greedy and I wanted to learn every single signal that I could to make money, but as I started going back through the charts and finding where the peaks and valleys were in a price movement, and then seeing whether there was a signal there, and that's how I learned the signals many years ago. But then I discovered that there was only these 12 that would show up. So through the years, I've discovered you don't want to waste your mental time and energy trying to learn all of them. Just learn the 12 major signals, because they're the ones that are going to produce profits for you 99.9% of the time. So candlestick signals graphics are very simple. The doji, which is the most famous or the most well-known, is where they open and close at the same level. A small trading range is called a star doji. A big trading range is a long-legged doji. And the Japanese rice traders described when they open at the top and trade lower and then close at the top, it's a dragonfly doji because it looks like a dragonfly. And the gravestone doji is described as the warriors coming out of camp, going into battle, getting beaten back into camp by the end of the day, leaving their dead all over the field. Thus the gravestone doji. There are also candlestick patterns. There's about 6 or 8 of them. And the reason there are patterns is because of the same simple philosophy of the Japanese rice traders. Investor sentiment works the same way time after time. So through the years, because the signals illustrate such a high degree of probability that there's a change of investor sentiment. And I know that for a fact because before candlesticks came along, I was the worst investor in the world. I was even a stockbroker for 8 years. And I had to get out of the business because I realized that brokerage firms had no more idea about what made prices go up or down than anybody else. So before we start, I want to show one of the most important technical indicators that you're going to come across, the T-line. The T-line is the 8 exponential moving average. It's got Fibonacci characteristics, meaning it acts like a natural support and resistance level of human nature. So when I was first learning candlesticks, back then there was nobody around to get a second opinion, because it's always better to learn getting somebody else's feedback to see if you're doing things right or not. I always tell people back then the only time I could get a second opinion was when I would go to the doctor. I'd say, "What's wrong with me?" And he goes, "You're fat." I said, "Well, I think I want a second opinion." He goes, "All right, you're ugly too." So I had to learn everything on my own. But when I first found out that candlestick signals worked with an extremely high probability, again, this was from the research of the Japanese rice traders over 400 years of identifying signals and patterns that are telling you what's going on in investor sentiment. Then if you add the T-line is this black line. We call it the T-line because it's the trigger line. And there's a T-line rule, which basically says if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close below the T-line. Now that word "and" is important because there's times where it looks like it might be time to take profits. But we just discovered the probability is that as long as you stay above the T-line, you stay long. Now this is important because what is our biggest bugaboo when we're investing? It's our own emotions. And so if you were like me, if I had a profit in a trade, I was just happier than a pig in doo-doo. And I'd say, boy, I better take a profit because I sure would look stupid if I sold or held on to it and it went to a loss. So I'd take profits, which had nothing to do with what the trend was doing. Now I've discovered that as long as it doesn't close below the T line, it keeps my emotions out of my trading. And it makes me, instead of making good profits, it allows me to make excellent profits. It works the same on the sell side. If you see a candlestick sell signal and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. So this is very important. The T line truism is, if you see a candlestick sell signal and a close below the T line, this word right here, you have an extremely high probability a downtrend is confirming. Same thing, if you see a candlestick buy signal close above the T line, you've got an extremely high probability that your uptrend is confirming. The T line is the 8 exponential moving average. You put it on your chart just like you would this 50-day simple moving average. And again, it acts like a natural support and resistance level of human nature. So here's the most powerful statement you're going to hear today. If the candlestick signals are the graphic depiction of investor sentiment, telling you what's going on is between the buyers and the sellers, and the T line acts like a natural support and resistance level of human nature, when you combine those two, you have an extremely powerful trading strategy. There's a caveat to that, which is the further away you move from the T line, the higher the probability it's going to come back and test it. So often get asked, well, how do we know when to sell? Well, there's sell signals. When are they best confirming? One, when you're in the overbought condition. Now, my conditions for overbought and oversold is stochastics 12-3-3. Very simple. If you're in the overbought area and you see a sell signal confirming, the Japanese rice traders say you have an extremely high probability you're going to be heading in the opposite direction. If you see a candlestick buy signal in the oversold condition, the probabilities are that you're probably now starting in an uptrend. So the further away you move from the T line, the higher the probability it's going to come back and test it, kind of enhancing the confirmation of a sell signal. Same thing on the buy side. The further away you move from the T line, the higher the probability it's going to come back up and test it. So with that information in mind, what we're looking for is the strong pattern breakouts. And these are based upon knowing what the signals and patterns are telling us at breakout levels. This is a fry pan bottom. You can see how you can hardly trade this at all, just kind of worthless. But notice what happens right here at the breakout level. We've got a doji bullish confirmation. Now, just like we have the T-line rule, we've got the doji rule. The doji rule says if you see a doji, the likelihood of the price move, or let's put it this way, the probabilities of the trend movement is on how they open after a doji. So if we take that into consideration and we can see a fry pan bottom and a doji and it opens positive, we know it's going to trade positive. And if we know it's going to trade positive, what's it tell us about the fry pan bottom breakout? That it's probably breaking out. So very simple use of the stochastics. If you see a candlestick buy signal in the oversold area, you can buy the signal. But a pattern is usually going to break out when your stochastics are already up here in the overbought condition. So again, use the doji rule. This is what we call a doji sandwich. A bullish candle, look where it closed, right here at a fry pan bottom breakout level. Then it opened positive and did a doji. Not real convincing. But the doji rule says the price is usually going to move in the direction of how they open after a doji. A positive open tells us we're going to have a doji sandwich. A doji sandwich is a big candle, a doji, a big candle with a doji sandwiched in between. And what do we expect coming out of a fry pan bottom? This big, strong price move. So again, I keep reiterating when I do these sessions, this is not rocket science. You don't have to be a sophisticated technical analyst to analyze what the Japanese rice traders have illustrated over the last 400 years of what human nature does. The stochastics I did are 1233. And that was nothing more than somewhere 30 some odd years ago. I'm a swing trader, so most of my trades last anywhere from 2 to 10 trading days. And at that time when I was learning candlesticks, 1455 seemed to be the common number, but it was a little bit slow for me. So I sat there one night and said, well, let's see if we can find something quicker. And I just tweaked it, did 1453, 1424, 13. Finally, I got to 1333, and that worked pretty well. So this is my rhetorical question. Do all of our price moves act big on a breakout? Definitely not. But when you're using candlestick signals and patterns, the probabilities of being in big price moves are greatly more in your favor. Let me find one here that has better moving averages. The next one will be one. Hold on, Michael, I'll get to it. Do we have a fry pan bottom on Gotham? I don't have the live charts up right now. So this is what the benefit of candlestick signals are. If it's trading flat, all of a sudden you see a breakout, especially up through the T line. First thing you do is you go back and see if there's news that created this move. And is that news going to warrant more upside? So it allows you to immediately identify that there's a major change of investor sentiment. So let's see if I can see it. The red line here is the 200-day simple moving average. The blue line is the 50-day simple moving average. The reason we have those on our charts is because every major money manager around the world uses those moving averages to make their decisions. A lot of people ask, well, why don't you use the exponential moving average instead of the simple? Because we're not using them to make our decisions. We're using them to see what everybody else's decisions are at those levels because they use those moving averages. Then the black line is the T line. On some of the charts, I'll have the 34 EMA that work relatively well. And there's a little green line that is the 3T line that works in conjunction with the T line. Now, the nice thing about candlesticks is they work a high percentage of the time. Meaning, if somebody says, put the XYZ indicator on your chart, put it on there. If it works, keep it there. If it doesn't, take it back off. The reason we try to keep our charts very simple is the most important element on any chart is the signals themselves. So here's your logic. You got kind of a fry pan bottom setting up, and there's your kicker signal. Your kicker signal is the strongest individual candlestick reversal signal. Look how it opens here and closes here, creating a dark candle. The next day they gap it up and go then. The investor sentiment has been kicked in the opposite direction. What do we look for coming out of a fry pan bottom? A strong breakout price move, and the kicker signal illustrates that, telling us we're going to have more upside. Same scenario. The most powerful individual signal is your kicker signal Look at your fry pan bottom. You couldn't trade again. You couldn't trade this, but however, you can see how the trajectory is creating this big fry pan bottom. This is what we're looking for, is these breakouts to the upside. The T-line, Michael, candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. That's the definition of a candlestick signal, which means it works on stocks, bonds, currencies, future or commodities, tulip bulbs, anything that has fear and greed involved. The T-line works on all time frames and all trading entities. This could be a 1-minute chart. This could be a 5-minute chart. This could be a monthly chart, depending on the time frame that you're investing. I used to trade the E-minis off a 1-minute, 3-minute, 10-minute chart. Right now, I trade cattle, hogs, soybeans, the futures off a 10-minute chart. If my 10-minute chart is setting up, then I'll flip down to my 5-minute chart and make sure it's confirming. So you use the time frames. Again, candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame. This is what we're looking for. That fry pan bottom breakout. This is what we call a trend kicker signal. Notice how it opened here and closed here. The next day they gapped it up. That told us that this fry pan bottom was confirming. And again, what do we expect coming out of a fry pan bottom? Very strong price move. Ever. That's today. I haven't even seen what it's doing today, but you can see your fry pan bottom. There's your breakout level. That was on Friday, which told us they broke out through the 50. Now, we'd be watching today to see how they're opening this one. And it works just as well on the bearish side. A dumpling top. Slow rounding top. When they kick it down, that tells you your strong downtrend's in progress. What was the best signals you recommend? Haken, it is the 12 major signals. I tell people, learn the 12 major signals and why. And not only did the Japanese rice traders illustrate the graphics of the signals, but they also told us what the investor sentiment was that created those signals. And once you understand that, you basically have the same grasp of what moves prices as somebody that has been trading in the markets for 50 years. You can use the T-line for currencies and commodities, yes. Remember, the Japanese rice traders did not become wealthy. They became legendarily wealthy. They were the financial powerhouse in Japan for centuries. And they did it on the most boringest commodity in the world, rice. So it wasn't an illustration or a demonstration of what the price was doing. It was an illustration of what investor sentiment was doing to the prices. What time on chart is a 1-minute, 5-minute? Oh, now these are daily charts. If I wanted to see what it was doing today, then I could flip to my 1-minute and my 5-minute chart. Carl, there are scans. This is why, Jeff is going to tell you all those patterns that we have already put into MetaStock's scanning software. So he'll explain that to you. This is why we're here. No, Franklin, the pattern can be, all you're doing is seeing what the trajectory is. Could this be 5 days? Could this be 30 days? It doesn't matter. We're just looking at the trajectory. This is recorded. So there are simple candlestick patterns that are very visually recognizable in the sense that you're in the oversold area. you can see indecision. You can see how they started back up with a doji sandwich. There's an implication about a doji sandwich, which is there's going to be more upside. Well, a lot of people say, oh man, there's a resistance level. I'm afraid of that. Except look at that flat handle. Now look what is happening. The bulls are stepping in, and what do we expect coming out of a scoop pattern? A strong slingshot effect like this. So we could be buying here, knowing that if it get up to this level, if it failed, we just close it back out. If it goes through, we have a strong price move. Now, how long would you hold on to this? Well, before I would have taken profits somewhere up here because I had a profit and I didn't want to let it go. Now I know you just hang on to it until you see what the Japanese rice traders illustrate to us. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. So what would this start telling me? Well, look what they're doing. They're gapping it up, exuberance coming in, and look how far away we are from the T line, and we're in the overbought area. That just gets me a little bit better prepared to get ready to take profits. Is the T line specific to what? No. But we add it on the charts of MetaStock to enhance the trend analysis. Are your patterns identified in real time on intraday charts? Yes. If this was a 5-minute chart and I was trading, say this was soybeans, and I saw this setting up, remember, candlestick signals are going to reoccur no matter what time frame. Richard, I can't do live charts right now. These are all PowerPoints. So this is the expectation of when we see a scoop pattern setting up, we get ready to be buying. Ibrahim, yeah, when I get done, I'll try to flip back up to the top. And they are on, they're already built into the MetaStock software, scanning software that we've put together over the last few years. Not few years, what was it? Over 10 years ago now. So how do we know when to buy? There's our breakout. Should we be buying here? Should we be buying here? We've seen the breakout. This is what is called your best friend signal. A doji followed by a gap up. The reason we call it your best friend is because not only is it telling you which direction it's moving with a high degree of probability, but it's telling you the magnitude of the move is going to be very strong. So on a breakout, where should we be buying? Well, that's where you flip to your 10-minute chart. You could be buying here, you could be buying here, might not be buying right here, but it would be buying here, and then you can see what happened the rest of the day. On the 10-minute chart, it's pretty much telling you they're not selling it off. Still a strong move to the upside. Do you consider time of day? Krishna, I usually will make my trades within the first 45 minutes of a trading day and the last 30 minutes of a trading day. Usually everything in between kind of gets lethargic. So you watch pre-market movements after doji. Tom, you can set up your scans. One of your scans could be, I'm looking at all the dojis that, or all the trades that, or the stock movements that created a doji yesterday in the oversold condition. Now I've got that on my watch list. I want to see which ones are opening the strongest the next day. So another major pattern is the J-hook pattern. It's got a prerequisite of a strong price move. Then you can see our sell signal. There's an evening star signal, one of the 12 major signals. And notice how it pulls back pretty indecisively. And now you can see what's happening right here at the T line. It's starting back up. So this is what we call 2+2 analysis. Look at our strong breakout from these dojis. What do we anticipate? A J-hook pattern, which means wave 3 is likely to be the same magnitude as wave 1. Or this is what we call a bobble breakout, which is essentially a J-hook pattern where you can see exactly where the profit taking occurred as soon as it hit the 200-day moving average. But notice what we got going on here. There's your doji sandwich. There's your breakout. So you've got two entry strategies here. One, you could be buying in here, knowing that it gets up to this level again, the resistance level that everybody else was watching. And if it failed there, you had a double top, so you close it right back out. If it goes through, you know you've got a bobble breakout, which is nothing more than a J-hook pattern that was more defined by what everybody else was watching. Adam, yes, Jeff will go into that when I get down here. So this is what we call observe the obvious. There's the 50-day moving average. Doji, 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 bullish confirmation in the oversold area. What's that telling us? That tells us there's a lot of indecision on the pullback, but what's it telling us? This is where everybody's deciding to buy. So this was probably wave 1. Wave 2 came right back. We can see the nature of the selling right here, or the trading right here. And then there's your bullish confirmation. And what is your bullish confirmation? A candlestick buy signal and a close above the T line. What's our trading strategy? If it opens the next day positive, we can be buying. Why do we want to see it open positive? Because we want to confirm the bulls are there. What we don't want to see is it opening down here the next day, because that pretty much tells us they're not confirming that signal. How do you use the T line to trade options? Because if you're not trading options based upon the T line, you're trading the underlying stock based upon the T line. That if this is time to be buying stock, or you like to buy options, then this tells you it's time to be buying options. So when I say observe the obvious, this was one of our recent trades. The reason was, this is a McMuffin. Now, a McMuffin is a combination of a Morningstar signal. The Morningstar signal is one of your 12 major signals. It's a big candle, a doji, and the third candle usually will have to close more than halfway up the previous red candle. Now it's followed by a doji sandwich. So what do we expect from a Morningstar signal? A reversal. What do we expect from a doji sandwich? More upside. So this becomes your morning sandwich or a McMuffin. So we could be buying right here, knowing that if this was a doji positive open, what was it telling us? This level right here was not acting as resistance. They were buying on the 50, and now they're coming in with great strength. This is what puts you in high probability trade situations. Now, not only does candlestick signals tell you what is going on in investor sentiment when to buy, it also tells you when is it time to sell. What was the alert when it was trading up here? Look how far away you are from the T line in the overbought area. What's our T line rule? It's probably going to come back and test the T line. So what do you do up here? This is where you probably heard many money managers tell you to, if a stock moves back 3%, 5%, 7%, you should stop out. The market doesn't give a hoot where you bought. What we're looking at is, what is the market telling us? So if we're that far away from the T line and it opens here and starts trading here, where do you think is a logical place to put a stop? right here at the open or yesterday's close, or right here at the halfway point of this candle. The Japanese rice traders are very logical to say if you're in an overbought area and you have bullish candle and they start trading it back below the halfway point of that candle, tells you the bears are in control. So not only does the signals and patterns tell you when it's time to buy, it also tells you when it's time to sell. Okay. Now, again, there's 12 major signals. There's about 8 candlestick patterns, but there's kind of combinations that make for much higher probability trade setups, such as your best friend. Again, our best friend is a doji in the oversold area. The next day they gap it up and close it higher. That's your best friend. Again, because it's got 1, the prospects of heading higher, and 2, the magnitude of that move is usually going to be fairly strong. So how long do we hold on to this? Until you see a sell signal and a close below the T line. These are the type of trades you want to get stuck in. And I say stuck in because you don't have to analyze this. How long does it take to analyze this trade each day? 3 seconds. Every day I looked at it and said, whoops, there's a sell signal. I'm getting ready to take profits if it opens lower and trades below the T line. To stay in it, it needs to open and trade higher. It takes about 3 seconds, which means you're spending little time analyzing something that's working and going and spending more time analyzing something that might be a little bit iffy. Whoops, Jeff, I'm running behind here. Look at your best friend breakout. Again, this tells you there's now a brand new investor sentiment. In this trade, and you can see where it bottomed out. Then you can see your best friend's signal. Starbucks, we got this on our recommendation list today. Look at your best friend signal. Notice your series of dojis down here in the oversold area. If one doji means indecision, a series of dojis means greater indecision. Then they gap it up. So if this was trading positive today, we'd be buying. I haven't checked to see what it's doing. What is the gray line? This line here might be the 3T line, which works in conjunction with the T line. So candlestick signals work just as well on the bearish side. There's your bearish best friend. Why would we be going short? Because it had a gap down best friend. If you were long, where would you have closed this out? Right here, because look what was happening in the overbought area. Look how far away you were from the T line. Same scenario right here. A doji gap down through the 50 and the T line, followed by a bearish doji sandwich. I told you there's probably a lot more downside. Anytime we see this action, especially when you can see what everybody else is watching, like a support level, the 50, that bearish best friend pretty much tells you there's a tremendous amount of selling pressure. So I always tell people, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So when you recognize the strong signals and like the message, look at this, that's an ugly chart. However, there's a message there. They gapped this up and then started taking profits. What do we look for? For the profit to end, because once the profit taking is over, what was this message? There was a new strong bullish investor sentiment in. Now your uptrend will start. Doji sandwich, bullish engulfing signal. Wave 1, wave 2, and what starts wave 3? The fact that the T line pretty much acted as support. Now we're going into wave 3. So again, this is not rocket science. Prices move the same way time after time. once you understand the signals and the patterns, it just helps you be in high probability trades with a much higher degree of being in the right direction. So candlestick logic basically says we can see what's happening at levels that everybody else is watching. Notice how the T-line, this is called a T-line crunch. Notice how the T-line kept crunching the price right up through the resistance level, which would have been our breakout area. What changes the investor sentiment? Seeing a candlestick signal. So if, this is just a recent one. Notice your uptrend, uptrend, uptrend. Where is your logical place to put a stop loss? Well, you're in the overbought area. You automatically put a stop loss below the T-line. Or if you're more aggressive, if you see you're in the overbought area and they open it lower, where do you think your next target's going to be? Back to the T-line. We shorted RPD, basically because you had kind of a dumpling top, a bearish engulfing, close below the T-line. This put us in situations where the probabilities were much greater that this downtrend was still in progress. Moderna, there's your kicker signal. Notice what happens up here. What's the last element that we can analyze? They could never close this back below the T-line. It's still in an uptrend. The kicker signal right off the bottom told you this was the appropriate time to start buying. Z-Lab, we recommended. Look at your kicker signal. This is what we call a double confirmation. It opened positive after the kicker signal. What was it telling us? First of all, it was telling us it was confirming the kicker signal. Secondly, it was telling us the T-line was not going to be acting as resistance anymore. We could be buying. So I often get questions, well, what if it opens positive and then turns around and goes the other way? Well, that tells you that trade didn't work. You close it right back out. You probably all have heard people telling you, cut your losses short and let your profits run. I've heard that for over 40 years. The only difference is nobody tells you how to cut your losses and let your profits run. Candlestick signals make it very simple. No, VID, the 12 major signals, if you see a candlestick buy signal in the overbought area, it doesn't mean very much. If you see a candlestick sell signal in the oversold area, it doesn't mean very much. If you see a buy or sell signal during the trend, not at an extreme of overbought or oversold, it's just another trading day. The signals become relevant at the reversal areas, or the bottom of a trend or a top of a trend. So here is recommended today, because look at the kicker signal. This was based upon earnings probably on Friday. So why would we be buying this one? Because the probabilities say there's a very strong reversal. And what do we expect coming off a kicker signal? Good, strong price move. Amazon, this is a bearish flutter kicker signal. Notice you had a bullish candle. The next day they gapped it down and did a doji below the previous day's open. Anytime you see something like that and you're long, close it immediately, because if this is a bullish trend, they shouldn't be gapping it down below the previous day's open. When they open it lower the next day, I told you you had a bearish flutter kicker signal, which basically said if you took out this little flutter, you've got your strongest reversal signal to the downside. Exponential moving average, when you, what is the point of the 3T line? Works in conjunction with the T line. It actually is a confirmation that if you see a buy signal and the 3T line comes up and closes above the T line, that's just additional confirmation. Yeah, the 3T line is the exponential when you have the 8 exponential. Yeah, so it just acts like a confirming indicator. Candlestick analysis is merely the identification of reoccurring signals and patterns that are produced by human nature. That is the most effective, consistent indicator in the world. It's worked over the last 400 years that the Japanese rice traders have used it, and it's going to work for the next 400 years because investor sentiment will not change. Let's see, what else was I going to say? So the information built into the signals and patterns, once you understand what they're telling you, when you use the MetaStock scans for those signals and patterns, now you're putting yourself in situations where the probabilities of being in the right trade at the right time is dramatically in your favor. Again, when I started learning candlesticks, I was the worst investor in the world. And then the first time I picked up candlestick charts and started to learn them, the one aspect that just hit me in this makes sense. Everything you see on a candlestick chart is just common sense put into a graphic depiction. Did you say you're using a simple moving average, or the 50 and the 200 are simple moving averages because that's what everybody in the world uses, and we're using those moving averages to see what their decisions are. The T line is the 8 exponential moving average. The 3T line is the exponential moving average. And then I'll usually have the 34 EMA on my chart, which works reasonably well. How machine learning? Vid, it's the algorithms, the information put in on computer generated trades is still based upon what human nature thinks should happen at those levels. So it's still created by human nature. All right, so I want to stress, you're going to hear some good trading strategies today. But whether you use candlestick charts as your primary investment strategy, or if you've got an investment strategy that works well for you, if you lay candlestick charts on you or use candlestick charts to analyze that strategy, it's going to make you see things a lot more clearly. The 3T line is a 3 exponential moving average.
All right. All right. Steve, we did have, as promised, one question from YouTube.
Okay.
And I promised we'd answer it. Do you have any recommended books on the rice traders of Japan?
On the rice traders? No. I can't remember. The first books I read were so antiquated that the first chapter was telling you how you built a box and you put a glass on the top of it, and then you put a light underneath in the box, and then you put your rice paper on top, and then you started drawing your formations. That's how antiquated it was. So I don't know why. Yeah, I don't know what the reason is of why the rice traders did that, because I forget whether was it the Hanshu family that did this. But anyways, it's more important to find out what the logic was that the Japanese rice traders kind of got from the graphics, telling you why those signals and patterns were being created.
Out of the books that you've written, which one do you think you would recommend you start with?
I would start with High Profit Candlestick Patterns. That's the green cover book. The first book I wrote was Profitable Candlestick Trading, published by Wiley & Sons, but it's more basic. The High Profit Candlestick Patterns will tell you what the 12 major signals are and how they are incorporated into the candlestick pattern. So the combination of using candlestick signals, showing the formation of a candlestick pattern, again, just that information just kind of improves the probabilities that that pattern setup is about ready to break out.
Right. Just a few comments here real quick, and then we'll get on. But Trey says, thank you so much, Steve. Franklin says, thank you, Steve. Richie says, thanks, Steve. Always a pleasure listening to your presentations from the UK.
Right.
Adam says, thank you, Steve. And Kersey says, thank you, Steve. So great presentation today. Really appreciate you coming in. Franklin wanted to know what the logic was again, but I'm not sure I have a great answer.
So what was the question? What
is the logic again? Yeah,
the candlestick logic is just basically knowing that the investor sentiment is what moves prices. Again, I tell people prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So candlestick signals are merely the graphics of what's going on in investor sentiment. So if we know that a doji sandwich is going to be a bullish move, and that doji sandwich is occurring right at a pattern breakout, the logic is investor sentiment is building up. Get ready to buy as soon as that opens positive and breaks out through that pattern. So the candlestick logic is that everything we see on a graphic of a candlestick signal or pattern is telling us that that signal has a high probability of moving a price in a specific direction.
Cool. Awesome. All of these comments, all these like, great job, Steve. Thank you. We love you so much from Botswana. I just can't keep up with them all.
What candlestick configure or confirmation signals do you use to get into a, I don't see what the end of that question is.
Into a trade.
Oh, into a trade. If I see a candlestick buy signal setting up in an oversold area, let me see if I can go back to somewhere. Darn, I was going to see if I could go back up. Like today on here, HEAR, which is a kicker signal, that what I want to see is that it is trading positive. I don't want to see it gapping down and trading lower. I want to see it that the confirmation is confirming. Now, the process is, if I'm ready to buy a stock because of confirming signal or pattern, I don't want to see the market opening up down 140 points. If that's the case, and even if the position is opening positive, I'm not going to jump right in. I'm going to wait to see what the investor sentiment is doing after that market opened much lower. On the other hand, if the shows the market's going to open up 110 points and the stock is opening positive, the market's still trading in the direction we expect it to, logic says everything's working. Let's go ahead and be buying immediately. Are you using RSI or stochastics? Again, who is asking that? Tom, you can use whatever you want as confirming of whether you're in the overbought or oversold area. And if you don't know whether one works better than the other, put them both on the bottom of the chart and see which ones work, or just keep both of them there. Will you have time for a quick opinion of Williams' percentage range? Sterling, same thing. I use the candlestick charts as my main criteria. Then I can add anything else on as a confirming indicator. So throw it on there and, whoops, you scrolled past me. Throw it on and see if it works. Anything that you put on your chart should just be improving the probabilities that that signal or pattern is working. The Sandy, I've written 3 books. The second one, High Profit Candlestick Patterns, it's the meat one. It's got all the information in there. Then I have another book, this Candlestick Profits, Eliminating Emotions, because that's how I set up my whole trading. because I knew I was the worst investor in the world because of my emotions. Everything I've set up as far as my trading is to keep my emotions out of my trades, just analyzing what the charts are telling me. Why do prices usually drop before a buy signal and rise before a sell signal? Brian, I don't know how to answer that right quickly, but that's why you always want to watch to see what the signals are telling you and whether they're confirming or not. What is the minimum volume to trade with as far as money or as the amount of volume in the stock? Would you recommend buying on a pullback after you have confirmation? If you haven't bought, yes, because you've had a buy signal, everything doesn't go straight up. So sometimes you can watch to see if it pulls back and then starts the next move up. That means the bullish sentiment is confirming. So there's all sorts of strategies. Now, I'll add in here, which isn't part of the program, I tell people, come try we've got a chat room that's open every day. I put out 2 or 3 stock picks every night, not so that people have stock picks, but so people have a video to see further training to learn why those were recommended. So I don't even have a slide for this. If you want to email abraham@candlestickforum.com, just say Steve said I'm allowed to have a 2-week free trial to the website, because in our chat rooms we usually have 150 people in there, and we've got a lot of traders that know exactly what they're looking for. So it's a perfect place to get recommendations, number one, but 2, speed up your learning process tremendously of which signals and patterns are the best.
All right. One quick comment out of YouTube. This had to do with the book. And Cassie actually says, I've read this book and it's great. It's helped me so much. Thanks, you guys are super.
Yep.
Thank you, Cassie.
How do you start your morning before trading? And how many hours a day do you sit in front of your computer? Victor, unfortunately, I sit here in front of my computer all day long because I've got severe arthritis in my right knee, so I don't want to move around very much. But knowing how to scan for the best trades each day should take no more than 20 minutes. And if once you know what you're doing, it's going to take 5 to 10 minutes to analyze which charts, once your scans are already set up, which charts are the best ones to be trading the next day. Whoops, I don't want to use up your time.
Thank you, Steve. That was awesome. Great job.
All right. Thank you, everybody.
Fast, didn't it?
Pardon me? Yes, it did.
All right. We appreciate it, Steve.
Yeah,
good job.
Who's the next person? Let me take their hour.
Yeah.
All right, everybody. Thank you for showing up.
Thank you. Thank you, Steve.
All right.
All right. Very cool. Let me go ahead and do this. Thanks again, Steve. We appreciate you coming in. I do have just a few things to talk about, and what a great session that was. All right. So I want to talk about this. The question came up quite a few times about whether you can use this in South Africa. So thank you for that question. You can absolutely use this in South Africa. You can run scans on it. And we'll talk about scanning quite a bit today, but I don't think I'm going to have a chance to run a scan just because we're kind of running out of time. But rest assured, like with the data that we get from Refinitiv, there's 300 exchanges that are in there. You can scan this for London, South Africa, Australia, North America, South America, Canada, which probably covered in North America, whatever you want. So I did want to really quickly talk about the CPS2. We actually kind of went in and created a program and a plugin that identifies all the patterns he talks about, all the patterns that you can see right here on the screen. If I'm sharing my screen, and I'm sure Kelly will chime in if I'm not sharing my screen, but all of these patterns are stuff that you can scan for, whether that's a South African market, an Indian market, whatever you want. And I do really quickly want to show these patterns as well, these additional single day patterns. as well. I do want to show what this looks like on a chart real quick. So right here, I just pulled up the Dow Industrial Average. Right here, all of the patterns are being identified. So right here, you had a big bearish engulfing. You had a T-line crunch right here. You had a doji right before that. You had a left-right bullish combo. Here was a huge bearish engulfing. I remember like this day, because it wasn't that long ago, and we're like, that's the biggest left-right bear bullish combo I've ever seen. I think it's a good time to kind of take a notice of that, right? But right here, it happened on the day we set a new low. That low was rejected. It pushed up really, really hard. And you have that left-right bullish combo. And with the expert advisor, that's going to be notified to you on the chart automatically. In addition to that, you'll notice right here, it'll actually give you a little bit of a definition in terms of what that left-right bullish combo is. This add-on is great. It's been rated twice by Stocks and Commodities readers, or not readers. It was reviewed in Stocks and Commodities by Dennis Peterson and Barbara Starr. We had version 1 was reviewed by Dennis Peterson, and version 2 was reviewed by Barbara Starr. And they give it very, very good reviews in terms of the patterns that were identified and the ability and how well it was put together. It's one of our most popular add-ons. It's been extremely popular, partially due to the fact of how popular Steve is, but just how well it works. And it's been something that I'm very, very proud of. We worked really quite hard with Steve to work on this and kind of create the first version and even the second version. And what's kind of funny is like we've put so much into this, so we've kind of, it's great. We kind of thought about ways we could kind of improve it and make a version 3, but we've got everything in there already. So anyway, this is the CPS version 2. You'd have the all of those signals are going to be identified on the chart for you. There's a definition right here that you can look at. Such a great add-on, and one of our most popular. So in total, it's going to identify all those patterns. You can scan for them. It's got an expert advisor. There's 3 different layouts. In total, there's 36 different patterns that it finds, and you can use that anywhere. And the one thing I think that we did with this is we actually priced it fairly low. It's only $499. Here at the conference, you can get it for $399. You can get a 30-day money-back guarantee on it. And it's super, super cheap, $399. It does require MetaStock to run, which if you don't have a copy of MetaStock, if you do that, we'll go ahead and give you a free trial. We are doing, though, one of the things that we're actually kind of gearing up for with Steve, one of our most popular speakers, as you can tell, all the questions. We love Steve. Steve does a really, really good job. And one of the things that personally has been really extremely beneficial for me over the years is working with Steve and all the stuff I've been able to learn with Steve. I love to run the scans that Steve uses and that kind of stuff. We're going to be running on, in just a couple of weeks here, December 3rd, we're going to be running a Candlestick training bootcamp. During that event, we're going to do market trend analysis, where he's going to identify the most robust candlestick trade setups. He's going to do successful trade entries, when to close a trade. Very important question. How to confirm, what confirming indicators that he uses. He's going to talk about his 12 signals, high profit moves. This is going to be an 8-hour, I'm sorry, it's going to be a 6-hour class, not a 7-hour class. And he's going to basically sit down and talk to him. So it's 6 hours of live training. This is going to start December 3rd at 10 a.m. Eastern time. And you can get access. In addition to that, we did record a class in 2020 that by itself is about like $600 or $700. We're going to include that recorded session immediately as soon as you sign up, and we'll reserve a spot for you on the December 3rd live session. So you'll get access to the recorded sessions right here, $699 value. That'll be available for you immediately. You'll be able to come ask questions of Steve and see him at the December 3rd 10 a.m. event that we'll be doing. And we'll record that. So after we're done with that, it'll be up on our website and you can log in and watch them at any time. So normally, just the class, this 8-hour class, Steve charges $899 for it. If you do it at the conference today, you can do it for $499. So if you already own CPS and you want to get this, you can sign up for it. It's $499. We're going to throw in this $700 class for free as part of it. But if you don't have anything and you want to get CPS, MetaStock, as well as like the the two sets of training classes. Remember, I told you the add-on was $499. I think it's underpriced at that price. But what we're going to do is for $698, you can get CP Candlestick Profit Systems 2.0. You can get that training boot camp that we're going to do. That's the live session that I just got done talking about. You'll get that free training course that we did a couple years ago that you can start going through right now. We'll give you a free month of our MetaStock real-time program. MetaStock's been rated #1 in its price category for 29 years in a row. We're going to give you a free month of data. We're going to give you a training class called Unleash the Power of MetaStock. All of this would be worth about $2,000 purchased separately, but you can buy it today for $698. To do that, give us a call, 800-882-3040. Visit us online at metastock.com/saleschat, or you can also go to metastock.com/confpromo, CONFPROMO. So you should go ahead and do that. I'm going to go ahead and type this right here and put it in the link here. And then I'm going to apologize. We're going to go really quickly to price, and we're going to apologize for being late. Thank you to Stocks and Commodities and CMT for publishing today's event. Another person that I would really appreciate over the years for kind of what I've learned from is Price Headley. And Price, I remember when I was living in Northern California, we'd fly him into San Jose and we'd do a event with the San Jose options group. And it was always good to see Price. I love seeing Price. I talk a lot about the methodologies that I've learned from Price over the years, and kind of like his mentality of like, I want to skip the small opportunities and focus on the big opportunities. I think is amazing with him. So Price, I'm sorry we're starting you a little bit late. I'm not surprised, but I am sorry. How are you doing today? I can't hear you just yet.
I'm doing great, Jeff. Just didn't want to interrupt you. You can hear me okay?
Yeah. You're welcome. I'm sorry we're starting a little bit late. Let me go ahead and make you the presenter, and I'll get out of the way as fast as I can.
No, it's always a pleasure, Jeff. Thank you so much for having me. And always, I like to share with folks what we're doing on our latest innovations. So can you see my screen okay there, Jeff?
I can't. It's coming through great. I'm going to get my face out of your way.
Oh, you're fine. I was told I have a voice for radio, so I don't have my face on there today. But folks, I'm thrilled to be with you. And thank you, Jeff, and all the good folks at MetaStock for having me. It's always a pleasure to share with you things that are working in today's markets. 2022 for a lot of investors has been a tough year, but for traders, I think it's been kind of an ideal opportunity to show why we trade, that we don't just trade the upside, we trade the downside, we take advantage of whatever the market gives us. And I think that's the attitude you need to have going forward as well. Is that kind of flexibility, that kind of opportunity exists on both sides of the market, down as well as up. There's going to be a volatility, we know that, and so our job is to profit from that and to also manage risk intelligently through the process. So what I want to share with you today is our latest innovation of Big Trends, which is how we trade same week options in 48 hours or less. So something where it's one of our more aggressive strategies, because we're dealing with options that are going to expire in a matter of a few trading sessions. And for a lot of people who are new to options, that's not usually the way I would start. I would actually say you'd be better off to start with something conservative and gradually build your knowledge and your education about options to go into this. But if you've traded options a little bit, or you understand the benefits of how we can control risk and get a lot more reward, this could be a strategy you could add into your trading arsenal. By the way, let me ask you, how many of you have traded options? Give me a number if you have, like first year, give me a 1, 15 years, give me a 15 in the chat, or 0 if you've never traded an option before. That gives me a little feedback on what kind of a crowd we have with us today as we get started. So Richard 1, great to see that you're started. Vicus 2, and Sandra, don't worry if you've never traded an option before. There's a lot to pick up here, and this is a very simple strategy to implement. John was 7. And more popping by there. So thank you for the feedback. I appreciate it. Let's get started. And first, to remind you, of course, that the information provided in today's presentation is based on our proprietary research, and it's intended for illustrative purposes only. These should not be considered specific advisory recommendations that I'm talking about today. We'll walk through case studies of what we've recently recommended but talk about how you can position for the future. Stock and options trading, as you know, have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. Do see our terms of use on our bigtrends.com homepage for more information in this regard. We're actually about to celebrate our 23rd anniversary since I launched Big Trends mid-November of 1999. Next week is our 23rd full year in business. So we've been blessed by so many folks that have come to us from MetaStock in addition to around the world. So thank you for your support. Or if you're new to Big Trends, you'll get a little taste of what you can benefit from here today. Today, I want to really share with you 3 secrets that I've learned in trading same week options. Weekly options, of course, there's every Friday is an expiration Friday with over 500 individual stock names. So, but the key is you've got to pick your spots. So trade only on certain days of the week. Okay. So I'm not going to try to trade these every day. I know for a lot of people getting into the trading game, you feel like, hey, I want to be in the game every day. I want to make some kind of a trade every day, because you get used to that sort of a worker mentality of, okay, well, I got to show up at a job every day. If I show up for trading every day, I got to do something, is the philosophy a lot of new traders coming in have. I think you've got to learn to shift from what you're used to from schooling, what you're used to from careers and traditional workplaces, and say, as a trader, your first job is to be an intelligent observer of what's happening and waiting patiently for when you have the right setup, the right pattern for the proper risk reward trade to put on. Okay, it's easy to get into a trade. It's much harder, as you probably learned, to get out of a trade, right? So let's not put on a trade at the wrong spot and then kind of put ourselves in a tougher condition about what we should be doing on the way out when we're like, I shouldn't have gotten into that trade. Don't just trade for activity, trade for results. Now, the beauty of weekly options is that as these options approach their expiration, you get even more leverage on your potential. We're talking about the razor's edge, if you will, of the leverage sword, right? Leverage can cut both ways, so we've got to control our risk. But of course, the beauty of that is that we're going to be able to get a much more decreased cost of investment so that we can buy these options relatively cheaply. A lot of times for as little as about $50, about $50 a contract controlling 100 shares, up to about $1 or $100 a contract controlling 100 shares. But regardless of what we have to pay, depending on the situation, we may pay more than that $1 a contract. But the idea is we want to set it up for the proper risk and reward stops and targets. So that's another secret. We're going to walk you through the strategic stops and targets. We're going to also talk about a couple of indicators today. I call it double confirmation, not one technique, but 2 that happen together at the same point on the same day. That's what I need to happen. So I can't just have one indicator signal today and another signal tomorrow. That's not a fast enough thrust. I need to have power of both indicators, like 2 rivers flowing into one more powerful river at the same point of entry to get me into that trade. This will help us to reduce a lot of fake outs. We want to get rid of fake outs. We can't get rid of all of them, but we can minimize fake outs and actually improve our hit rate and our confidence in the trades. Because let's face it, trading is not just about, having the right indicators. It's about having the confidence to place the trade and not have that fear holding you back and make you hesitate from pulling the trigger on the way in, or even worse yet, on the way out. So a lot of what MetaStock does for me and what it does for a lot of traders is it basically gives you a system and a set of data and a set of looking backwards over many years of data, like Jeff helped me to do with our Big Trends toolkit. I know he'll tell you about that when I'm done, but basically saying, look, now we can take all that data and that knowledge that builds our confidence, and now we can execute with confidence in real time. So execution is really where the rubber meets the road, okay? But the key is you've got to set up your trades. You've got a favorable risk-reward ratio, knowing that you can lose relatively less and you can make relatively more on average over time, so that means that, okay, if you do hit your stop, you get out. You don't hang around and hope. Hopium, as one of my Big Trend subscribers calls it, is one of the most deadly addictions out there, right? That you get hooked in hope, and basically you're going to get see a lot of small losses that you should be taking turning into big losses, versus then you get just feeling like you got to take any kind of a winner, and you take your winners out too quickly at smaller gains, and that's not the secret for success. The secret for success is smaller losses, bigger gains. Now, I've been trading for over 32 years. I caught the trading bug actually when I was at Duke University. Upon graduating from there, worked for the nation's largest options newsletter in the 90s, and basically then realized, hey, I was as head of research there in my final years. I was able to kind of see that I could do this for a lot of other traders with the power of the internet. In the 90s, internet was still relatively new, but I saw this internet, of course, is the way of the future, and it has continued to be the way. Even you look at COVID, the digitization of the economies when it comes to online shopping, online ordering, online work from home. The power of computers just continues to assert itself. So I founded BigTrends.com in '99. Our whole goal when I launched Big Trends is to say it's not about having an opinion about the markets. It's about having a systematic approach. It's one of the things MetaStock is so good at, is basically giving you a systematic approach to take your emotions out. I heard Steve Bigalow referencing that, yes, that emotions make us a bad trader or a bad investor, right? If we panic at the wrong time and get out when we should be even considering getting in, or worse yet, getting in on highs and hopes and then basically getting flushed out on the next retrace back down, that's not going to lead you to trading success. You got to have a system that tells you you have an edge. So our whole goal is that we've been able to serve tens of thousands of traders with unique option strategies based on this. One of the things I recommend is that you go through the entire event here, and MetaStock, by the way, congratulations on setting up so many great speakers that basically, and traders, the real world traders, to say, look, it's about focus. Okay, if you try to do too many things, if you multitask, it's proven that you will lower your IQ. Our goal, and I know MetaStock's goal here, is to enhance your trading IQ. So get focused with your full attention. Okay, put away the cell phone, put it on vibrate, put it on silent, even better, and basically get focused, learn, and write down questions. You can always email us and call us with questions you have about the presentation. This is information that's taken me, in a lot of times, years to learn, that I'm giving you my shortcuts to give you hopefully a leg up on your own options trading success. As you know, 2022, as I alluded to, a year of massive movement, the 20% plus drop. And if you were in the wrong stocks, we're talking about 50, 60, 80% drops, even in big names. I mean, you look at Meta, the former Facebook, absolutely pummeled this year. Even Apple here recently getting pummeled. Had its worst week last year since the pandemic, harsh drop on. And so the reality is that you have a situation here in which, okay, if you've got the massive movement, now the question is, how do you trade it, in what direction? And so that's why we developed this relatively new strategy. We call it Lightning Options Trader, that uses same week options that are going to hit their Friday expiration. We're going to talk about how we get into those. Now, a warning here, and we are big on disclaimers and reminding you that, hey, every trading strategy has risk, but this is definitely something where if you don't trade these right, if you just passively hope that they're going to work out, you can lose what you put into a trade. We're going to seek to control our loss quicker than that, of course, and knowing that, okay, hey, if you don't have a systematic way, see, that word keeps coming back, systematic. Systematic takes your emotions out. Filtering your trades, we're doing the scanning for you. You can learn from what you get in our Lightning Options Trader package that I'll tell you about, that you can actually learn how to do this yourself. So not just have me giving you trades, but you can learn how to go find these trades yourself with MetaStock's Explorer tool and more once you get the settings and rules sheet from us as part of the package I'm going to give you here today. But what I want to first focus you on is just really focus on these same week trading secrets before attempting this method. So you gotta not just know enough to be dangerous to yourself and your trading portfolio. So the first secret here, we started out calling these lotto trades, but I don't really love that name lotto because it implies a low probability event, right? If you're playing the Powerball, you know that the odds are of you hitting the $1 billion jackpot or whatever it is now, that basically your odds are like 1 billion to 1 or less, right? So the reality is that's not going to have a positive expected return. I don't recommend playing the lottery even when it becomes large. It's still a negative expected return game. I'd rather play a game where I have a positive expected return, even though that means that there will be winners and losers. But the key here is that knowing that these high reward last few days of their expiration trades are best on certain days of the week. Why is that? Because if you start off too early in the week, you find that you're going to pay too much, and that time burn is something we have to be careful about managing. So Wednesdays and potentially Thursdays are our two preferred trade days to get into these same week trades, knowing that Friday at 4 p.m. Wall Street time, Eastern time, that's your expiration, right? So you're saying, hey, you're trading them 2 days before expiration on a Wednesday afternoon. Yes, if we have the right risk reward and the proper setup, the proper signal. And we even go deeper into looking at every stock's history of trades to say, okay, does that stock work really well in the system? Some stocks work better. Some stocks do not work as well. Okay, so it's about also knowing you've got what we call a focus list, which we have and new subscribers get as to the best stocks to trade with this method. So you don't have to look at thousands or even hundreds of examples. You can look at the top couple dozen names with our focus list, okay? But the idea is that, of course, as the week increases, volatility can increase, just like leverage can increase. So the solution for us is that we wait those first 2.5 days or so. And so by about Wednesday afternoon, usually right around 3 o'clock Eastern, about an hour before the Wednesday close, we get in there knowing that we expect this move to typically double an option and by the next day's close. Okay, if it doesn't, of course, we've got a stop plan. We'll talk about that too. But the beauty of this is that, okay, and we do not enter new trades on the final day. So the final day is a no to get in. We think that's cutting it too close to the expiration, and it's not giving you enough time to let that move play out. Also, it's if you buy them on a Friday morning to get out Friday's close, you're guaranteeing yourself day trades, right? We know a lot of smaller trading accounts don't want to mess with the risk of a day trade or a bunch of day trades at once. So this is something where you don't have any day trades because we get in Wednesday afternoon. The earliest we can get out is Thursday morning, okay? So that's another benefit of this approach. It's still swing trading, even if it's a very quick swing trading approach. So with that understood, if you're new to weekly options, the idea is this is looking at, say, back in September's typical Friday calendar. You see all 5 of those Fridays in September, the 2nd, 9th, 16th, 23rd, and 30th all basically had weekly options. Technically, the 3rd week of the month is the monthly options expiration, but if you trade them in the last couple of days of their life, they're trading just like weekly options with 48 hours to go, right? So the idea is that from Wednesday's close to Friday's close. So the idea here is that, okay, why would we buy more time than we need? When you're looking for fast movement, weekly options are really ideal for getting that. That's why they become so popular. You see huge volumes in weekly options, especially on a lot of the big tech stocks and other big names out there that are gaining interest. And guess what? If it moves, it's going to get traders and institutions interest. And so I see a lot of hedge funds trading this, not just individual investors and traders. So that's creating more liquidity, more opportunity to get in, get out, not you against the market maker, not me against the market maker, okay? So Don says, do we buy extra time here? No, we don't buy any more time than we need. We buy for, if I've got a trade coming up this Wednesday at 3 p.m., which is fairly typical, I'll have at least one new trade a week. Wednesday at 3 p.m., I'll put it for this coming Friday's expiration. It's the 2nd week of November, the week 2 options for November, okay? So you say, isn't that really aggressive? I'm saying it's aggressive, but we know that, hey, if we can target a double and keep our stops significantly less, then we can get a nice reward for our risk, okay? And you can too. So the idea here is that, okay, these are some where we're going to get a very low time premium we have to pay. We're going to talk also about our strike price selection here in a minute. But the idea is that it's about finding technical momentum, right? So anytime you focus on the charts, you should be focusing on getting momentum on your side. The shorter term your method is, the more important it is to have momentum working for you and not fading momentum, not saying, oh, this dip is going to turn into a buying opportunity. We're very much the opposite of that philosophy. Our philosophy of big trends is that if things are breaking down and going oversold, you don't want to buy it. You actually may want to take advantage of more downside to come. So that oversold and overbought misnomer, as I call it, it's something that everybody thinks that, oh, this is an oversold situation, I should get ready to buy. It's the exact opposite. And you have to basically retrain yourself. If you've been reading the traditional textbooks, Steve earlier was talking about antiquated textbooks on his when he first learned candles and saying, look, If you're trading from a textbook that was a decade ago written or more, you're way behind, right? You need to be finding stuff that's working now, and you need to make sure that it's been put through its paces in recent markets, not in old time situations. Now, why should you care about this exciting new strategy? We call it Lightning Options Trader, new to our big trends community here just in recent times in 2022. And something that's very fresh that way. Here's a performance, though, of including past testing as well as trading history over the last 24 months, knowing that, okay, look, when you took every one of these signals, includes all losers and winners before commissions. So these are just buying options, by the way, buying a call or buying a put, targeting a double on your whole position when you get it, targeting a 50% loss when you get stopped out. And so, okay, with all that ups and downs from November of 2020, the pandemic year, to November 7th, 2020 to November 7th, that's today, in 2022, right now today, that this portfolio, if you started with a $10,000 account and put in no more than $1,000 a trade, so no more than 10% of your trade with no compounding, just kept it at $1,000 a trade for the last 2 years, you'd be up 143% on your portfolio trading calls and puts over this 2-day or less holding period. Okay, so basically it's typically 24 to 48 hours is our typical holding period. We can do a trade on Wednesday. We can also, if we won on that trade on Wednesday, we can do a trade on Thursday. But if we didn't win on that trade from Wednesday, we don't do a trade Thursday. So it's kind of a go with the winner strategy. So 10,000 would have grown to over 24,000, 24,371 in gross profit, adding up all gains and losses before commissions. Let's remember, past performance never guarantees future results, right? The future results are going to vary. We like to hope and think that they're going to be better, but at the same time, they could be worse. Results will in the future will vary from the past. That's just a reality of trading and investing. But the beauty of this is that you're not locked into having to hold something for a very long time. You'd either know quickly that you're right or quickly enough that you're wrong. You blow it out, you move on to the next one at a up to a 100% gain, or sometimes we get a gap even bigger than that in our favor. We'll show you an example of those outliers, but you shouldn't expect that. Target the 100% and take all of it off the table when you get a double or more that next day. Now, how do we find those trades? I'm going to show you here momentarily with a few charts, but bottom line is that let's first talk about our second secret. The second secret here is that one indicator is not enough. Two indicators, we call it double confirmation, both signaling on the same Wednesday afternoon or Thursday afternoon that we're getting our signal that you should be into this trade, then two indicators are better than one. That doesn't necessarily mean 3 is better than 2 and 4 is better than 3, right? It means that these two we found is kind of a sweet spot to keep us focused on the best fresh thrust opportunities, best takeoffs to the upside or best collapses to the downside, okay? That's what you're after as an options buyer, is getting quick trend momentum in your favor. And so we do like using oscillators that are similar but not the same, okay? So we're not looking for a perfect overlap of two oscillators that just line up the exact same all the time. We're looking at things that are kind of different enough that way when they both signal together, twice the confirmation for us leads to twice the confidence in our trades, right? We're looking for that kind of extra something that's happening to say this should give us more opportunity, more confidence that this trend should continue. Now, let's look at a trade example here that we recently went on Pfizer, PFE. You know, Pfizer's been a big beneficiary of all the vaccinations with COVID, right? But we know COVID is receding, at least for now, and pray that it continues to recede, right? But the reality is whatever happens, we can pick up on this chart that it's not one but two oscillators that are performing here, okay? So I heard somebody else earlier ask about Williams percent range. We look at a lot of different things from Williams percent range, RSI, CCI, stochastics. We've got a lot of different indicators, and a lot of those are available in my toolkit that Jeff will tell you about later that literally has a dozen different techniques that you can use. But this is taking two of those oscillators. When you become a subscriber, you get the exact two with the exact settings that we get. But the key is, look at this oversold. Below this, on this middle panel here, we'll put an OS by it, right? And the same thing with this bottom green line here, another oversold area, okay? When we went oversold before on Pfizer on this one oscillator, It was not quite there on the other one, okay? So we didn't take that trade. That's a fake out. You see, if you got bearish there saying, hey, is it breaking down even more? And remember, oversold is not a buying opportunity with our big trends methodology here. It's actually saying momentum is thrusting more to the downside. So now you get not just one oversold here, but another oversold here. That was October 6th. And so in that last hour, we're saying we want to get into a Pfizer stock trading about 43.25, maybe 43.30. We're buying a 43.5 strike put. Now, if you're new to options, that means it's a right to sell Pfizer at 43.50. So as it is the first strike in the money, okay, the first option that we can buy that's even slightly in the money is the one we want to trade. So we call these near the money options, but with a slight bias to being a little more in the money than out of the money. Because the idea is that as it goes from around the strike price, maybe slightly in the money, to more in the money, that's where you get a massive, what we call gamma boost. I mean, gamma means how fast you pick up delta. And I'm not going to get too technical on you here today, but it just means that delta means how much your option should move on the next point move in the stock. So if you've got a 50 delta, it means that, okay, the stock moves down a point, your option should go up 50 cents. So we know right away if this option is trading close to a 50 delta, we buy this thing for 53 cents. That's 53 bucks a contract. We need about a 1 point move or slightly less than that with it being slightly in the money. We need about a 1 point move for this thing down to about 42.5 to get our double target, right? From 53 cents, we need it to go to $1.06. Now, as it worked out, it moved down so quickly that next morning we felt a little bit better than that double target, and we got out closer to about $1.15 on average. I made a little more than 100%. I made 107% that next trading day. Now, you'll always look back and say, there are times where it keeps going. You could have made even more. But there are also times where it reverses, right? So we're taking the bird in the hand philosophy here. Take the double and run, right? Take the 100% gain. Don't sell half of it and try to keep running. I have other programs where I do sell half and try to go for triples or quadruples. But in this case, it's actually worked better to say, take the bird in the hand double on the whole thing. You know, if you bought, in this case, if you were putting $1,000 into every trade, you know, if it was 50 bucks, it'd be 20 contracts. Here, it's a little bit less than that. Maybe you can see maybe 18 contracts or something like that you're getting. It doesn't matter about maximizing your contracts. It matters about, can you double your money? If you're putting $1,000 in, or give or take, you double your money, you just made $1,000 profit on one trade, right? The very next day. Now, there are times where we put 1,000 in, we lose 50%, and we could lose $500, right? So make 1,000 and lose 500. If you could do that every other time and rotate it that way, 50-50 win rate, you'd still be averaging a $250 profit per trade, right? You'd be up 500 over 2 trades, not including commissions, but saying, look, on a gross basis, you'd be up $250 per trade. We call that having a positive trade expectancy over time. That way, you know, okay, I can keep firing. Even if I've had a losing trade or two, I can keep firing knowing that if I play the odds over the course of the years of our testing as well as our trading, that then we say, okay, look, there's no guarantees in trading or in life, but the reality is you've got to be able to keep executing consistently. And what we tell people too is that, you know, make sure that you are comfortable with the amount you're trading, especially starting off, to say, look, you haven't totally learned the methodology yet. You're just getting kind of your feet wet. Start small and build. Trading is scalable. Trading is something where, okay, fine. You say, I'm going to start with 500 instead of 1,000. That's fine. You can do that with this method. And basically say, okay, then as you gain confidence and see what's happening, you can bump up to what your more normal allocation would be as you start to see how both not just the reward works, but the risk works, right? You start to get a sample in real time that you can work with. And so we, in the package I've set up for you, have given you plenty of time to take advantage of kind of getting your feet wet, getting kind of accustomed to how this thing works. So regardless of what happens from there, we don't care after we've gotten our double, right? If it goes on to triple, quadruple after that, fine. If it flips on us, money is back on the sidelines. The $1,000 off profit off $1,000 invested is, in this case, a little bit better than that, is taken and put back in your account into the safety of cash, waiting for the next trading opportunity. That's just a bear example, right? That's a put trade. We do both calls and puts, and in this one, it's pretty close to almost even. In the past year, look at this, 54.5%, almost 55% of the trades have been calls, and 45% have been puts, right? And you say, well, the market's been down. You might even think that we'd get more puts than calls. But remember, we're trading this on a very short window to say, okay, what's the history look like? And therefore, what does our opportunity look like? So I showed you a bear example. With this balanced approach, I think that's what's so exciting about it, is that you don't have to worry anymore about the market. What's the market going to do? You know, I know some people would say, oh, I won't buy a call if the market's down. Our philosophy is, if we have an edge, we want to take advantage of that edge over time and not let something like the gyrations of the market sway us from what should be a great opportunity, right? You might think, oh, the market's going to lift all ships or it's going to drop everything at the same time. You see, this year it's not working like that. You've seen tech collapse here lately, and yet you've seen huge gains in energy, huge gains in industrials along the way, sometimes healthcare, sometimes biotech. You know, it's like the rotation. It's never been, I think, more evident than this year of what a stock picker's market it can be and how you can profit from that stock picking with this kind of a method. So now let's look at a call on an energy-related name, Apache, APA. Okay, this is actually from last week. So when you ask, what have you done for me lately? Well, this is what we did for our Lightning options traders last Wednesday. Actually, last Thursday. I'll take that back. This was a Thursday example. And you can see here that this is a perfect example where you wouldn't want to miss out on an opportunity here when we were saying, look, this has had a huge flip. By the way, if you're watching on those engulfing patterns, this was a big bullish engulfing pattern. So you can sync up lessons like you learned from Steve's candlesticks that he was just talking about. I know Jeff talked about it too. Look at engulfing patterns. That's a beautiful bullish engulfing. But the key is that, look, here's our indicator. Going overbought on the one oscillator and on the second oscillator on the same upside cross. Both of them have to cross together. It can't be that one's been sitting there overbought and then the other just now joins overbought in a future day. These are, by the way, daily charts. And so the key here is that, look, daily charts, we're looking at into that close. We're finishing just above 47, about 47 and a third. We're buying the options are going to expire the next day's close. Okay, so this is something that if you're new to options, it might take a little getting used to, that this is pretty much cutting the razor's edge of volatility into the final day's close here. 24 hours later, 25 hours really, because we put it out about 3 o'clock on that Thursday. And then, okay, by 4 o'clock the next day, 25 hours later, that option is going to expire. Well, guess what? We're going to be out before then, win, lose, or draw, right? We're at a dollar, $100 a contract to control the 47 strike calls. You know that intrinsically it's got to go to about 49 that last trading day. You can see actually Apache this past Friday went to 50. Okay, you can see today it's settled back down a little bit. But the key here is that at 49, we're definitely cashing this thing in, right? We're saying take that double from as it goes from about 47 and a quarter, 47 and a third up to 49. Think about that in percentage terms. What is that on the stock? The stock's rallied about maybe 1 3/4. It's rallied not quite 4%. We're making 100%. You see the 25-to-1 leverage plus on this type of a situation for less than a day, less than a full 24 hours of work, right? From Thursday's near close to Friday intraday. So the beauty of this is that we send you real-time emails. We'll show you a real-time email in a little bit about how that looks, as well as a text alert to your smartphone on how you can profit from this next trade and also how to manage risk if it doesn't fire. Okay, not every trade is going to hit its target or its stop. Sometimes we use what we call a time stop. So here's an example with what's normally you would think kind of a slow name, Kraft Heinz, right? Ketchup, cheese, whatever. You say, okay, look, they move just fine for us with this system. And in this case, we closed it out on a Friday, 1 hour before the expiration close. So at 3 p.m. Friday, if we haven't hit our stop or our profit target, we say, okay, we gave it a chance. Make sure you go ahead and get out of this thing before the expiration close. It's time to get out. So in this case with KHC, here we are, got the trade on this was a Thursday. This was, you can see on this Thursday, we were getting the signal to get in. The stock was trading about 37 3/4. We're buying that one strike in the money, the 37.5 strike call that's going to expire the next day's close. We paid 51 cents, 51 bucks a contract. Do you see how many of these examples you can get in for a buck or less, $100 a contract or less? $51 to control a stock that's worth on 100 shares is worth about $3,775, right? So that's where your leverage comes in, because you're controlling that stock for a very short window as they both go overbought. Now notice, this is another example where the prior few days you said, should you have gotten in back here because this thing was crossing up? And you say, look, no, this other confirming indicator here, an oscillator, was not in its overbought mode. So while you say, well, gee, we missed out, we bought it too late, it could have bought it earlier. You can always play that woulda, coulda, shoulda game in your trading, but that's not going to serve you to say, where's my edge strongest? It's strongest when both of these cross above their overbought at the same time. That's where we want to not sell, we want to buy when we get that kind of strength together, right? Here's another one back here where it looks like it crossed up on the left. You say, question mark, should I get in? You say, no, because we're not getting the confirmation. You avoid this kind of a fake out bar where maybe intraday could have gotten you a profit, but see, the odds were not with that trade for the future days. And so the key here is that it's about putting the odds in your favor, but they both have to line up together at the same time. So we got out that next day. See where the stock's trading by the end of the day. It's close to our profit target, right? We need this thing to go to about 38.5. It's about 38 and a quarter. We're getting a 76% gain and out by 3 o'clock that next afternoon, right before the expiration. So the key is, okay, can you focus on this? And that's why not just getting email alerts, but also text alerts to your smartphone, I think is essential. So we send you both, so you make sure that you know exactly where to get in, where to get out. And if you ever have a question, you can call our 800 Big Trends line and make sure that you haven't missed an email or a text alert. If you've got any doubt or any question in your mind, we've got real people standing by all day, every day during trading hours. Okay, so classic business hours. So, and let's face it, let's talk about a losing example too. Not every trade's going to win. Here's what a typical, kind of a, hits our 50% stop example looks like. And so, okay, 50% may sound wide for a lot of you. They're used to trading stocks and having very tight, much tighter percentage stops. But with options, especially 1 or 2 days from their expiration, you got to give some room for wiggle. We found that the 50% stop level is pretty much ideal, because here's a great example with On Semiconductor. ON's a symbol. Back in August, we had recommended the 75 strike calls when the stock was trading closer to 76. We paid $1.53 when it was about $1 in the money, right? So this is a little more than $1, $153 to control 100 shares of stock that was worth somewhere in the neighborhood of $7,600, right? So your leverage is still tremendous. But you see the next morning it opens down a hair and it just keeps dropping here, right? So somewhere in here, closer to the 75 strike, we're getting stopped out here for about 75 cents. We're losing just over 50%. We lost about 53% on that trade. I know that doesn't sound good to anybody to lose 50 or 53% on a trade, but the idea is if you can make a double, like we said, on $1,000 invested, you make 1,000. In this case, we would lose about $530, give or take. You say, okay, on $1,000 invested, and you say, okay, obviously if you're putting in $1,000, by the way, you can see how many contracts could you get. You couldn't get 7, that would push you over 1,000. So if you get 6 contracts here, you'd be investing about $918. So you'd lose about 470. Okay, so that happens if you're trying to make 1,000, lose 470. I would still do that all day, every day, if I know I've got the odds stacked in my favor, right? It's like even if you're playing a coin flip game, but you made more money on the times where it came up heads and lost less when it came up tails, you would play that game and knowing that you've got that kind of a steady kind of a win rate around 50%, knowing that you can make more and lose less. That's a game I would play every day. It's just about being consistent with your capital allocation, taking every flip, every trade, not trying to pick and choose. Okay, just being consistent. Consistency breeds confidence. The third secret here, finding a favorable risk-reward ratio. I've already talked about it, but as we said, a 50% stop, knowing that if it gaps against us more, we could lose more than 50%. But you know what? Sometimes on our 100% target, it gaps even more in our favor. So this is what's called the asymmetric benefit of buying options, knowing that you can't lose more than you put into a trade. You can make many multiples of what you put into a trade when you're right. So it doesn't take many of these doubles to generate some impressive net returns over time. In this case, looking back over the past 2 years, the strategy had 32 profits that doubled or more. Okay, so when you start looking at that, you say, okay, we can make that triple-digit gain, and we can make it sometimes very dramatically. In this case, let me talk about one of these outliers that went on to be, and this was from late July, First Solar, FSLR. We bought a call right before there was news that hit, and we weren't expecting this news. Our system just picked it up that we got all this congressional money flowing into these renewable and alternative energy sources, including solar, benefiting from this. So look at FSLR, First Solar here. This was July 27th. This was a Wednesday afternoon. Stock was finishing here just or in the last hour, it's just above 77 bucks, about 77 and a half. We bought the 77 calls. They're going to expire in 2 days and an hour, 49 hours later, right? So basically, we put it out 3 p.m. on Wednesday to buy the 77 straight calls, paid almost 2.5. So if you're putting $1,000 in, that would only get you 4 contracts. But guess what? Think about this. That's about $1,000 invested at about 2.5. 249 was our average entry price. The next day, when that congressional money flow news hits, see it goes from 77. Look at that red reversal. It opens near 90 bucks. What's a 77 call worth up near 90 bucks, right? A right to buy at 77. Now Thursday morning, the 28th of July, it's at near 90. That's worth almost 13 bucks. So that 2.5 is turning into more than 12.5. And we're cashing it in that next morning. So we've only been in that trade for just over an hour, right? In trading hours, from that last hour of the trade Wednesday, getting out Thursday morning. It's not a day trade because it's another day, but the idea is that it's up 407%. This is truly an outlier. I don't expect this to happen, but maybe even once a year. But, you get one of these happening, and that's like getting multiple doubles all at once, right? You take $1,000 and you turn it into roughly $5,000. You make about a $4,000 profit, and you're going, okay, that gives me a lot of cushion to, on a 10% of your capital allocated, you make over 400%. That's like a 40% gain on your total trading portfolio on one trade. Okay, now that's an outlier. It's not going to happen that often. Don't anticipate that it's going to happen that often. There will be times where it could gap worse than your 50% loss too, So, what if you lose 100% of your investment on a trade? It could happen. Well, again, I would take that risk for the fact that I can make well over 100% when it gaps in my favor. 2, 3, 4, or 5, in this case, 5 times my money every once in a while, right? So the idea is that, and this one did keep going the next day. I didn't care. Very happy to take 407% that next morning. So the idea is recapping these secrets. It's all about picking your spots, not trading every day. My family's been in the thoroughbred horse business for generations, and my grandfather said, you can beat a race, but you can't beat the races, and it's like, in this case, it's saying, look, don't try to be a hero and trade every single thing that you ever see moving out there, right? It will get you into a lot of noise, and it will reduce your confidence. Entering only on Wednesday afternoon, and then only considering a Thursday trade if we had a Wednesday doubler already booked to say, okay, we've got some sort of free trade, if you will, to work with for that next day. That's the only way we'll add a trade on a Thursday. Don't just use one technique, use 2. You'll get all of these techniques from me in a rule sheet and kind of an overview. In addition to weekly video training, they'll tell you about that I give all of my Lightning Options Trader subscribers. We're trying to get those fake outs reduced, right? You saw some examples where one signal but 2 didn't, and that served to help you miss some fake signals, some fake outs rather than true breakouts. And then the risk reward targeting, in this case, twice our reward for our risk will allow for the chance to make doubles. And then if it's at that 50% loss, just blow it out and try to preserve capital to not let it turn into a total wipeout, right? You don't want to do that. That will eat up too much of your hard work on your gains, right? So just reminding you what a 24-month performance look like with our Lightning Options Trader program. Like we said, this assumes you start with a $10,000 account. You could start with quite a bit less. You could do 5K or even less, because we're never going to have more than 2 trades open at a time. And so, okay, and you're done by the Friday's close. All your money's back to 100% cash, just waiting for that next signal on Wednesday next week. So we're looking forward to a new one here in just over 48 hours on Wednesday afternoon this week. Okay. So the beauty of this is that, okay, just looking at the last 2 years, $10,000 account turned into $24,371 before commissions or subscription fee, and saying, look, that's just, that's a tremendous return, given that if you looked at the market performance over those last 2 years, sure, 2021 was a good year. 2022, if you bought and held, not a good year, right? So the reality is, you would not be doing so high just buying and holding the market versus you could have more than doubled your money in 24 months. Okay, and keep that in mind, more than doubled your money. We're going to talk about a guarantee on, we believe very confidently we can double your money over the next 24 months or less as well with this method. And we're going to show you how we back it up. Now, bottom line is that, but obviously past performance doesn't guarantee future results. We all know that. But the idea is that we showed you the 3 secrets here. And the other thing that we do, and this is where a lot of people come to us at Big Trends, is we actually do what we call profit factor filtering. What does that mean? It means we go through and examine every trade signal that we get on a Wednesday or a Thursday to say, is this a trade that we should really have a lot of confidence in based on its history, oftentimes over decades of data. So we're looking back over many years of data and saying, okay, is this thing working on the long side, the short side, or both sides? And this is what helps us build our focus list to help us find the new trade signals that we have a lot of confidence in. So we're doing that work for all of our Lightning Options Trader subscribers here. And so to get access to this, I've just got a few minutes left and I want to show you how you can get access to this. Is basically you get real-time alerts sent to your email and to your smartphone. You want to set up that smartphone texting ability as well. And we set up this special, thanks to Jeff and the MetaStock team. I wanted to give you some extra goodies here. So let me show you what I've got in this Lightning Options special. Normally, if you bought 12 months, a month at a time on our website, it would be $297 a month. In addition to all the extras that we're including here of our settings and rule sheet, weekly video training I do every Monday at 6 p.m. I'm going to record a Lightning Options Trader video here in just a little bit that'll be posted on the member site access at 6 o'clock Wall Street time. And then access to me and my analyst team via dedicated email. Anytime you've got a question about any trade in the portfolio of Lightning Options Trader, you can email me. If you're just buying that monthly list, $297 a month over 12 months, you'd be up to $3,500 plus, right? I'm going to make it a lot more attractive for you today. And in fact, much more attractive than just cutting the price. I'm going to actually give you some extra bonuses. When you buy 12 months today, I'm going to give you an extra 12 months on me. So you're actually going to get 24 months for way less than the price of 12 today. So the total value of this package, $7,000 plus when you add up the monthly list price. I'm going to give it to you for just a one-time investment of $997. The reason I say investment is, would you invest in any program? No, you would invest in programs that give you a positive expected return over a large sample of trades. In this case, a year would be a value at $997, but I'm going to give you 2 years for just that same one-time investment of $997. It won't auto bill. It won't do anything. I can't guarantee in 2 years it'll be that low, but the reality is for the next 2 years, you can lock it in when you go to the special link that we set up for you here. And it's members. I'm going to type it in the chat box, Jeff. members.bigtrends.com/LOT for Lightning Options Trader. It is a lot of value, okay? I can't help it. But bottom line is it's true. I mean, we're giving you a lot of value. And in fact, I'm going to stand behind it to say I'm so confident that you're going to double your money over the next 2 years, or frankly, I expect it to happen a lot quicker than that. But in the next 2 years, I'm so confident you'll have doubled your money within those next 2 years that I'll give you the performance guarantee that if you don't at least double your money, hey, if you're only up 50% in 2 years, you will get an extra 12 months free if you haven't at least doubled your money, okay? So an extra 12 months will be added to your subscription if at the end of those 24 months you haven't at least doubled, okay? If you more than double, you say, hey, you promised me a double and I tripled you, hey, it's at least a double. But bottom line is that now we say, okay, this doesn't include commissions or cost of subscription. The bottom line is that, yes, just looking at the total gross performance, adding up all gains and losses before those things, let's expect that we're going to at least double your money. Okay, now we're assuming that you're going to be able to put in $1,000 a trade, but even if you're putting in less, I'm confident over time you'll get that double. And if you haven't, I'll give you an extra 12 months on me. Real quickly, as I'm just in the last couple of minutes here on my presentation before I hand it back to Jeff, if we look at going to that page, remember it was members.bigtrends.com/LOT, this last link here in blue. When you go to that page, members.bigtrends.com/LOT, this is what it looks like. I'm a big believer in the KISS principle in trading, and in this case, in the order page. Keeping it simple has served me really well over my 32-year trading career. Okay, the reality is that, look, we don't want to make things complicated, so just get your key billing information in here, whatever your credit card bills to, you can pop your credit card number in here, or if you scroll down just a hair, you'll see there's a PayPal link in that yellowish orange PayPal color there, button there. So the bottom line is that you can go PayPal as well. Now, one of the things that we want you to do is review all terms and conditions. Like I said, Big Trends is celebrating its 23rd anniversary next week. I launched the company mid-November of 1999. I've always been about transparency. I lay out all terms and conditions. I lay out, okay, if you don't like it, what your refund policy is, where you can get some of your money back, that's there. But the reality is, look, you've got to review that, agree to your terms and conditions. As I said, if I don't at least double your money in the next 24 months, you'll get an extra year on me. So 2 years would turn into 3 years if I haven't made you at least a double in these next 2 years on your Lightning options trades that I'm going to call out for you real time, week after week. If you think about how many trades you're going to get to, at least a trade a week on average, or at least 50 trades a year. We expect to do more like 70 or 75 trades a year. But now I'm giving you 2 years of that. So not just 100 trades, but probably well over that for less than $1,000 bucks. That's phenomenal values given that how many of these can double your money and how fast you can get there with Lightning Options Trader. So you can review those terms and conditions, check the box, complete my purchase when you've got your credit card information in. If you have any questions, we've got our toll-free number up here, 1-800-BIG-TRENDS, or you can email us anytime via clientcare@bigtrends.com. You get a separate dedicated email to me and my analyst team as well if you have questions about your portfolios that are related to the trades called out. We spell it out down below here as well with the terms and conditions and our toll-free 800-BIG-TRENDS number and the client care number. So let me just see real quickly if I miss a couple questions, then I'll hand it back to Jeff. Canav asks, how many trades do we open at once? We can never have more than 2 trades open at once. Usually it'll be 1 a week, but sometimes 2 a week. And so the reality is that you can keep yourself really focused on the best of the best trades. And so in this case, Ed says, what about selling options? That doesn't take advantage of the potentially unlimited reward versus risk. It's actually setting you up the other way, Ed, that you can lose a lot more real quickly if you're on the wrong side of an option to sale. So, or even a credit spread. So we don't think that's setting you up for the proper risk reward dynamic as an option seller with this strategy. There's other strategies that you can do well with option selling. This one is much more about knowing how to buy this. Joyce, say if you edit trade, I'm not sure what you're saying there, but basically we call it every trade in real time. We track all of our winners and losers in our model portfolio. If you've got a question about looking at our last 2 years plus of trade history, call us at 800-BIG-TRENDS or email us clientcare@bigtrends.com. That's on the order page there at the top and at the bottom. And ask for the full track record. Study it. Study all the gains and losses. Study what drawdown risk you had along the way. We're fine with that because we're that confident that you'll definitely want to lock this in. This offer is not going to be out there that long. I'm at my noon cutoff point here, so I'm going to hand it back over to Jeff to say thank you so much for having me. It's always a pleasure, and look forward to seeing you all again real soon.
Thank you, Price. Before you go, I have one favor to ask of you.
Yes, sir.
I want you to give me a random number between 1 and 9,419.
All right. How about 7,223?
Okay. Thank you. I'll look at your price. I got to figure out who that is, though. So
I'm going to just give you number 1, right? But no, it's tough on you there.
Hey, dude, I'll find it. Let's see. Just in case you're interested in who won the prize, it's Alexander S.
All right. Congratulations, Alexander S.
We'll talk about the prize in a second. Price, great job. I appreciate you coming in, working on the toolkit with us. The offer link again for that is members.bigtrends.com LOT. Yeah,
thank you, Jeff. Always a pleasure. I appreciate you having me.
All right, very cool. I also want to talk a little bit about prices add-on. And so let me go ahead and make myself the presenter real quick. Unfortunately, not unfortunately, but we are running a little bit behind. So I'm going to make it really quick. But we have created a very, very popular add-on with Price as well. I mean, I remember Price was one of the first really big projects I took on when I started my business development role. And this has been so popular that we're on the third iteration of it. And it's been extremely popular. We call it the Big Trend Toolkit for MetaStock. And in it, it includes all of the methodologies that he wrote in his book, Big Trends for Stocks and Options. And with that, here's a list of the methodologies, but these are all included. There's a number of different add-ons that are available for different platforms that aren't MetaStock. This is the most inclusive. This is the only one where you're going to get so many different methods and so many different models. One of the things that I was a fan of, though, with the version 3 that I'm just going to show you real quick was Big Trend Toolkit Score and the score breakdown. With it, it actually combines all of the actual indicators that he uses and comes up with a scoring system that ranks a stock anywhere between 0 and 100. And we kind of created it. I liked it so much, we included it in all of the expert advisors. I'm going to show you one of the systems right here on the Dow Industrial Averages, or the DIA chart that we've been looking at. This is using Price's indicator called BTTK efficiency. Okay, so what it looks for, and Price is really good about the way he kind of describes this. This is looking for stocks that are moving efficiently. And he compares it to like a trading commute, like stocks that are moving very, very efficiently. So if stocks are moving very efficiently, they're going to kind of get to the goal of where they're going. And this is a score that he gives stocks. And one of the many methodologies that I've shown. But here you'll see right here a buy signal right here. There's an exit. These are all kind of clearly defined for all of the methodologies. Yesterday we had a buy score, okay, or a buy signal, and I could run an exploration to find that in MetaStock. MetaStock's really, really good at scanning. One of the things I particularly like about this expert advisor and this particular methodology is the specificity, how specific it is in terms of giving you signals. So if I go back one day, I'm going to go ahead and kind of move this arrow here. This is the arrow that the expert is looking at. If you'd ran a scan, or if you're just looking at the Dow because it's the Dow, on Friday, you'd see that this was giving an efficiency buy signal. And I'm going to go ahead and come in here. The big trend score is actually pretty low, 20. It goes up to 100. 20 is actually kind of terrible. But right here, the efficiency ratio system is currently indicating a long opportunity. When the efficiency ratio crosses above 30, use that bar's high as a key point that must be closed above that bar's high to confirm a buy signal. So what it's saying there is like, okay, we're going to wait for a close above this high that we had on Friday, and if so, that'll be a confirmed buy signal. Okay, again, we're not recommending you buy Dow if it closes above this. We can't do that, but that's the way you would interpret the indicator. Okay, but the thing I like about the expert commentary is how specific he is about what you could do with that. So if you're interested in taking advantage of this opportunity, you should look at buying the stock. If you're an option trader, you can look at 3 to 4 months out before expiration. If you're extremely aggressive, you could look at one strike out of the money. Or if you're more conservative, you could do this. Kind of lists all of that stuff out. And it also gives you some ideas in terms of when you should be looking to exit that position. One, if the efficiency ratio closes below the low where the efficiency drops below plus 30, or on the close 2 weeks before the expiration date, or by the first Friday of the expiration month. So it's a cool add-on. Again, these are all the methods that are included. Because it's a MetaStock add-on, you can go in, you can kind of see the signals on a chart, you can see the expert commentary. You can use our scanner. So if you're here in the US, you want to scan all the optionable stocks for your favorite system, you can. It's all inclusive. So it does a really, really good. In total, it's 17 different methods. So you've got the experts, the explorations. You can system test it. We have one of the best testers. In my unbiased opinion, we have one of the best testers that are out there, and all of the custom indicators that are available as part of the actual add-on. So with this, the add-on itself is normally $6.99. Here at the conference, we're going to give you $100 off for that. It's $5.99. We're going to back it with a 30-day risk-free money-back guarantee. I wish I could get that on all of the trades that I've been doing, but if you don't like it for whatever reason, you can cancel, you get a refund. So if you want to do that, you should give it a go. Again, if you don't have MetaStock yet, we can give you a trial as part of this. Give us a call, 800-882-3040. You can visit us online at metastock.com/saleschat, or you can go to metastock.com/conf-promo. So there you go. Very quickly, I'm going to talk about the CMT sponsorship. We appreciate CMT. CMT is a huge, very well reputed company. They've been doing a great job. Hello, Scott. Goodbye, Scott. We really appreciate the work that they've been doing with us for the last year to kind of help us promote the events. It's a great organization. You can find out more about them at cmtassociation.com. And before we get to Scott Brown, just one more thing. Well, I promised Alexander S. that you won a prize. So we're going to give you 3 months of MetaStock RT, the real-time version. We're going to give you 3 months of data. We're also going to give you a 3 months of a service called learnmetastock.com. So all in all, that's about doing some math in my head, $1,050 value, approximately, just math head. We're going to go ahead and give you that. I'm going to send you an email. I'm going to request some information for you to kind of help you get set up. And congratulations, you're a winner. So in any case, we're going to go to Scott Brown next. Before we do, I'm going to read the disclaimer again because I know you love it. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators of features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So there you go. Our next guest today is Scott Brown. Scott is actually the owner of MetaStock. He is one of the nicest guys. He's going to talk about our patented forecaster module that's in MetaStock, but he's actually owns the company right now. I'm going to only say good things about him because, well, he owns the company. But we love Scott. He's such a he's such a great presenter, and it's certainly good to have him on here. Scott, how are you doing today?
I'm doing well. Can you hear me okay?
I can. You're coming through, and I can see you.
Good. Boy, the handsomeness of this conference just went up about tenfold when I joined.
I think it's a little more than that. You're being
yeah, I'm just kidding. I'm thrilled to be here, buddy. It's going to be awesome. Yeah, it's actually my wife's the owner. I'm her worker every day.
That's actually true.
Fair enough, right?
Yep.
Good. You're doing a great job, Jeff.
Well, thank you. I just made you the presenter, so yeah, you should be able to kind of take control.
So just click show my screen. Okay. I think we're okay. Can you see that okay, Jeff?
I can see the go-to web. Yep. So if you just hit present, you'll be ready.
Okay.
Awesome. You're great.
Well, first off, let's kick this off and let's give a big thank you to Jeff Gibby and Kelly Clement. Jeff does everything here. He does all of our sales. He is involved so much with marketing and business development and things like that. It's because of Jeff we get these conferences put on. And, this is a lot of work. I think, there's around 40 different presenters. And to line this up, get everybody on board and to do this for free, that's great. And it's a huge appreciation there. Kelly is in the background. He's helping with all the technical aspects. He's the president of MetaStock. He does so much all across the board with MetaStock. But without those two, this conference wouldn't happen. And so a huge thank you to them. And I know I speak, Jeff and Kelly, for all the people watching. Thank you. You guys have done a great job organizing this. And to have this for free, all these massive experts, and with the technology that we have today, that you can just log in from your home and watch this, or I bet some of you are at work watching this, and whatever it is that you're doing. So I've been with MetaStock for over 20 years. And I actually started with MetaStock just as a sales rep, as an average entry-level sales rep. And, I worked my way through. We were owned by Reuters at the time, and then Thomson Reuters bought us, and I became a product manager of MetaStock. And way back when, I helped create MetaStock versions 8, 9, 10, 11, and was working on those from a product management point of view. And then I went into our large account sales, where it's our global sales, and I was in charge of our dealers. And I kind of ran that group for a while. And then I became the director of sales and marketing, and then the president eventually. So I've done everything from the most basic level here to, all the way up to being the president. And then during the recession, the Great Recession that we had, back in about 2011, and I was meeting with my boss, who came over from Deutsche Bank, and a great individual, and he kept telling me the first 15 minutes I'd met him, and we were in New York, and he said, "Hey, we need to get back to our core." And I was like, "Our core?" And the core being institutional clients, and that isn't what MetaStock is. And so I said, "Well, hey, are you going to sell us?" And he said, "Yep, I sure am." And I said, probably the smartest thing I ever said is, "Hey, can I buy it?" And he said, "Sure." And it took us about a year, and that's kind of what happened. And so I've been involved with MetaStock, as you can tell, from a lot of things. And I'm going to give you some background on what we're going to talk a little bit about today. It's the MetaStock Forecaster, and it is an incredible story. A gentleman named Ken Hunt, who is one of the best programmers in the world. He's been working on MetaStock code for over 30 years, created our back tester and this forecaster. Well, me and Ken are good friends, and Ken was building things when we were a part of Reuters and then Thomson Reuters. They wanted him to build a chart, but Ken is not satisfied with just building a chart, and so he would build all these cool things along with it. But Thomson Reuters, all they wanted was a chart. And as I'm sure some of you, if you've ever been part of a very large company or corporation, change doesn't come easy. And, Ken is definitely built for someone like MetaStock, a smaller company. And so he moved on, and he quit Thomson Reuters. But him and I would go to lunch about every 6 months just to catch up and see what's going on. And in the beginning, for about 3 years, he was building this software called the Forecaster. And that's really what we're going to look at. And then when I bought the company, I called Ken Hunt up and I said, "Hey, some crazy news has happened, and I'm taking over for as an owner of MetaStock, and I'd really like it if you would come back and help us build MetaStock to where it needs to be." And basically what I told him, we're getting the band back together, and what he had been working on full time for 3 years was the MetaStock Forecaster. And so we were able to come to an agreement and put the MetaStock Forecaster into MetaStock, and it is so cool. It's we're putting a patent on it. We've only been putting a patent on it for the last 7 or 8 years. Talk about if anybody's ever done that out there, I'm sure you can laugh with me, because that is a process beyond processes. And the only one that wins on that are your attorneys. They can charge you a lot of money, but we're doing that, and it's been great. So with that introduction, what does the MetaStock Forecaster do, and what are we going to talk about today? You guys really are lucky, because this opportunity to see this functionality, we're the only software in the world that has this type of functionality. And so that's why it's just so important that what we're going to go over today. So it analyzes price action after past events to determine the probabilities of future price action. It really answers the question, where are prices most likely to be in the future after an event occurs? An event can be anything from basically an indicator. So if you have a MACD, Bollinger Bands, if there's a buy or sell point on that chart, an event will be created. And after we click on that event, a cloud will actually draw out. So there's a few things that we're actually going to go over today in the forecaster. We're going to look at things like looking at these clouds and the clouds and showing how those work, showing into the future, drawing your own patterns. How many people have asked me over the years, do you have a cup and handle pattern? Do you have a triple top pattern, a head and shoulders pattern? And some of them we do, but there's so many patterns out there that we don't have all of them. So now Ken has created the capability for you to draw your own pattern with your mouse inside of MetaStock. And this forecaster is not a plugin or an add-on. It comes with the base product of MetaStock, whether it's the real-time or the daily charts. We can copy patterns directly from the chart, rank recognized events, and we're going to get into all of this. So technical analysis really emphasizes the past, right? Technical analysis with the forecaster is what we're trying to do, is emphasize the future. We're really looking at complex statistics and probability analysis that are blended into simple, easy to understand probability clouds. Now, again, let's be very clear here. There's nothing that's perfect in this market. You're going to hear from 40 presenters, right? And not one of them has the perfect solution. And so what you're trying to do is just find something that might put the odds in your favor. And that's what we're doing here, what we're trying to do with the MetaStock forecaster. So look at these different events, and I'll show you these events once we get into the forecaster. But these instruments price data, it will actually, when we bring up any security inside of MetaStock in the forecaster, it will automatically scan all of these different indicators and provide event markers where those buy and sell events occur. And then we can click on those and we can actually draw, or it'll draw a cloud on your chart. So for an example on here, we're looking at Rio Tinto, okay? And what we're looking at is the moving average 50 cross down. And it's putting an event where the buy and sells would occur. Now, an upside down or regular triangle don't mean anything on the chart. It's just displaying it, and we can click on it and it will show you a cloud. And this is a projected probability map of where it's going into the future. We can look at 30 days, 60 days, or 30 days, 90 days, or 180 days. And there's so much information in there, and I'll show you more about this chart. Let's kind of talk a little bit about this, and then let's jump into the software here. So once you're inside of MetaStock, let's say you get super excited and you're like, I've got to try this forecaster out. What is it looking like? So you've downloaded MetaStock. You're going to come here to the Power Console, and we're going to click down here on the forecaster, right? And what we're going to do is, let's look at some different, things here. Let's look at Amazon, and how about we look at some currency, and how about we look at the E-mini, okay? So we're looking at everything, a stock, FOREX, and we'll be looking at the E-mini, okay? So I put those three symbols in here, and I click enter, and now what it'll do, it'll show you the forecaster with these three individual securities that are there. The first one that we're going to look at here is Amazon. And what we're seeing here is a chart of Amazon, the volumes below it, and you're seeing all of these little event markers on the chart, right? Now, down here, is our process recognizers. When Ken built this, he said, hey, I want to divide these up maybe into some different areas. One being highest profit potential. Next one being highest profit potential long only, highest profit potential short only, the most accurate current forecast, the most pronounced current breakout, the most distinct forecast cloud, most recent event, most events, or just a recognizer name if that's all you're looking for. So what we're going to be looking at is the most recent event, for example, on this one. So we click on that and we say, oh, so if we're looking at a chart, this chart is going to be showing you really kind of what's been happening over the last, I mean, man, you look at this back in March, January 2020 was our low there. And then it really climbed and made a lot of money. And then obviously, we come into 2022 and we have some ups and downs, very sideways market. And then in March, right, it starts dropping a little bit and it comes down. Hey, we're getting some momentum back into it. And then we're establishing new lows now. So what this one is populating, it says, okay, our most recent event is our 52 weekly low on Amazon, okay? Now, what we're looking at over here, right here is it'll show you all the different indicators or recognizers that we actually scan on, okay? And if you come up here to our recognizer library, it shows you all the different ones here as well. Now, you can come in here as well, and you can select those. You can enable them or not, but I have all of them selected. So we'll come back here to our Amazon chart. Right here is a statistical report. And this is going to really dive in for those individuals that like to tinker or look at things. This statistical report will show you that, hey, look, this event occurred 20 times between November 8th, 2017 and Monday, November 7th, 2022. The first event occurs on March 12th, 2020, and the last event occurs on November 7th, 2022. On average, the event occurs every 35 bars, with the recent frequency of the event appearing to increase rapidly. Obviously, that's the case because the markets are dropping. Recently, on average, there have been 9 events for every 100 price bars. Now, the shortest gap between events is 1 bar. The longest gap is 470 bars. This is where it really dives into the statistics. This is for that person out there that really wants to see what this is about. Statistically, 7 bars after the event occurs, and with a probability of 95%, the closing price appears to be about 5% higher, with a standard deviation of 0.0953. The statistical margin of error is approximately 22%. Now, what I find to be the most accurate when I'm looking at these different things is having a lot of event markers, because the more event markers that I have, the more that this cloud can lean on as it computes into the future. It has more data points, if that makes sense. If you have to have at least 5 event markers on a chart for it to create a cloud. So what we can do is we can come on here and say, okay, today, November 7th, 2022, here is the long-term view of Amazon in a cloud. We can look at a 30 bar. You can look at 90 bars, or you can look at 180 bars. So really 1 month, 3 month, or 6 month outlook. Now, for example, let's take this cloud right here. Now, here's our probability scale, and the darker it is, the less probability that it could go to there. Now, the brighter the color, the higher chance of probability that it could go there based on the 52 weekly low events and that data that has occurred historically as it builds that cloud into the future. So here it says, hey, look, based on the 52 weekly event in 26 to 30 bars, so about a month out, it feels like it's going to find its ground and stay there. Now, that doesn't mean that of course, there's a guarantee that it's going to go there. No, again, this is a probability. But look at this, how interesting. It says, you know, hey, it's kind of bright down here. And about 6 months from now, it could be as low as, you know, 70. It could be anywhere up there to the 80 mark. Well, the interesting part of this is this could help someone that really likes to trade options, right? If you could look into the future and see a range and you feel comfortable with that range and you could buy those options fairly cheap, this is something that would really benefit you. Okay, so let's come back out here and you can say, okay, well, you know, let's look at 30 days, right? And let's look at 30 days back here. These are static images and these do not change, okay? So exactly what was placed on May 11th, this event marker with this cloud, it's the same. And it's interesting, look at this one. These clouds are very unique. There's never anything that's going to be perfect, you know, on it, but look how it splits. It says, look, it has an opportunity to go up. Here's the range. And it went through that range. Whereas, you know, if you're trading this at, let's say, 102, 103, and you feel like, oh, hey, there's an opportunity, it could go up to 120. Wow, within 30 days, you could make some, you know, money on that type of options trade. Let's look at maybe 90 bars, what it did. Wow. So here's a great example of, look, in the short term, it really dialed it in, got it correct, but then it thought it was going to drop off here, you know, in that third month, whereas it actually went up and it went above that cloud. Again, an example of nothing's perfect and you're not going to find that. So what I find to match these pretty well is, one, you want a lot of data points. I like to look at things that maybe have, you know, 20 to 30 different times that it hits, you know, event markers in there. You could come in here and say, okay, this occur was 14 times. Here's 1, 7. Let's see if we can find one with a little bit more. It might be hard because this is a, let's see, right here, 11. Here's one with 24, right? So in this, this is saying for the next 30 bars, this is the MACD cross down. This is what it thinks, you know, based on those MACDs coming back. And as you can see, it's actually dropped down further. When you're basing these future clouds off of all these historic events, you got to remember over the last 5 years, Amazon for 4 of those 5 years, it looks like, has climbed pretty high. And so it has a hard time computing that on the downside, as you can see there. Let's take a look at the euro. I'm sure a lot of you in here, boy, this is the time to go back to Europe, man. Wow, look at that. All the way back in May of 2021, it was over $1.20, $1.20 US for €1. Got down all the way almost to 95 here, which is pretty amazing. We're going to look at let's come in here and do the most accurate current forecast. And how about we look at the CCI oversold? Again, I really like this one because look, 35 times this event marker has occurred. And we'll come in here and let's look at some of these historical clouds. So we come in here and wow, that matches up pretty good, doesn't it? You can come along, you can click on another one. That looks good for 30 days. How about we change it to 90 bars and we'll see how good it looks. Wow, that end cloud out there kind of came through. Let's do 180 bars. Remember, the brighter the cloud, the higher chance of probability. Okay. So not bad, kind of matches it with its down. But now what you're going to say out there, and I don't blame you, is let's look at it as during this downtrend, right? So as we come, oh, I didn't want to do that. Let's come back here and look at these downtrends. And let's select some of these events, right? And see what it looked like for 30 days. You know, back on this marker on November 25th, almost a year ago, you can see kind of how that progressed there. And we can kind of come in here and say, well, let's keep clicking on these. Okay. So it thought it would be a little bit higher there. Thought it'd be a little bit higher there. And then right here at the bottom, let's look at the last cloud. Wow. So it's really starting to dial it in with all of that, you know, data that we've looked at, 35 different data points. If you wanted to see what the euro looks like, you know, 180 bars out, you'd click it right here and it would draw that cloud out. So it's saying, hey, look, there's still an opportunity 100 days in the future where it might come back down to that 95 cents. Obviously, that the euro is based on so many different things. Obviously, with our aggressive interest rate hikes, that's helped the dollar become stronger. And so you see that right there. Now, this is the price volume and event marker tab right here. Some of you are going to be saying, well, what's the forecast cloud there? The forecast cloud is really cool. It's looking at past performance. And it's actually using 25 of the 35 most recent events there. Every time we get a new event, this cloud will actually change. And so it's very interactive, where these clouds right here will always remain the same. The clouds right here will actually change. And so you can kind of go back and forth and you can say, okay, how did that cloud look like 20 days ago? Well, it will show you right here with the price, volume, and event marker. Well, with this, as the market evolves and changes, this cloud will actually change too with the data that comes into it. So that's what we call the forecast cloud here. And back in our PowerPoint, as well, that was the probability map. Let's stay on this that we're looking at right there. So as we come around here and we're looking at different things and we kind of move that around, this had occurred 35 times. And again, the more data points, when you're basing things off of math and those things, the more data you have, the more accurate the potential could be for this probability. Okay, let's go to our next one. And here's the E-mini. And we're actually going to keep it on the highest profit potential there. And we're going to look again at the 52-week low. There were 27 of those that occurred. So we can come in here and we'll say, let's look at the E-mini. We're not too confident. We can look at the 52-week and you can see 30 days out. You can keep clicking on these clouds. Remember, the brighter the color, the more opportunity that chart, it will go through it, okay, into the future. Boy, there was a really great one right there. Let's go ahead and scroll up here. And as you look at the E-mini, wow, you know, over the last couple of weeks, October was such a strong month there. And we can see it. Well, did it catch that as well? Wow, that's pretty good cloud there, isn't it? That's a really good looking cloud. We can come in here and say, well, what's the 90 bar based on the 52 weekly low events? Wow, it still thinks there's potential for a run up, and 180 bars. So that's 6 months out there, right? It's actually even further than that. So there you go. That's what we're talking about when we're discussing these types of things. So let's say we're in here and you want to look at another security. How would you do that? We come here to open new analysis and we type in, let's look at oil. Hey, I know we're doing some really cool things here. We're looking at anything from stocks currency, futures, commodities. So here's oil as it comes up, okay? And here's a chart of oil. And we can come back here and look at most events. What we should do is pull up a chart of like Chevron and them recording the highest, some of the highest oil profits ever, if that doesn't make you a little bit upset. But anyway, let's go CCI overbought. And this happened 57 times on this chart, okay, where there was an entry or exit. And again, you can come back here and kind of look at it and test it and say, well, how did this look, you know, back here on this date, January 15th, about, you know, 13, 14 months ago, has a bright yellow mark there. Bright yellow is a very high probability that the future price will actually go through that. Okay, here's some more. Let's look at 90 bars. And we'll look at historically kind of how it performed. Okay, not bad there. And then let's come in here and we'll come here to our 30 bars. And let's look at, because a lot of you will say this, and I agree with you. Well, that's great. It looked good historical, but is this going to do anything for me into the future? And that's really what we're interested in, right? And that was one of the reasons we created this, that we patented, that we really wanted our users to have that capability. Wow, look at that 90 bars out. This is based on the CCI overbought for oil. And it still thinks it's got a run on it based on that. So it's saying, hey, look, today we're trading, you know, somewhere around 92 probably, or on this last bar, right? And potentially this could go up to 105. So if, again, you were an oil trader and you had this information and this was, you know, 66 bars into the future, and you could place trades cheaply on that, you know, that's something that you'd be, you know, excited about, right? Now, does that mean that it's going to go there? No. Again, there's nothing perfect. Out of the 40 speakers you hear this week, there's nobody that's going to introduce you to the perfect indicator or the perfect trading system. But what you're looking for is you want to just sway and put the odds in your favor. That's what you're after, okay? Another one that we're going to bring up here is, let's bring up Apple. I know a lot of people love to trade Apple. So we'll go ahead and jump here into Apple. And we're going to do some really cool things with this one. This is where you finally, I have you in the palm of my hand, and you're going to go, your mind's going to blow here, okay? This is where we're going to have some fun. So if we actually go in here and we come to our recognizer library, and we are going to draw a new pattern. So this is where we're going to come in here, and we are going to call this Jeff Gibby's awesome, wonderful, cool indicator. And what you can do is check this out. You can actually draw your pattern with your mouse. So if you wanted to do a head and shoulders, look at that. I know it's not the best, but you can manipulate these, make it, it almost looks like a rolling wave there. But you can come in here and do that, and then you can invert it, you can reverse it, you can save it, right? You can do all these cool things. And I'm going to come in here and say save, right? Oh, I can't put in a quote. So now it'll save. There we go. So that saves it. And now we're going to disable all of them. And we're going to come down here to Jeff Gibby's awesome, wonderful. He is not allowed to market or sell this. It is owned by me. I hope you understand that, Jeff. So we'll come in here and we will rescan the selected analysis, and we'll see if it gets any hits on Apple. And look at that. No, nothing occurs, right? And so there was 0 events that occurred in 5 years. Now, that's a really great thing. You're sitting there saying, well, I thought you were going to show me something cool. I am. This is something that is very specific, and it's got to hit the right things for it to go ahead and say that, you know, there's an event that occurred on this. Now, something else you can do inside here, and I think this is actually more vital and even cooler than drawing your own indicator. I don't know of any other software in the world that allows you to do that. Well, a lot of you will be trading, and you're going to be sitting there and you're going to say, hey, these 5 bars here are exactly what I want to look at. These are the 5 bars that will show me my perfect trade setup. So if you're inside here and you see that, and you can click on the user defined pattern select, we can come in here and say, okay, I want to look at, you know, let's go with these bars right here. And I want to see these bars that come up here, right here to the top. So maybe 6 or 7 bars where that open and close or higher each time. So it says here, do you want to capture the selected price formation as a user-defined pattern? I say yes, and it automatically draws the pattern for you and it creates all the formula language behind it. Well, we're going to name this one Kelly's. Stupendous. Amazing. MetaStock indicator. Oh, I know this is going to be amazing with a name like that, right? So you can also invert these, you can reverse these, and I'm going to click save. And I'm going to come down here and we're going to say, we are going to scan Kelly's Stupendous Amazing MetaStock indicator. No, Kelly, it's not Kelly's stupid indicator, it's stupendous. And we're going to rescan that selected analysis. And let's see what happens. Let's look at the chart of Apple. And it comes in and it says, hey, look, this happened 38 times. And you can come back here and start kind of clicking on these. And it'll tell you, like right here, greater than 95%, right here, 76%. It needs to be 75% match or above. But look at that, how cool that is. It shows you all the matches here. And then you can come in here and be like, well, what happened? Let's see. When we click on those, it'll then draw the specific indicators into the future. Wow, look at that one. That looks really, really good. We can come out here and we'll say, now this is where I bet we get caught a little bit on, because it dropped pretty hard. Let's see what it does here. See how it's a little bit above that? Historically, Apple's had such a great run that cloud there, you know, based on that, struggled a little bit, because it's basing all of its historical information on all of these patterns and what occurs after that. You know, whereas you can see something like that. You can come in here and go 180 bars. But this is me creating a custom indicator. Wow, look at this. How cool is that? So back here on November 14th, all that yellow. And look where that price movement was. And then it jumps up here and the cloud splits. It's got a tail. This is what I call the mermaid cloud. I just patent that. What do you think of that? And you can see that, hey, we want to follow the upside because there's more color there. I have a higher chance of probability there. So with that, it follows up there. And look at that, man. If you could trade options back on Apple's, 5-6 months earlier, that would have been a pretty cool thing to do. But again, there's nothing that's perfect. There's no cloud that's perfect. This is something that is included inside of MetaStock, this forecaster. We actually have the patent for this. And there's a few things that we've done in here. Let's jump back into our, here's a map overlaid on it on the old event. I don't want to, isn't there nothing more boring than going through a PowerPoint? So we're going to actually go through this, and we're going to do this. Let's go back in here. So there's a few things that I want you to remember from my presentation, okay? One thing is, inside of MetaStock, you can do anything from a stock, FOREX, commodity, future, and you can put it in the forecaster, and you can base it off of all these different sorted by recognizers right there, and it will show you all of these recognizer library right here, included in it, and it will actually create the events where those buy and sell opportunities would occur. You can click on those. You can click on them, and it will draw a map for you. Wow, here's another 180 bar that did pretty well. And it will draw the map for you, okay? You can sort them based on highest profit potential long and short onlys, most accurate current forecast, most pronounced current breakout, most distinct forecast cloud, recent events, most events, or recognizer name. We can also come in here, and remember, there's a forecast cloud. This is a static image right here, whereas this image right here, it will change every time you get a new bar, or not a new bar, but a new event marker, okay? You can come in here and you can create your own patterns. Remember, you can draw with your own mouse and name it. You can also come back to the chart, and you can use a user-defined select pattern and highlight the bars that you want. It will create the pattern for you, okay? And that pattern, what it will do is then you can scan that pattern on anything. So again, I can come up in here and say open new analysis. Let's say we want Microsoft. We click Start Forecaster, and we can come in here and we can scan it on Kelly's stupendous, amazing MetaStock indicator. You can come back here. These were charts or events that occurred back then. It'll show you the 90 bars there. You can bounce to a one in the future. You can come in here and look at what it would do there. Again, right there, here's a cloud that didn't identify and match up exactly with that price chart. I want to show you examples of both, some that do occur, some that don't occur. And that's the beauty. And this is a really fun tool to have, because this tool, you're going to play with it. You're going to get to know it better. You'll be doing back testing and things like that. And that works on the historics, what you're trying to see what occurred historically. This forecaster is a tool that comes with the base version of MetaStock, and you can play with it. You can do this on daily charts. You can do this on intraday charts. It is such a great tool to have. Let me pop back in here. So that kind of, and we'll kind of get into some questions and we'll go into those, but I want you guys to know that for 29 straight years, if you look at the technical analysis of Stocks and Commodities magazine, they asked their readers to select the best software out there. And in that version of $200 to $499, we've won it 29 straight years in a row. That's amazing. How much does it cost? MetaStock Real-Time, it's $265 a month. That includes your Zenith real-time market data and news. That does not include exchanges, but that will include the forecaster and everything that I just looked at. So if you're a real-time trader and you want to use this on just a month-to-month basis, it's only $265 a month. You can actually also purchase it a one time, and it's actually, cheaper if you do it that way. How much does it cost for our end of day subscription? This will include data link, end of day data and market data. It's only $69 a month. That'll include that forecaster as well. So you're getting all the tools inside of MetaStock, whether it's Quote Center, forecaster, there's so many tools, back testing, exploring, all of those things. And then, oh, are you kidding me? Jeff, you did not tell me that you were going to do this. But since you sent me this slide, I'll do it. We're going to give you a 3-month trial, a buy 1 month, get 2 free, includes MetaStock 18, the data region for your choice. It'll also include the white glove installation from support. Hey, you call our support team. They will get you installed and ready to go. It's the best support team you have ever called. In the 20 years I've been here, we have, anytime you call our support, we send out a questionnaire. And we have never had that below 90% approval, customer satisfaction approval. Here's the way you sign up. You can go to our sales chat. You can go to the web landing page at metastock.com/SBOT341, or you call us. Make it easy. Just call in. They're standing by. We have our sales rep here that are trained. We're based here in Salt Lake. Oh, you know what? I'm going to show you one more cool thing that you can do with this. If you go inside of MetaStock and you go to Explore, come down here to our Explorer, all of those indicators in there actually have, most of them will have the capability in here to show a forecaster, so let's come in here, scan. So let's go forecaster, 52-week low. We're going to scan the NASDAQ 100, and you can see how cool our Explorer is, and it will go through that here and scan that for us. This will bring back event markers that have a 52-week low as of today. Watch how cool this is. So it says Amazon. It shows you all these different stocks. I can highlight all of these, and then I'm going to save this list to a clipboard. So I click that, and I come in here into right here, forecaster, and I come in here and I click paste. It actually will now bring up all of those charts inside of the forecaster. So cool. And then I can come in here and I can say, hey, let's look at team.o. It was on the 52-week low. Oh, I only have it set for Kelly's super ones. So if you need to change that, you just come back in here to enable all, and then you come in here and we do that, and we select enable all. We rescan all analyses, and then that will go ahead and rescan all of those separate charts. And then if you come in here inside of, you can see the exploration right here. It's looking at all of those 6 stocks that occurred. Another really cool thing that we have in here, let's say you bring up a chart of, we'll just bring up any chart. We come up here with Microsoft. I click OK. And then I want to go to Forecaster. If I click that, it will open up the chart inside of Forecaster. Boom! That just happened. I know, you guys are, I just keep amazing you. But again, this is how you're going to get it. Hey, Jeff, are you there? Do we have any questions? I know we have 5 minutes left.
We do. And let's see. Let me go ahead. I just showed all the questions. I've answered them all. So we have a question about whether we'll get a link to record the presentation, and I can answer that one for you. The answer is yes. We'll send out. Well,
I don't know if my agent Jeff will allow you to do that. I mean, it's so expensive to have me on here, and the copyright laws, all those things. But anyway, I mean, if you're going to let people have it, go ahead.
Okay. Tom says the forecast club looks amazing.
Oh, awesome.
And other than that, we don't have a lot of questions. So
okay. So I'll just wrap it up. I know we just have a few minutes here. Get in on this. Get the trial. Try it out. For $69, you get 3 months of this. That's I mean, figure that out. You're looking at $23 a month on average. That includes all your data for the region. That includes the forecaster. That includes, you know, MetaStock as a whole right here, and Power Console, the Quote Center, the Explorer, backtesting, forecaster, and the options scope. For $23 a month, come on. If you do not have MetaStock, call in or text, chat in, or go to the landing page and get set up. I really appreciate being here with you. I appreciate you being here. I know you learned something here in this last hour because the forecaster is such a great piece of technology. Again, thank you to Jeff and Kelly for putting this conference on. I know everyone will get great value out of this. Yes, of course, this will be, you know, recorded. We have an amazing YouTube page, youtube.com/Metastock, that has all of the historical conferences we've done. But anyway, great job, Jeff and Kelly. Thanks so much for having me. Are you there, Jeff?
Yeah, I muted instead of unmuted. So
okay, I got a little nervous, like no one could hear me for the last hour.
Carl Westbrook says, "Hey, great job. I really like the look of the forecaster." So there you go.
That's awesome. Is that Tushar Chande? Are you kidding me?
Hey, Scott, are you kidding me? Your presentation there. My goodness.
Hey, Tushar, I want you to know that one of my favorite indicators of all time is the Stochastic Relative Strength Index.
Oh, cool.
And I have used you in hundreds of presentations. Your name, we have the Stochastic RSI built into the Expert Advisor.
I know.
And your name comes up every single time I bring up the expert commentary. And it is awesome to have you here. Guys, this is a legend. Tushar Chande is in the house. He is a legend. You guys are lucky.
Thank you, Scott. That was a tremendous introduction. I really enjoyed your talk. My goodness. I wish I had, an opportunity to attend more of your talks. It's been wonderful to hear. Absolutely fascinating.
Oh, well, I'll let you talk. I don't want to take your time, Tushar, but seriously, I will be listening to your presentation. Everyone, you are so lucky to have a legend like Tushar Chande here.
Oh, thank you, Scott. That's very nice.
Definitely. I remember Tushar, when we started talking initially, I was like, yeah, Stochastic RSI. I know who you are. So it's good to have you. Thank you again, Scott.
Okay. Thank you, buddy. I'll get off.
All right, no problem. All right, very cool. Let me go ahead and make me the presenter again real quick. And Tushar, I'm going to come right back to you. So we'll see you in just a second.
No problem.
Cool. All right. As Scott said, 29 years in a row, MetaStock has been rated #1 in its price category. It's like almost 3 decades. And if you get the opportunity, if you get stocks and commodities, make sure to vote for us again, because we'd really like those round numbers. So if we win it again this year, it'll be 30 years straight. So again, great software. As Scott talked about, we have 2 versions of the software. We have our real-time version, which is only $265 per month. That includes something we haven't really talked a lot about, but that's the Zenith real-time data package powered by Reuters News and Refinitiv Data, and that's a product they literally spent $1 billion developing. It has a couple hundred reporters in 2,000 different reporters in 200 different news bureaus globally. One of the best data and news providers on the planet. And they spent about $1 billion developing out a platform that we call MetaStock Zenith, and that's actually included. If you're interested in news and information and stuff like that, it's a literal competitor to Bloomberg that's included for such a low price. Also includes the forecaster we talked about, the ability to scan the markets, the expert advisor, all of the stuff that's been helping MetaStock be rated so highly for so many years. So that's only $265 per month. And we also have an end-of-day version that is $69 per month, and that'll include the MetaStock data link, the MetaStock the data link, all of the data that you need to run it, all the ability to scan, the forecasting, all the stuff that Scott talked about, all the stuff I've been talking about all day with the ability to scan and stuff like that. So that's only $69 per month. And as Scott told you, we're going to do a special offer on that today. If you do MetaStock, if you pay for a month, we're going to give you the second month and the third month for free. So, I mean, even with just the end of day version, that's basically $69 for 3 months of access. December, January, February, you'll be able to run it all the way to February 2023. But it's $23 a month to try the software that's been rated #1, to be able to run all of these great scans, to be able to do that forecasting. It's a good opportunity. So that's going to include MetaStock 18. We're going to give you the data for the markets you're interested in, whether that's America or Europe or Middle East or Africa or Asia Pacific. We cover over like 200-300 exchanges, 200-300 exchanges. So we're going to have the data that you're interested in, most likely. So we're going to include that. One of the things that we've been doing for the last several years, and it's been extremely popular, is a white glove support. And with that white glove support, we're going to actually have somebody call. They're going to help you. They're going to give you, they're going to help you make sure everything's installed, answer any questions you have, show you if you want, if your focus is in scanning the markets, I'll show you how to do that. So we call that our white glove installation support. We're also going to give you our Unleash the Power of MetaStock, which is a training, a home study course that you can go through. So you can get all of that, again, $23 a month. 800-882-3040. You can go to metastock.com/conf promo to do that. And you can go to metastock.com/sales chat. Michael asks, how much historical data do you get with MetaStock? So for, if you're looking at US, I'll try and kind of hit the high notes here. You're going to get data on futures back to the 73. For stocks, it's going to be 80s. This is on a daily format. Intraday, you usually get about a year of data. You want to, and then for international markets, I think it's about 10 years. So if you have questions, if that didn't cover that answer, metastock.com/sales chat, and they can say, well, what market are you interested in, and give you the exact number. So there you go. Thank you for the question too. Jack, apologies for the bad link. The link you'll want to use is metastock.com/conf promo. So there you go. Again, 800-882-3040, metastock.com/sales chat, or metastock.com/conf promo. So hope you enjoyed that. Thank you, Scott, again, for coming in. Do want to say thank you to Stocks and Commodities Magazine for sponsoring today's event. They do such a great job with us. I remember, oh geez, it was 10 years ago now or more, but I remember calling Stocks and Commodities and go, oh, here's an event we're going to put together. We're going to have all these speakers and it's going to be great. And they've supported and sponsored the event ever since we started it. And I really appreciate them. They're really great to work with. It's a great magazine. One of the things that I think you'll realize is important, because you're here today, is it's always important to kind of improve the education you have. You can always get better. And I think if you're not getting better, you're going to get worse. And I think having a really good magazine delivered to your doorstep every month is a good way to kind of make sure you're keeping that education curve going. So thank you, Stocks and Commodities, for sponsoring today's event. If you subscribe to MetaStock today, because it's a great platform, and try it out, they're going to give you 5 months for free. And if you spend $300 or more, they'll give you 2 years for free. So again, they've been great, though. We love working with them. We appreciate all the work that they've done. And I guess we'll get off of that a little bit. So again, the link for the trial is conf promo. All right. Our next guest, Tushar, I'm just going to turn you on. I remember when we started to talk to Tushar called me up. And he was like, hey, this is Tushar Chande. And I'm like, I know who you are. Every time I run a system test, your system, your stochastic RSI system that you built with Stanley Kroll is towards the top of that list. So this is one of the best system designers that's out there. He's got a lot of history. Very, very smart guy. We're happy to have you here, Tushar. I'm gonna go ahead and ask you how you're doing and turn the presentation over to you. So how are you doing?
I'm doing well. I've been enjoying the morning so far.
Good.
It's good.
It's going well.
It's good to be on and meet all your people. I'm so glad and welcome everybody. It's been awesome. I hope you're enjoying the presentation and more to go. So it's going to be a nice week. And thanks again for setting the conference up. I know it's a ton of work for you folks.
For sure. Well, I'm glad you could make it. I'm glad you're here. I can't see your presentation, but I don't know if you're sharing the right screen. I don't see the. There we go. All right.
Oh, okay, you got the screen now?
It looks great. I'm going to get out of your way. It's all you, man. Thanks for coming, Tushar.
All right, thank you for having me here. Good afternoon, everybody, I guess, on the East Coast, and good morning everywhere else. I hope you're enjoying the morning so far. My topic today is, so you want to buy near lows? Yes, there's a system for that. So this is almost a perfect year for a system like this because we've had these massive sell-offs and then strong rallies of different levels of support. So this is a kind of system that works beautifully in this kind of market environment. So I'm happy to get a chance to discuss it. And of course, the system is included in my toolkit for MetaStock, and you can get that by clicking on the link here. So I hope you'll enjoy the presentations. Let's get started. So a quick disclaimer, just to remind you that there's risk of loss in trading, and past performance is not necessarily indicative of future results. And one other disclaimer that if you get my package, you'll see that some of the templates in there do not exactly match what I will show you during the slides today. That's primarily because I wanted to keep it cleaner in the package, and I'm showing more detail here for explanatory purposes. So they're not an exact match. Okay, let's get started. So the outline of my talk is a sort of a comprehensive review of the swing system. So we will sort of give you a conceptual view of what's happening and intuitive understanding. So we'll look at the introduction wire charts, we'll look at the entry setup, we'll look at using the swing system expert and commentary that's available in the package so you can see what it would be like to actually use it. And then very interestingly, I'll show you that there's a candlestick connection. So it's not merely a set of random rules, but it actually also captures trader psychology, which is what makes it more powerful and useful. And then we'll show you how to use it with some scans. And I definitely want to spend some time talking about weaknesses because after all, it's a relatively simple mechanical set of rules and they don't always work perfectly in every circumstance. So it's good to know the weaknesses. And then we'll sort of unwind or wind up by looking at some examples and understanding exit speed. One of the big challenges in any system design is how to combine the speed of the entry with the speed of the exit so that they can work well together. And then we'll wind up. So let's start by looking at a bunch of charts. So a visual introduction, sort of a conceptual understanding of what we're trying to do and what it would take to succeed. So this is a chart. I've deliberately hidden some of the information. We don't really care what it is for now. So if I just come along over here, the market or instrument made a high, then retraced, then broke out here, and then we made a nice trend up. And now it's been consolidating, and we are at this red bar, which is just broken below this uptrend line. So now the question is, what's going to happen next? And just using conventional analysis, we could say that we have a well-defined downtrend line. It could come back down and retrace, maybe retest this breakout, or maybe get a little below and come down here perhaps. So the point here is that in real time, when you just see one bar, it's hard to be sure exactly whether that is a low or not. And that's the problem we're trying to grapple with. So this is the previous chart where I've put back the identifying information. It's the QQQ chart, or the tech index, if you will. And this is the red bar in the middle of the previous slide. And you see that the market actually went higher, formed a top, and of course, it's been slammed for the rest of the year. So you see the basic challenge we're trying to figure out. We're trying to see whether we could identify key lows and get an entry at or near these lows. And now we already recognize that it's hard to tell in real time whether a particular bar is the low or not. For example, this bar might be the low, but it went lower and so forth. So we're trying to understand, can we write rules that'll enable us to buy near critical market lows? So that's the problem. Now for any system, and particularly for the swing system, we have to be able to answer three questions, like where do I get in, where do I enter, where do I exit, because entries and exits run together, and finally, what is the trade size, like how much should I risk and how much quantity should I have in this particular position. So these three questions are what we have to answer, but that's the minimum. We have to go a little bit beyond that. So the particular problem for the swing system are are we going to design it based only on prices, or do we use something else? So for example, if you have an index like an S&P 500, you get lots of other information like advanced decline numbers in terms of stocks, or advanced decline volume, or the volatility measurements like the VIX index. But we want to design a system with no market-specific information. So for example, if you're trying to trade a commodity market like corn or soybeans, you get a lot of information about plantings and weather and commitment of traders and so on. But we are going to ignore all of that and make a design based only on prices, because we want a really robust and widely applicable system. Then the second challenge is, can we use this on any time frame? So for example, if you have an index and you have volume on daily data, can you really apply it on intraday data or monthly or quarterly data? So do the rules adjust automatically? That's an important design issue. And then there's also the question, are these rules designed for a specific type of instrument? Are they for stocks or bonds or futures, or can you use them across the board? And lastly, what are the failure modes? So when you think of a system, you have to sort of look beyond just the initial questions that we posed in the previous slide and think about how robust is this going to be? Like, how can you design a system that has wide applicability across time and instruments with the fewest possible assumptions? So that's the challenge we're trying to solve. So back to where we were, this is a QQQ. We'd like to enter in or near these circles. And in this chart, what I've done is I've superposed the swing system that's in the package, and I've put it on the QQQ chart. And I have highlighted the entries with these big green arrows because it's a little hard to see otherwise. So if you look at what we were trying to do, we definitely have been able to write some rules that gave us entries inside these circles or just outside these circles. And then we have also a few other signals elsewhere, but let's ignore that for a second. Just from a design point of view, the answer is yes, we can write some rules that'll get us near a key bottom without actually knowing whether that particular bottom is a key bottom or not, because that's the randomness of the markets. So now let's take a step forward and ask the question, okay, we found an entry point, but what is the condition or what are the circumstances for having a successful trade? So here I have put a new indicator in the upper panel. It's called the Chande trend meter, and it runs from a scale of 0 to 100. So if I come here, the scale is from 0 to 100. And what you can see here is that the market came down. This is the red bar that was in the center of the previous slide. And then we had a V-shaped bottom, and we had a strong follow through after the initial entry point, so that the trend meter was pushed above 90. So the way the trend meter is designed is that when you have a very strong uptrend, you get values above 90. And when you have a very strong downtrend, you get values below 10. So you see that the criteria of success was that we got an entry point here, and then the market rallied after our entry to the point where the trend meter had a sustained move above 90 and stayed there for some time. So we need a U or V-shaped bottom with a follow through to the upside. So this is a different time frame. We're talking of a futures contract, the S&P 500 continuous futures contract, and we are on a 30-minute time frame. So we have shrunk the time frame quite significantly. And this time we have the equivalent of a U-shaped bottom. So again, we had weakness, then we had a little consolidation, and then we had a move up, and then this is a U-shaped bottom. But again, here you see that even on the 30-minute time frame, the market rallied and pushed the trend meter above 90. So again, what I'm trying to communicate here is to explain what are the conditions that drive our success. So we need to come down, have weakness, we buy strength after weakness, and then we are assuming, or we want ideally, the market or the instrument to push higher so that the trend meter will be above 90 and will stay there for some time. And remember, in the previous slide, we had daily data, and this slide we have 30-minute chart. So it's sort of independent of the time frame. And then if you, I don't know if you can see this carefully, but we have an entry here and an entry there which didn't work. And you can see that correspondingly, the trend meter was also not above 90. It was, say, between, say, 50 and 80. So that's the goal of what we're trying to do. We're trying to find a situation where it'll come down and then rally hard off the entry. So these four charts together sort of give you a snapshot, an overview of what we're trying to do. We're trying to find entries in the circle. Then yes, we can find entries in the circle or near the circle. And then we're looking for U or a U-shaped or a V-shaped bottom. And then we want strong follow through. So in the upper panel, the trend meter will move above 90. So those are the sort of the combination of circumstances that'll give us the most probability of success. So that's an overview of what we're trying to do and how we can get there. Okay, so let's take a slight break now. Schematically, I want to show you what's happening to market momentum during the entry. Like, what is the entry setup we're looking for, or what should be happening in the market? Because we're trying to write rules that are very general and generic. So here, a slightly different chart. In the upper panel, I have something called the stochastic RSI, which we've heard about just a couple of minutes ago. So the stochastic RSI essentially is a combination of the stochastic concept and the RSI concept. And the stochastic is essentially a range location oscillator. And we're using the 7-day RSI value and a 7-day window to understand where is the RSI in the 7-day window. Is it near the bottom of the window or near the top of the window? So when it's at the bottom of the window, we get readings near 0. When it's at the top of the window, we get values near 1. So when the RSI is rising, we get values near 1. When the RSI is falling, we get values near 0. So this is again from Friday. So this is a very recent, this is the rally we had on Friday. This is a 5-minute chart. So we've shrunk our window even more. And you see, even on the 5-minute chart, we essentially have a U-shaped bottom. Then we have low values of the stochastic RSI. So we have weakness. Then we have strength. The stochastic RSI now is close to 1 or at 1. And we are buying strength after weakness. So we have weakness, RSI or stochastic RSI near 0. We have strength, stochastic RSI near 1. And then we are buying strength after weakness. So that's the entry setup. Now, we have to sort of remind ourselves that once we are in the trade, then the entry setup kind of goes away, and all we worry about is the trailing stop. So the entry process gets us in, but once we're in, the entry conditions or what's happening in the upper panel is not really relevant to the rest of the trade, and we're just going to follow or use our trailing stop to get us out of the trade once we're in. So that's gives you a sense for we're buying strength after weakness, and we're visualizing weakness using the stochastic RSI. So this is QQQ again, but this is a 30-minute chart. So we've expanded the time horizon. And again, we have the 7-period stochastic RSI in the upper panel, and of course, prices in the lower panel. And if you look at this particular trend here, you see you get exactly the same picture. We have low values of the stochastic RSI, then we have high value of the stochastic RSI. So we had weakness and we had strength. We're buying strength after weakness. Once we're in, we don't really care what happens here. We're just following with our trailing stop. If you look on the left-hand edge of the screen, we have a nice trade over here. Again, you see that it was preceded by weakness. We're getting stochastic RSI values at 0. And then we have strength, stochastic RSI near 1. And then once we're in, remember, we don't really care exactly what's happening up here. We're just using the trailing stop to get us out. And coincidentally, this gives me an opportunity to point out that if you look at this particular trade, it reversed after the initial entry and almost got us out. So it's very important to maintain stop discipline. And I'll refer to that again later on. So remember that once we're in, all we worry about is the trailing stop. And it's very important to maintain stop discipline. And of course, remember, this is a counter trend system. So one of the weaknesses of the system that we'll discuss again is that we could have a sequence of losing trades. So that's something to remember because we are pushing back against a declining market. This is the QQQ chart we had from the beginning. Again, a daily chart. This is the trade we've been talking about. And again, remember, the upper panel is the 7-day or the 7-period RSI. And again, you see that it works exactly the same way on a significantly longer time frame from versus 5 minutes, we have the same setup. We have weakness, low values of the stochastic RSI. We have weakness, low values of stochastic RSI. Then we have strength. We're buying strength, and then once we buy strength, we're just going to follow with our trailing stop and get knocked out. Same thing here, for example, we have weakness here, we're buying strength after weakness. So the formulation or the structure of the problem can be best understood by thinking of it in terms of the RSI values. When the market is weakening, that is, we're getting more situation where more daily declines, the RSI will drop and we'll get a low value on the stochastic RSI. When the trend picks up, we'll have more daily positive moves day after day. So the RSI will naturally tick up, and we're going to pick up the uptick in the RSI using the stochastic RSI. And then that tells you the strength after weakness. And then we are in. Once we're in, this goes away, and then we only focus on the exit stop to get us out. Okay. Now, hopefully you're getting a sense of what we're trying to do. We're trying to write very generic rules that we can use without worrying about what we're trading, what time frame we're trading, what exchange we are on. And when you start using it in real time as part of the package, you see that we have a commentary, and that'll help you. That's all you really need to sort of use the system in the package. So this is XLE, the energy sector spider. This is from last Friday, and in the upper panel we have the Chande trend meter. Again, the scale is from 0 to 100. When we have very strong uptrends, we'll get value above 90 or certainly above 80. And when we have very weak downtrends, or when you have strong downtrends, you'll get values below 20 or below 10. So here, the entry occurred a few weeks ago. We've been having this uptrend. Here's our trailing stop. So an important thing to remember is that you may not always catch the exact entry point. So for whatever reason, you may not have been focusing on the energy markets, and then it catches your attention, say, okay, so for example, you could run a scan and find that the energy markets are trending. So you might have decided to enter at this point. You can still use the system, because even though the entry occurred a few days ago, it still gives you a trailing stop. So you could say, for example, you decided to enter on this particular day, you could use a distance from the entry level to the exit level to size your trade, and then you'd be long, and then you could use this as a trailing stop. And you'd have some comfort that there's a good probability that this trend would continue, because the trend meter is above 90. So I just want to remind you that you can use the system even though you may not necessarily always get in on exactly the day of entry. So there's some flexibility in how you implement this. Okay. So if you push right click, it'll give you a menu. You can attach, you can do right click, expert advisor, and attach. And if you look through the drop down menu and you have the package, you see this TCCT swing system, and then you can attach that to the chart, and then you could do right click, expert advisor, and commentary to get a commentary. So let me show you what that looks like. So again, this is the this is the XLE chart. This is the trade I was focusing on the right hand side, and you see that if you do a right click, expert advisor, and commentary on, say, this red bar here, it gave you an entry level. So what this expert advisor will give you is it'll give you an entry level that's 2-4 decimals, which of course you can't necessarily use. But for example, you might have put an entry level at 72.8 to sort of round up to a nearby number, or even 73. So this gives you a specific entry point. So in terms of using the technology, you just need to attach the expert advisor and the commentary has a bunch of other things in it, but all you really need is the entry level and the exit level. And if you're before here, it'll give you an entry level, and that's a stop you need to focus your trading around. And then this is what the window looks like, because there's a lot of other verbiage here that you don't necessarily need to focus on. But now this is the same XLE trade. That's the day of entry. We're several weeks into the trade, and you see that now you get a trailing stop. So again, from a day-to-day basis, if you are physically in this trade, what will happen is that you can just attach the expert advisor or the commentary, and it'll tell you that the exit is 83.98. And if you look at, I've tried to sort of highlight that this is pretty close to 83.98. My calculation here is somewhat rounded. And obviously, for example, you'd have to put a stop maybe at 83.98 or 83.97 or 83.95 if you want to round things a little bit. So that just gives you a way to use the system by using the commentary. And even though the commentary has lots of other things, once you get used to it, you see that it'll just give you an exact number that you need to act on. And then, for example, here, you know how the stochastic RSI is working. So if it's above 0.8, it's strong. If it's below 0.2, it's very weak. Right now, it was at 0.48. So it's just showing you that the short-term trend is weakening. So this just gives you a little alert that, okay, I want to make sure that I put in my stop. And then this is just to remind you that you don't necessarily need to use or look at everything every day in terms of the entire commentary, but just the trailing stop is really all you need in terms of getting out of the position. So the way to use the package is to either for a particular for individual chart, you can just attach the commentary, and then it'll give you exact entry points and exit points, and you don't have to really worry about where do I get in, where do I get out. This is just another example with Starbucks, where I want to again highlight one particular thing. So on this red bar here, again we have an entry position of 86.78. So maybe you'd enter at 86.80 or 86.90 or even 87 if you like round numbers, and then you'd be good to go. Now the reason I want to point that out, highlight this particular one, this trade is, you see that this is the bar of entry. Again, you had a pullback for a couple of days after the day of entry, and our stop is just a hair below the market. So if you try to use discretion, it's very easy to convince yourself that, oh dear, I'm going to have a losing trade. It's going to run through my stop. But actually, what happened was that we had a strong move up on Friday. So it just highlights, as I've said once before, that whenever you're trading a system like this, because you're going against the market, it's very easy to imagine that you get a little ripple, you're in, now it's going to pull back because the downtrend is still pushing back on the market. So you have to maintain stop discipline in order to trade this system consistently and well and logically. And again, if you attach the commentary, it gives you an exact number for the trailing stop. So you don't have to worry about where you want to place your stop. Okay. So another way you can find trading opportunities in the package is we have included a scan. So there's a scan by the Chande trend meter. So for example, if you I'll show you that most of the trends are in the energy market right now, and energy has been rallying all year long. So for example, I did a scan of only the 121 stocks that are in the energy sector, and I ranked them by Chande trend meter. So for example, here right now, Dorian and say TPL, LPG and TPL have CTM values of 100. So that's telling you that these stocks are trending very strongly. So let's say you were trading something else. Now some money is opened up, and you want to think, okay, maybe I'll use the system on the energy sector, but you missed the day of entry. But that's all right. So for example, this is what so let's look at Dorian. So Dorian, this is the Dorian chart. The entry is down here, and then we have this very impressive move. The stop has been accelerating nicely, and now you're somewhere over here. So again, if you want to get in, you can still get in, like I said before, and you have a specific entry point, you have an exit point, you can size a trade, and you can use the model, even though you may not have actually entered on the day of entry. Similarly, what I want to sort of just to connect to the next step here, what I want to do is I want to zoom in on just these few days before, and what I want to show you that if you look at these three bars, the three bars before the day of entry, you see that the open and close for those three bars as a group are very close to each other. So I have drawn two horizontal lines. This is the open for the first of the 3-bar set, and that's the close of the 3-bar set. And that looks like what's called a doji. So if you look at this highlighted single bar here in yellow, you see that for this single bar, the open and the close were very close to each other. So that's the candlestick definition of a doji. And what the system has done is it has detected a 3-bar doji before it. So a reason I want to point this out is that it's easy to lose sight of what's happening to trader psychology, trader mentality, and just sort of write, system rules that are just coming out from some AI package or whatever, and you don't really know why those rules are doing what they are doing. And this will give you some insight into how the system is thinking about the market. So in the previous chart, you see there's a candlestick connection. So I wanted to spend some time just reinforcing this idea. So just by way of context, I know a very large money manager who has spent a lot of money on building an AI trading system. Well, it's so bad that they had to have another AI system on top of the AI to explain to them why the underlying AI is producing its trades. So, it's spewing out buy this, sell that, and no one really knows why it's doing that. So they need to have another explanatory AI to help humans understand what's happening. So that's why I thought it's worth spending some time on what is the candlestick connection underlying this whole system. So I don't know if maybe I'll just do a quick review of what a doji is. So I've highlighted the open to close range with the blue rectangles, and then the open and close are in different colors but close together. And you see that depending on where these open and close lie along the vertical body of the chart or the bar, they have different names. But the idea is simply that the open is approximately equal to the close. And you could have something like a dragonfly doji or a long leg doji just to help you remember what the pattern looks like. So in Japanese, apparently doji stands for blunder or mistake, oddly enough. The way I think about it is that open is approximately equal to close, but let's say that it is less than 20%. The distance between the open and the close is less than 20% of the total bar height, because you need to have some way of quantifying what you mean by open to close. And then it represents indecision, hesitation, equilibrium, and potentially a reversal. So the way people think about it is that we have some hesitation and some equilibrium in the market that's going to lead to a reversal. So sort of a pause in the trading, if you will. And Stephen Bigalow, who's sort of our big candlestick guru, sort of likes a setup. He likes to call it buy gap up after doji. So it's a rich tradition in the Japanese candlestick literature. I sort of just generalize it by one small bit by saying that just buy breakout after doji rather than necessarily a gap up. So it's a very popular concept. So let's look at EQT. In the upper panel, we again have the 7-day stochastic RSI, and we have weakness, like we talked about. Then we have strength. We're buying strength after weakness as the entry. So the entry is exactly as we have been talking about. There's weakness, stochastic RSI is near 0. We have strength, stochastic RSI is near 1. We're buying strength after weakness. And I want to look at these 1, 2, 3, 4, 5, 6 bars before the day of entry. And you see that the open here and the close there are very close together. So let's think of it more as a candlestick situation. So here I have converted that into a candlestick sort of layout. And what you see here is that this is a trade, that's the uptrend. So let's fill in a few doji patterns. So you see that I highlighted the dojis in yellow. They are very common. They occur all over the place. And if you just see a doji at the end of the bar, you don't really know what's going to happen next. So for example, here this occurred near a bottom. It sort of occurred near a top. So it's conventional wisdom to say that they occur near bottoms and tops. But sometimes it could happen in the middle of a trend, as I have shown over here. So let's focus on these 6 bars before. And what you see is that 1, 2, 3, 4, 5, 6, these basically are functioning as a long leg doji. And we are buying a gap up after doji. So the system, even though it has absolutely no knowledge of candlestick patterns or anything, is functioning like a trader would after it's coming out of a doji. However, it's a deconstructed doji or a distributed doji because it doesn't necessarily fall neatly where you can see it easily on a daily chart or a weekly chart. It could be distributed or broken over the time break so that it could occur over multiple bars. And then if I extend the idea, there are a couple more trades here. You see that there's like a 4 channel or 4 bar doji here, or a 3 bar doji there. So in effect, the system is responding to trader psychology by buying a breakout after a consolidation. So the rules are natural and connect to how traders think, and not just them being spewed out, by a, some sort of AI process. Here's end phase, another example. That's the point of entry. We got 1, 2, 3, 4, 5, a distributed long leg doji with a little hesitation, and we have entry after a doji pattern. Here's Merck, very recent from last Friday. So we have like a 7-day distributed pattern or distributed doji. Again, we're buying a breakout after doji. And then a couple more examples. Fibrogen with a 10-day doji, we can keep going ad infinitum. Apple, so it's not limited to obscure stocks. Again, weakness, strength. We have the stochastic RSI in the upper panel, and we have a 5-day doji, and this is a rally in the summer, went beautifully through July and August. So the swing system is functioning like a distributed doji, though I can assure you that there's really no information about any candlestick information or patterns in the rules. It captures the distributed doji, deconstructed doji idea. So ultimately, it's reflecting trader psychology, and that's what makes it so powerful. So you're not working in a vacuum and saying, why is it giving me those entries? All right. So having sort of visited what does it look like, what's the philosophy, what makes it successful, the connection to the sort of candlestick area, let's look at a little more specifically about how the system is being built. So again, this is a chart. We started off at the very beginning. Here's the red bar, what's it gonna do next? So we're doing what's called bottom fishing. So the exact low is difficult to pinpoint in real time. I mean, we want to do it thousands of times. So we're almost never going to be right each and every time. We want to buy near the bottom. So the closer we can get to the bottom, the better, or the critical low, the better. And then the main question is, can we do this systematically? Like, we don't want to sit over there and look at a chart and say, oh my God, is it going to go up or down or whatever? We just don't have time for that. And then, of course, the 3 questions are, where do I enter, where do I exit, and what's the trade size? Okay, so this sort of helps you visualize how the rules are written. This is Cintas Corporation. The upper panel is the Chande trend meter from 0 to 100. You see that it's above 80 in this case, but we have the follow through we need. There's a signal line, sort of a green line. There's a signal line, and we have a red line, which is sort of an exit line. And if you look at this double-sided arrow here in yellow, it tells you that I can write lots and lots of different rules on how far the signal line has to be above the exit line. So imagine you can write 1 million different rules, and then you need a trigger. You need to say, okay, if this happens, I'm going to start thinking about a trade. That's called a trigger. So we have a signal line or trigger line. And then you see that there's a smaller double-sided arrow that says, okay, suppose this is the bar on which you have triggered. Now I have to buy tomorrow, but at what stop or what level should I buy tomorrow? So the red line sort of tells you that I want to be above the high of the trigger bar, but it doesn't have to be. You could buy really above, really below, at the open, at the close, a little bit below the high. So again, infinitely many ways to write the rules. But more importantly, as soon as you think of it this way, where do I enter? I enter somewhere in the vicinity of the red line. Where do I exit? I have a clear exit stop. And what's the trade size? The trade size is the difference between the entry level and the exit level converted to quantity through your risk. So let's just quantify that. The entry is strength after weakness. The trailing stop is what I just call the delayed channel. But the trade sizing is about 2%. So I want to highlight the fact that we want to have relatively low risk in these positions. So we're talking about 0.5%, 1%, 2%, something small, so that even if the trade goes against you, it's not going to have a huge impact on your overall profitability. So relatively low risk, maybe 0.5% or 1%. I've said less than 2, but even 2 might be high for some people. And the way we size the trade is, we know the entry point, we know the exit point, and we know the risk, because we know the dollar risk, because it's X% of our equity. So then the quantity is Z divided by X minus Y. And of course, this is for stocks and ETFs. Potentially, if you are trading futures or any other instrument, you can add some conversion factors to make the math work out. So the sizing is very simple. The closer you are to the exit, the closer you can get to the reversal point, the larger the position you put on for whatever risk you have assigned to the problem. Okay, so let's sort of summarize all the discussion we'll be having so far in terms of how the system is designed, right? First of all, there's no optimization. This is a very, very important concept. Did I ever say anything about we optimizing this or that? No, there's no optimization. So the same parameters, exactly the same parameters, are being used for all instruments on any exchange, on any time frame, and on any type of market condition. So it's the most generic and powerful system you can write when there's no optimization, because who knows what the optimum will be, 5 months from now, 5 weeks from now, 5 years from now. So the fact that there's no optimization makes this system extremely powerful. And it's because there's no optimization, I have universal application. I can apply it on any exchange, on any instrument, on any time frame. So that's the beauty of this approach, that it's very, very robust. The entries are clearly counter trend in philosophy. We want to buy weakness, but we have combined that with a trend following exit. So we have trend following top scholar, take our profit slowly, cut off losses at once. And lastly, this adapts automatically to the market. Whatever the market's volatility, etc., is for that moment, the system will adapt to it. So this is sort of a summary slide that shows you that this is a very, very robust system. And remember, it also captures trading philosophy or the candlestick connection. So as a design process, it's really extremely robust. So that transcends, just any sort of optimization that you can do for it. Okay. Let's look at how you can find trading opportunities. So you can do that with a system scan. The way the package comes with a swing system delayed stop scan. So it shows you which instruments have given you a signal or about to give you a signal. So it won't show you something that gave a signal a month ago, but it'll just show you what's happening at the moment. So I scanned the energy markets and it gave me EQT as a potential symbol. So here's a chart of EQT. This is the signal that we had a few days ago. And then, again, we have an entry, we have a trigger line, we have an event, a trigger event, and we're buying beyond the trigger event. The upper panel, of course, is the 7-period stochastic RSI. We have weakness, we have strength. We're buying strength after weakness. There's another way we can scan it. So we've focused entirely on strength after weakness. I can also ask the question, show me everything. I can use the 7-day or the 7-period stochastic RSI and show me something where the lowest 10-day lowest value of the stochastic RSI below 0.2 and the current value is below 0.8. So there was weakness, there's strength. Show me everything that had a strength after weakness. So that's another way to look for trading opportunities. So here, what I want to show you was I've scanned the major sectors in the S&P 500 and I ranked them by the Chande trend meter. So if you look at the top of the list, these are the sectors with the stocks having the most trend strength. Conversely, you can look at the bottom of the list and say that these stocks have been beaten down. And let's say we get a post-election rally or whatever, you might get a bounce, so you might find some opportunities there. So you can either look at the top of the list or the bottom of this list. But I just happen to look at the top of the list with 121 markets. And I asked the question, show me the stocks where the current value of the 7-day stochastic RSI is 1 or above 0.8, but the 10-day low is 0. So there was weakness, there was strength, I can get in. So this is a chart of Antero Resources. This is the first one alphabetically on the list. You see that the entry occurred quite a while ago. The upper panel, of course, is the stochastic RSI, and the red dots are the trailing stop. So you see that there was weakness before entry, then we have strength. So we bought strength after weakness, we have entry, exactly the same as before. Now, as the trade evolved, I told you that ordinarily we'll ignore everything happening above. We'll just look at the trailing stop. But let's say you want to enter this market because you didn't get in here. Now you have another weakness and strength. So you had a little pullback. You could have entered with this trailing stop because you encounter trend. Or again, we had a pullback and strength again. So you could buy, say, above this high or above today's high or Friday's high and use that as a trailing stop. So again, this is another way to scan for symbols or instruments that have had a 10-day value of stochastic RSI near 0 and the current value is above 0.8. So we had weakness, we had strength. Let's get into the trade and follow along with the trailing stop. This is APA, which was the second item on the list alphabetically. Again, the entry was quite a while ago. But again, you can see that we've had these waves in the market, a little consolidation and roll up, consolidation and move up. So again, you can follow along and enter, say you want to buy strength after weakness, you could enter here or you could enter here. So this is another way of using the same system and the fabulous scanning logic in MetaStock to find trading opportunities. Okay, so I mentioned the weaknesses of the system before, but let's highlight them because I want to be very sure you understand that this is mechanical rules. They're very easy to find examples, but they fail or fail repeatedly. So this is an example of Abbott, and the particular risk I want to highlight is what's called gap risk. So if you just look at the chart, we had this beautiful trade here that worked beautifully. We had some nice trades here that worked well. But in this particular instance, let's say that the entry signal was here. So let's say you bought Abbott and you had put your stop here. What happened was that whatever news environment was pushed the stock. So it opened below your risk here. So this was the exit stop, let's say, or slightly below, but it opened well below. So one of the reasons that I've recommended we have relatively low risk exposure to this trade is this idea of a gap risk. That is, even though you have a stop in the market could open below the stop, significantly below the stop, because of whatever happens in the news environment. So that's certainly a major risk with this strategy because the market is in a downtrend and we're pushing against the downtrend. This is an example of Verizon, and this is another failure mode that I alluded to before, that you could have a long string of losing trades. So again, we are going counter trend, we're pushing against the downtrend, but the downtrend doesn't, has not weakened yet. So this is an example of a stock that's just dribbling down slowly. So it comes back down, gives us a signal, knocks us out, again, bubbles up a little bit, gets us in, knocks us out, and so on. So that's something to be aware of. It's a significant weakness of the system that you could have a string of losing trades because we are pushing against the downtrend, and the downtrend continues to reassert itself. So a good rule of thumb I use is that if I get, say, 3 consecutive losing trades, I just stop trading that particular instrument or stock or whatever, and say that I have plenty of other opportunities. I'll come back to it at some later point. So 2 major failure modes. You have gap risk, and you have a string of losing trades. And of course, you have other risks as well, but these are the 2 that I particularly want to highlight. Okay, so one of the things to remember is that you can use it on any time period. So let's just walk our way through a couple of time periods, because that's another very powerful feature of the system, that you can use it to confirm market bottoms, if nothing else. So let's think about it this way. So this is QQQ again. This is monthly data. So a very, very long time frame. Covers a very long period from, say, 2003 to now, so about a 10-year period. And you see that if I just look at the middle of the center of the chart, in the upper panel, we have what's now the 7-month stochastic RSI. We have exactly the same setup. We have weakness, values near 0, then we have strength, values near 1. We are buying strength after weakness. So the way the model works has not changed at all. And you see that, for example, you can follow along and get some participate in very long trends very easily. And I'll just point out here, this is a great COVID sell-off. So if nothing else, you could use it to confirm that the market has indeed made a bottom by checking to see whether you have an entry signal on the system. So you don't have to take anybody else's opinion on whether this is a bottom or not. All you have to do is run the system and choose the particular time frame that makes sense to you. And you can use this if you get a signal, which means that the system has detected a bottom. So this is monthly data. Now this is weekly data. So again, exactly the same setup. We have the 7-week stochastic RSI. So if you look at this period here, we have weakness, values near 0. We have strength, values near 1. We're buying strength after weakness. Once we buy that, then we just keep going and following the trend. And you see that the trailing stop has worked pretty well. And again, here we have a couple of losing trades in a row because it's going counter trend. So if you look at the current situation, the Fed is doing its thing. They said we're going to be higher for longer. We'll keep raising rates till the inflation comes down, et cetera, et cetera. 10,000 different opinions on whether the market has bottomed. You don't really care. You can just look at weekly data and see whether this will give you a signal. eventually the market will bottom and the system will give you a signal. And you can use it as a way to confirm that there's a bottom. This is QQQ on a daily data, exactly the same setup. So if you look at this trade in the middle, we had weakness, we have strength after weakness, we're buying strength after weakness. Same thing here, we have weakness, low values, high values, we are buying after we have some high values. So the system works exactly the same way as you expand or shrink the underlying time period. So that makes it a real luxury to be able to use the system without worrying about what chart or what instrument you're applying it to. And you can, as you apply the system, you will get a little sense for how it works, and you'll have your own confidence in using the logic. Now, not everybody trades just stocks and bonds. People are trading all sorts of instruments on all types of exchanges. So I just want to give you a couple of examples. This is a 5-minute chart on NASDAQ futures. Lots of chop, but you see there's weakness, strength, and then you could have some losing trades where the market is going on a narrow range. So it works on a variety of instruments. This is a futures contract. This is an FX rate. This is the dollar-yen rate. Like, you had some beautiful moves here as the dollar is going higher. Again, we have strength, then we have follow through. This is the Chande trend meter in the upper panel. You remember that during strong trends, we have the trend meter above 90. This is a dashed green line here. So you see that during this beautiful move up, this was, the trend meter was above 90, so confirming there's a trend, and you could have participated in it. So this is an example of an FX or sort of a foreign currency market. This is a Apple but hourly chart. Again, you can see that you can use it on a tech stock, which is very tied into the market. So it really reflects the actions of big traders. So you can see that. Now this one, a little cautious about putting it in. So what I want to show you, this is a leveraged ETF. It's the SOXS 3X Bear ETF. So extremely volatile. I really do not recommend it to trade it unless you're willing to tolerate a lot of volatility. So this is not an instrument for everyone, but I just want to put it in here as a counter example just to show you that even something that's extremely volatile and really, really choppy can still be traded by the system, i.e. the system is able to absorb the volatility and give you decent opportunities and give you a way to understand what's happening. The last sort of technical issue I'll go into is system speed. So again, this is a 10-minute chart. The red dots are the exits. We're buying a weakness. We're buying near lows. The market has expanded and given a CTM above 80. So I said, okay, great. And you see there's a follow through. And then this is again in the summer, every time we get a breakout, CTM above 90. So this is, I want to give you a sense for the speed of the exits. So this is the same chart as before, but now I have these blue dots, which is the parabolic exit or the parabolic stop and reverse system on top of the red dots, which are my delayed channel exit. And if you look at this particular move up here, you see that the parabolic moves dramatically faster, but the my exit is not lagging it by too much. So if you look at this chart here, this portion here, the parabolic really accelerated, but so did the trailing stop. So this is big. I don't want to give you the misconception, just because I've put in this rather benign title of delayed channel exit, that it's moving very, very slowly. It's not. It's moving quite aggressively, but maybe not as aggressively as the parabolic blue dots. This is, again, a futures contract, but 60-minute chart. And you see that if you look at this move here, you see that the parabolic in blue dots would have given you multiple entries and exits, whereas the red dots give you only one entry and one exit. So the speed of the exit is actually quite substantial, even though it may not appear that way. And I'm showing the blue dots of the parabolic just to give you a sense for how does my exit strategy compare to something that's known to be extremely rapid. So for example, if you look at this move up here, the blue dots actually moved almost too rapidly for this trade. And the red dots, which is my exit, give you a more gentle and simpler way to follow the choppy uptrend than the really rapidly accelerating parabolic exit. So another way to visualize the exit is to use a slower parabolic. So I just fiddle with the parameters. So now you can see that the parabolic is moving quite a bit more slowly. So if you look at it here, you see it was moving very rapidly. You hit it here, then come back and hit it there. Now you see it's moving a little more gradually. But you see that the red dots are not trailing too far back, and you got an exit not too far from where the parabolic would have gotten out. Same thing here. You see that the parabolic is moving quite a bit more slowly and give you an exit not too far from where my trailing exit is. So one of the big challenges for any system design is how do you combine speed of entry with the speed of exits? And if the speeds are mismatched, you get weird results. And here you can see that even though the system scales across different time periods, I showed you monthly data, daily data, intraday data, the system is able to adapt and absorb volatility and give you a very decent and elegant speed of exit as well. Okay, so let's wrap up. Thank you so much for all your patience. Here's the summary slide. We're buying near the bottom. Again, this is the EQT chart. We have the stochastic RSI on top. We're buying, there's weakness. We're buying strength after weakness. It gives you a specific entry point. I showed you the commentary. It gives you buy at this stop. There's a specific trailing stop. Again, the commentary gives you exit at this stop. So very easy to apply. We use the same rules on everything. This is a very, very important feature, that there's no market-specific information. We've not tweaked it or optimized it for trading a particular type of futures contract or equity contract or commodity or anything like that. The same rules on everything. I've shown you there's a candlestick connection, so it relates to trader psychology. It's not just some arbitrary rules spewed by God knows what, and it's adaptive and powerful. That is, it can absorb a lot of volatility. It has a pretty slick exit strategy, and it keeps you in the direction of the move. And even if you miss the initial entry point, you can still get back in and use the exit strategy. Okay, I also have a blog, so I hope that some of you will sign up and follow along. I mostly talk about concepts and context of what's happening in the equity markets. So, for example, current topics are things like the news conference last week by Chairman Powell, and then I have some proprietary indicators that I also discuss in terms of trend following or counter trend, and just a chance to exchange some ideas. I also have some introductory videos that my friends wanted me to make, so you can check those out for fun of it. The package itself, I hope you'll enjoy using the package and you'll consider buying it. It's easy to understand, it's simple to use, and it's very, very powerful. It addresses two main questions. Is something trending? So find me the trending markets. So that's the Chande trend meter. Very strong uptrends, value above 90, very strong downtrends, value below 10. And then trend following systems. This is sort of an overview. The trend meter is a multi-time period, multi-indicator combo that solves the problem of how do you measure trend strength. There's a long-term system with a trend following entry and a trend following exit. So for those of you who say that, hey, I'm not a short-term trader, I want to hold for the long term, this is a very good model. And then we talked about the swing system on the right-hand side here. There's also a volatility system. So there's a counter trend entry and a trend following exit. So I hope you will buy the toolkit. You can access it using the link below. It's really very easy to use. It's simple to apply. It's very powerful. It's very clear. There's no ambiguity. Get in here, get out there. You can use it on any time frame, from intraday all the way out to, say, quarterly data. And you can use it on any exchange or instrument. So you're not limited to a particular type of instrument. So that's it. If you have any questions, I can answer those. It's back to you.
Right. I have a question about the trailing stops, and if you could speak to the basis of the trailing stops.
Okay. So the trailing stop is essentially a delayed price channel. So it's a price channel with a little bit of delay. So that it's a relatively short-term price channel. So it's like a lowest low of X days delayed by Y days. So it gives you so it's a trailing stop. It's based on the lowest low of the last X days, but there's a little delay in it, so we get a little lag, and the lag actually makes a difference because it gives you that unusual behavior that I pointed out towards the end of the talk.
Awesome. And then I have one more question for you. This is a very important question. Can you give me a number between 1 and 9,419?
How about 3140, because that would be like 10 pi.
3140. Okay, let me look at that real quick. 3140. You helped us pick out our prize winner, Anthony J. And I'll tell him what he wins in just a minute. Thank you, Tushar.
Well, thank you very much. Have a great day. Enjoy, everybody. Bye-bye.
Thank you. Bye. Okay. Go ahead and kind of take over real quick here. Okay. And then this. And then this. Tushar does do a really good job. Some of the questions we had, obviously this is a very, very good add-on. It includes the three systems that he was talking about, which is the long-term system, the swing system, and the volatility breakout system. So the long-term system is trend following. It uses high levels of smoothing. It buys strength. It's designed for patient position traders and has a wider stop that is included as part of the package. You've got the swing system that buys strength after weakness. It uses tighter stops and it looks for follow through after breakouts. And then you've got the volatility breakout system, which I really like the way that he does this. You're looking for a one-day breakout using average true range. With this, you have a bit of a high risk of reversal, but it does use a pretty tight trailing stop as well. So all three of those particular systems include scans. So you can go in and scan with MetaStock and find exactly what they are. They include the expert advisor with the stop losses, the commentary that's so helpful in terms of helping you identify everything, and of course system tests. And it is a system that you would expect tests very, very well. And I say that because Tushar systems test really, really well when you back test them. So with this, normally this add-on is only $499. Here at the conference, we're going to do a special $399. We're of course going to back that with our 30-day money-back guarantee. You get instant access to the bootcamp training, a free trial of MetaStock if you need it, and $399. No risk guaranteed. Money back if you don't like it. So you can take advantage of that by calling 800-882-3040. You can go to metastock.com/sales-chat, or you can go to metastock.com/conf-promo. Those are the ways that you can take advantage of that. So Tushar, we really, really appreciate that. Now, I promised we would do a giveaway to Anthony J. Anthony, you are the proud new owner of this Around the Horn book by Adrian Mantz. This is a book that it's actually kind of hard to get a hold of these days, but it has a lot of visual patterns in it. It's a really, really good book. Hardcover. I'll drop you a note in terms of how you can claim that prize, but congratulations for winning. And I need to give away products a little bit better. We've only given away 2 gifts. I have this whole spreadsheet full. We're going to give away gifts every time from now on, I promise. If you're watching on YouTube, make sure to like and subscribe, but make sure to register so that you're on the drawing list to get it. You can go to metastock.com/traders-conference, register, fill out a little registration form, and that way you can win the next book or the next copy of MetaStock or the next valuable prize that we're going to give away. So there you go. Real quick shout out to CMT for helping us sponsor. Chartered Market Technicians has been an organization that has a huge reputation. They do risk management, quantitative systems development, portfolio management, and behavioral finance. Great reputation, great group of guys to work with. You can find out more about them at cmtassociation.org. And then in addition to that, of course, we're MetaStock. If you want to get a 3-for-1 trial where you buy a month and get the second and third month for free, metastock.com/conf-promo. You can do that. It's obviously a great software program. We love it. 29 years in a row, it's been rated #1 in its price category by the readers, not the editors, but the readers of Stocks and Commodities magazine. So metastock.com/conf-promo for that. So our next guest. Oh wait, we got a guest net coming up. Our next guest is Melissa Armo. Melissa has done quite a few of our sessions. She started talking about doing sessions with us. I think it was earlier this year, but I think it was like March, if I'm remembering that right. I love the kind of the gap strategy that she employs. You're going to like it too. Melissa, let's go ahead and bring you on here. How are you doing?
Great. Can you hear me, Jeff?
Yes, I know you had sent me a message saying that you're worried about your audio. It's coming through great. So
wonderful, great. And let me know how to share my screen here.
Yeah, I've just sent you the controls. So it should just say, hey, do you want to share your screen? And you just say yes. That's it. You got it.
Okay, great. Thanks so much for having me today. Beautiful day here in New York City, 70-some degrees, which is unusual considering we're about 3 weeks away from Thanksgiving. But it's nice to be here with you today. And obviously, this is an exciting week.
It's good to have you. And I will, I'm going to get out of your way. The floor is yours.
Thank you. So today we're going to talk about gaps and specifically trading the side of institutional money in gaps. And as I was saying, this is an exciting week. Why? It's an election week for the midterms here in the United States. For those of you that are U.S. citizens, we have elections tomorrow. So everyone is wondering what's going to happen tomorrow, or really Wednesday, when we see the outcome of the midterm election. So will the market react? Will it not react? Will it react positive? Will it react negative? We obviously saw the big sell-off, or you saw if you watched the market last week after the Fed announcement about the rate hike. And it really wasn't even the rate hike per se, because the Fed said they were going to raise rates 75 basis points last week. It wasn't so much that the market reacted negatively to. It was the fact that the Fed said that they are going to stay the course. So the course that they've been on all of 2022 is that they've been raising rates. And actually, they've been raising rates quite fast. Some of you may have been around long enough to remember when mortgage rates were 7% or even higher. And that's really where we are right now. And by the end of the calendar year, mortgage rates could even be 8%. And so the market is reacting negatively to that. And Apple was down today. We actually traded Apple today as a play of the day. And one of the reasons Apple was down today was because there's more lockdowns going on in China, COVID lockdowns in China, and obviously people are worried about a slowdown in production, and people are worried about layoffs if companies start to lay people off and how that could affect the economy. Everyone knows already we're in a period of inflation. So all of these things are great things to talk about. I talk about them when I appear on television. But actually, what I look at on a given day, any single given day, is the price side of things, the charts, like Jeff was talking about. I really just make decisions based on price. But it's not just based on price. It's based on the price of the gap. All of the events that I just discussed with you, though, affect or create gaps and make people buy or sell stocks or the market, the overall market, and then that creates momentum and movement. And obviously, that's what we want to play on as actual day traders. If you have questions as we go along today, you can email me at melissa@thestockswoosh.com. You can also call me at 929-3200-GAP if you have questions, or follow me on Twitter, Facebook, YouTube, or Skype. I do appear on national television. When I'm on TV, I try to put my hits and when I'm going to be on, so you can watch me on Twitter or Facebook. And again, this has been a very interesting year to discuss markets. So 2022, it's been a great year to trade if you've been on the right side of things. If you've been on the wrong side of things, you've had a terrible year. So there probably is people here split in half the camp, is my guess. When the year started out, we were bullish. Okay, we had a very bullish year in 2021. And then we started to fall off earlier in the year. And really, people continued to buy the dip at the beginning of the year, which they did in 2021. And that did not work this year. Now, I don't buy the dip. I've never done that. It does not consistently work to make money in the market. So the one thing is, if you want to make money in the market, you have to be able to consistently apply a set strategy that you can use in any market conditions that works all the time, or as many times as a setup occurs with a certain degree of profitability. Okay, it doesn't mean that sometimes buying the dip doesn't work. It did work in 2021. It actually worked the whole year of 2021 in the overall market, and I mean the QQQs of the SPY. But it's not working this year, okay? So again, the consistency is what is important if you're trading. Everyone has some losers, but the idea is to have more winners than losers. And if you've been buying the dip all year, you've just flat out, full on, nonstop been losing because it's just not working, okay? And again, we're getting into the end of 2022, and 2023 has a lot to come and in store as well. I put the stats for the whole year. These are the day trade stats. These are not options. I will talk about a couple options trades in here today for the entire year of 2022. It has been a great year. I'm mostly short. We are going to talk about shorting today. That's what I like to do. $605,054. This is year to date through today. Actually, we did Apple today. I'm going to go over that trade with an average risk of $2,800 per position. That is per risk per trade. These are positions on margin. Okay, so you would have to have a margin account to take these positions. And again, these were all gap trades. Some were longs, but most of these trades were shorts, okay, which is what we're going to talk about today. So if you're here and you've been thinking about doing this, whether you want to do it part-time or for extra money, or whether you want to do it full-time, I think at the end of the year is a good time to take stock for what you've accomplished this year, how much money you've made with your trading, or whether you've been considering trading all year but haven't been able to pull the plug, that you want to start to go into 2023 with some kind of goal setting for yourself. Where do you want to be 12 months from now? You know, maybe you're happy. Maybe you've had a great year, you know, for 2022. Maybe you want to do better, okay? This is the time to do it. You know, people do New Year's resolutions. I think it's a good idea with trading to have a plan of action. A lot of people work hard trying to become successful traders, and they just never get there. And actually, a lot of people work hard in general at their jobs, and they never get anywhere. It takes more than hard work, actually, to get ahead. It takes having the ability to see into the future and believe in yourself, and actually believe that you can make something of your life, that you can change your life. And part of that has to do with taking risks. Because if you're not willing to take risks, then trading is not for you. You must take risk in order to make money in the market. And if you're not happy with your current job, with the current income level that you're at, you have to be willing to take risks to make changes to get to the next place. And even though they may be scary, there's no other way to change the circumstances that you're in other than to take risks. It's not about risk for risk's sake. This isn't about not thinking it through. You can think things through, but a lot of people, I think, don't understand that you do have to take risks to better your life. And a lot of people just waste time really getting nowhere. Meanwhile, years and years of their life are going by. So I think it's important for people to understand that one individual can trade the market successfully as a career. You can do it. You can do it. You need a dependable method, okay? And in order to reap the rewards the market has to offer you, you really need a quality system. I found a lot of people, and I talk about this, I've been teaching people with the stock swoosh for 10 years now. I started my business in 2012. A lot of people trade, and they're trading basically blind. They're trading blind. They don't have a set system. They don't have a strategy. Some people don't even use charts to trade. Okay, they're trading based on a gut or a feeling, all right? The central structure to trading results has to be the strategy and a solid foundation that's based on accurately reading price action and advanced technical analysis. Now, earlier I was talking about the Fed. Last week, people were buying into the Fed announcement. That was a crazy thing to do. Why did they do that? They thought the Fed was going to say they were going to back off raising rates, but they didn't. And it was crazy that anyone went long into that. But people were going long since October 13th, actually, in the market. And specifically, the Friday before the Fed announcement. You have to look at price, because price will tell you actually what's happening right now. And it's you're making the prediction whether the price is going to go up or down, to go long or short, okay? But you have to have a reason for doing that, something that you're looking for. And again, that's the strategy part of it. So go into the end of 2022 with a positive and optimistic attitude about your financial goals for 2023. Be realistic, but you can set your sights on some pretty good goals 12 months from now. I don't think that's crazy. You can trade the market and you can be successful. I know people get down on themselves, but it's just you don't know what to do if you're not making money. And if you are making money, congrats. You know, it's not impossible to make money trading. And again, I'm talking about consistently. But again, one of the nice things about trading is you could do it from home. You could be anywhere in the world and do it. And it's really full-time pay for part-time hours. Now, I trade in the morning. We were done super duper quick in the morning in the trading Apple. We were in and out in a couple of minutes. It was literally not even a half an hour. We were done. That was it. That was the day. You don't have to sit and trade the entire time the market is open. And you also get evenings and weekends off, which is nice too, if you want to do this for a living. But it really is a dream job, because the only thing stopping you from making more money is actually the amount of risk per trade that you're putting on in the trade. So I have advanced trader risk, beginner trader risk. We're going to look at some examples today, but the fact is you have to set your risk based on your cash. But as you do well, as you grow your account, you can increase it, okay? You can increase your risk as you go along. And again, that's the positive thing that you have to look at. But again, if you're not making money in the market, you're probably not reading charts, trading blind, like I said, or you don't know how to read a chart. And if you don't know how to read a chart, you really shouldn't be trading at all, because this is extremely, extremely important, okay? And Jeff talks about this all the time. We could all pull up Apple, we could all put up the daily chart of Apple right now this second, and we could all get the same exact number, pretty much within a millisecond, all right? It's live electronic data that we're all seeing, and we can't disagree about that. So we see where it's trading, we see the price that it's trading, and we need to be able to make decisions before the move actually happens in the stock to get in the trade before it goes there. Again, that's how you're gonna make the money. But for me, it's all about one strategy. For me, my strategy is gaps. You actually, though, don't need a general overall broad-based view to make money. Tons of people have that, and they fail all the time. So it's really about focusing, for me, on the gap, but it's also focusing on institutional money. So I'm looking to read institutional money in the price patterns and gaps. And I really am telling you, you don't need to do anything else. Because if you see the stock is getting bought with institutional money, you can go long and it's going to lift it and you can make money going long. Or you could buy a call in an option, for example. If you're shorting a stock, okay, you're shorting it, you could buy a put. If the stock price drops, you'll make money. Or you can short it as a day trade, as a day trade where you're taking it on margin. Take 1,000 shares, short it at 20, get out at 19, you made $1. So how much would you make? $1,000, okay? That momentum would be what? To the downside. Institutional money, therefore, is selling the stock. It's pushing it down, okay? But all of this, like I said, involves taking risk, and nothing great in life comes without taking risk. And as soon as you start to accept that, actually, and almost embrace it, you know, and again, this isn't about taking risk for risk's sake. It's about taking calculated risk. That's what it's about. So think about where you want to be at the end of 2023, 12 months from now. Do you want to be at the same place you're at now, or do you want to be somewhere better? I always try to set higher and higher, bigger and bigger goals for myself year over year, whether it's for myself personally, whether it's for, you know, my trading, my options trading, my day trading. I always want to try to be improving. And I think that that's something that people somewhere along the line, again, miss out on, because they feel like they're constantly in the state of anxiety and struggle with trading in the market. You've got to try to find a way to make trading less stressful for yourself. And one of the ways that I did that is I only trade the morning. I'm quick in and out, done in the morning, and I'm done. So I don't sit there all day, trading. I found doing that, you give money back. So I just look at trading the first half hour of the day and I'm done. And I have found that is so much easier, okay? It's really about mastering a skill. That skill could be fast trades. It could be shorting, which we're going to talk about today. It could be predicting the moves of where the market's going to go next, for example. And it's really anything that you do, could be sports, anything. You want to master the skill. You master the skill set and you're going to be able to do well and you're going to be able to make money. So part of the thing that I'm looking for, again, because I'm in and out of these trades sometimes in minutes, is I want a big move. Large moves happen in gaps in the first half hour of the day. I happen to call my system called the golden gap because I'm looking for only one a day. And that's all you need is only one. So I call it golden gaps because it's like finding gold in the market because you only need one trade. Again, one trade a day. Also, guess what? It limits your losses. So you will have less losses if you're taking less trades, you see? And you can also then put more size on. So the golden gap is a rating system. We're looking at technical analysis. We're going to look at charts in a minute. It looks at 26 points of the daily chart of a stock. The rating system is a checklist. The checklist tells you what to look for in the price of the stock. The 26 points predict where the stock is going to go when it's gapping. So I'm not predicting the gap itself. I allow the gap to happen, and then I'm predicting where the stock is going to go, whether up or down, after I see the gap. It tells me where the money's flowing. The gap tells me that, okay? And why does this matter? Because that's how you're going to make money to profit. That's how you're going to make money, by knowing what direction. If someone said to you, and again, I'm just going back to, you know, before COVID, that COVID was even going to happen and the whole country was going to shut down. You could have shorted the market. You would have known the market was going to tank February into March of 2020. So knowing where something's going to go ahead of time is very valuable information, but you don't have insider information on any stocks or even what the Fed's going to say either. What you do have, though, like I said, is the charts and the live data. But getting back to what I was saying about the beginning part of the day, this is the most important part of the day. In the first 30 minutes of the day, stocks make about 80% of their move in the gap. You play that day, you're in and out, and you're done. You can play it as a day trade. You could play it as an option if you want, but typically when I'm doing options, I'm looking for much, much larger moves, meaning a big move that would go maybe for several consecutive days or a larger move into the close into 4 o'clock on that day I'm doing it. So the difference between me for doing options and day trades, I'm just looking for bigger targets in the options, okay? And big profits come in money moves. So the faster you can get it, the better it is. And again, it's not about quantity. It's not about doing a million things. It's about doing one thing. And again, that also limits your losses. It is about quality. It is not about quantity. So this is very, very important. So what am I looking for? I'm looking to find stocks to trade that are gapping, that have never won. A high probability of directional bias for the entire day, 2 big moves in the day, 3, early confirmation of my bias in the move between 9:30 and 10 a.m. Eastern time, and 4, precise entries with follow through and a good risk to reward. So again, risk to reward is important. Now, what do I consider a good risk to reward? Risking $1,000 and making 500, risking $1,000 and making 1,000, 50% or 100%. Those are good risk to rewards in my opinion. Now, we were just talking about Apple, so let's go over this here. So Apple we shorted today, and what did it do? It gapped down. So let's take a look at it. So this was Friday, November 4th. Again, this is a daily chart. So Friday we closed here, boom, gap down here, fell, got in, got out, done, boom. I'm going to show you the 1 minute in a second. Entry was 136.80, 1,800 shares is an advanced trader risk of 3,060. Exit was 135.68. We had a good exit on this. And the profit was $2,016. Now let's look at the 1 minute chart. Again, we're in and out quick, very, very quick, okay? So this was this morning. This is the 1 minute. See down here. Today is the 7th. We got in, got the drop, got out, done, boom. So see time of the day down in here? We were done by 10 a.m., 10 o'clock. See it? So again, Apple gapped. And actually this was down quite a lot. Early this morning was down even more. Okay. So that's it. You go about your day, do whatever you need to get done. I'm doing a webinar with all of you. You don't have to sit all day long. Now, I'm just going to show you the last week of trades here. Friday, we didn't do any trades. Why? Nothing met my criteria. You've got to wait for the trades that are good. Wait for the gaps that are good. Remember, high odds. Got to keep the odds high. So the whole idea of my rating system with the 26 points is I'm looking to find a gap that's going to rate 20 points or more. It doesn't have to have a perfect score, but I'm trying to get as high as a rating as I can. If it rates under 20, I don't do it. So there was a lot of gaps on Friday, but no quality, no quality. Actually, Friday we gapped up, failed, fell in the morning, and then reversed in the afternoon. Friday was a crazy day for the market. It was trying to find itself after the FOMC announcement on Wednesday, actually. So again, high odds. Trading is about odds. I put a stop in when I take a trade because I know that I could lose in that trade. Okay. So it's about the idea of keeping the odds high. You want to have more winners than losers. Now, we did this one here. This was the day before, Thursday, the 3rd, we shorted the QQQs. So again, this is a day trade. Entry was 262.20. Shares is 1,500. Risk is 31.50. Exit is $260.50. Profit was $2,550. This was on the 3rd, down in here. Right there, snug as a bug. What happened with this? Market closed here, gap down, fell. So again, this was a gap. And I ran it in the morning and said, this gap's going to fall. And it actually did. Okay. So let's look at the 1 minute. Again, this is a daily chart. Okay. That's where I'm seeing the gap here. There it is. This is the 1 minute. Again, having charts is so important. It's critical. Because if you don't have charts and you're not looking at charts and you're not reading charts correctly, you're trading blind if you're not looking at them at all. And if you don't know how to read them, you're confused. You might even think about going long the QQQs here. The play was not a long. The play was a short, okay? So again, it's about getting the fast move as quick as you can get it and getting out as quick as you can get it. So we did this in here, got the drop, boom, done. Again, boom, done. 10 a.m. out. First half hour of the day. See it? And again, if anyone has any questions, you can put it in the room there. I think I can see it. Let me just scroll down. Can everybody hear me?
We can hear you.
Okay, good. Okay, so that was a short that we did on Thursday in the QQQs. So let's go back to this. Then we had the SPY. The SPY was another short, okay? This was on Wednesday, actually, here. So this was a gap, closed here, gap down, rallied at first. First we rallied and then it fell. Now again, I did not hold this all day past the announcement, but again, we did this in the morning, got out quick. Entry in the short in the SPY, I'll show you the 1 minute in a minute. This is the daily. 383.50, shares was 1,500, risk was $2,700 a trade, exit was 382.30, profit $1,800. So again, when you're looking to trade, you have to say, I believe this is going up or I believe this is going down. You can't be wishy-washy about it. If you're wishy-washy back and forth, whether it's a long or a short, it's going to be very difficult for you to make money with any level of conviction. You can't have conviction something's going up and have conviction something's going down at the same time, okay? Anyways, here was the morning where we did the trade, where we shorted this buy and we got the drop and we got out here. But I just want to show you where this went then later in the day. Again, we were well out of this. But that was the Fed announcement. Here's where people were buying it. Here's the left. And then as he was talking, it started to sell off like a hotcake. See it? So again, this may not look like much, but actually it was profit. It was $1,800. So again, you just need just a piece of that move as quick as you can get it right in the morning, the first 30 minutes of the day. That's the whole point. So again, it's looking for large institutional money. That's why I'm trading gaps. They work very well and have big moves. Gaps are created with large institutional money. That is what makes the gap. The professional gaps that happen and play out in stocks are formed by one thing and one thing only: large institutional money. Therefore, you need a way that will help you pick the correct direction to play the gap and confirm that the large money will flow with it. Again, if you have institutional money, by institutional money, I mean what? I mean hedge funds. I mean big banks. They are selling positions and they are buying positions, okay? And actually, they sold Apple today. Apple was down this morning in the pre-market. Apple gapped down this morning, okay? So you're looking to trade with that money. It makes it so much easier then to make money. And then the faster you can get in and out. And again, if you're out by the morning, you don't have to worry about the wiggles and jiggles of other things that go on later in the day. Like, for example, FOMC announcements, if you're trading till 2 o'clock. But anyways, gaps are an event. They create a sense of urgency. The sense of urgency in a short is what? It's panic, 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 panic. So anyways, the event is what is happening. And therefore, an action is being forced by participants of the stock. People are forced to make a decision because the event is occurring, okay? This is why gap trading is incredibly powerful. It's incredibly powerful. And trading gaps is a powerful and profitable way to trade because you're trading on the side of power. You know, I would say in general, okay, retail traders may be able to enter a stock and temporarily move a stock for a short period of time, but they're not going to be able to take hold of it the way an institution will and drive the price up or drive the price down in one direction or another, strong, big. And again, I'm saying big, that means volume. That means big moves, okay? Here's another great example. This was Meta. We did this a bunch of times, actually. We've been day trading this. We've been doing puts in this as options. Stock closed here, gap down. Closed up here. This was back at the end of October. Opened down here on the 27th and gap down. It's been selling off ever since, okay? This was a really nice short move. It was a move to the downside. How did the stock price get up here at 130 and then be down here the next day under 100? Well, this was earnings for one thing, but really what happened is institutional money sold Meta. They sold it. Boom. Sold it. Sold their positions in it. And again, you can look at why or whatever you want to go over. But anyways, the stock price moved down. Okay. So in that case, again, you would want to look at doing something that would be a short or a put. Here's another example. Well, we've sort of talked about this, but this was the rally up here that we saw on the Fed, and then the gap taking hold of the live day when it sold off like a hotcake. Just a beautiful move, just a beautiful move down. And again, this was on November 2nd. That was Wednesday. Any questions here so far? Well, yeah, I don't have any indicators on this charts. So I'm not making trading decisions based on any indicators. Whoever's asking that. I'm making trading decisions based on the gap. Okay. If you find indicators helpful, that's fine. But that's not making the decision for me. The gap is. Okay. So anyway, go ahead.
I was going to say, we do have a question off of YouTube. Gosh, dang it. Zola wants to know, how do we find the gaps for new traders?
You can find gaps anywhere. In fact, Jeff, I'm sure that you have some kind of scanner, don't you?
Oh, yeah, definitely. That's an easy scan to find in MetaStock, for sure.
Jeff can help any of you guys and gals with that. Finding them is not hard. That is actually very easy, and Jeff can go over that with you when we're done, how to find them. There's thousands and thousands and thousands of stocks that gap it every day. The niche that I have and what should come to me if you wanted to learn is how to pick the one that's going to work in the direction that it's gapping. Because, for example, you cannot short every gap down. You cannot go long every gap up. You can't short every gap up, and you can't go long every gap down. That's very important. But finding them to rate them is something that Jeff can help you with, because there's thousands and thousands every single day. But it's about pinpointing the best one. And that is what you'd come and learn from me. The rating system itself tells me that Apple's the best one to do today. And Apple's going to work in the direction of the gap. In other words, Apple's gapping down and it's going to fall. Apple could have very well gapped down and rallied. We saw the market. It was on October 28th. The market gapped down and rallied, okay, on that day. In the QQQs and the SPY, it was October 28th. That gap down flipped. So there's easy ways to find gaps. Again, Jeff can help you with that. It's the idea of trying to pinpoint the best one to do and get the direction of it right, okay? But finding them is something Jeff can help you with his thing. I'm very aggressive when I trade, so I use the 1 minute. So all of these you've seen looking at here were the 1 minute chart. Remember, I'm in and out quick, but I'm analyzing the large time frame, which is the daily chart, to make the trend decision on directional bias for the gap. And again, you can't short every down gap. You can't go long every down gap. You can't go long every up gap. You can't short every up gap. If it was that easy, then the reality is that nobody would ever lose. There would be no thought process behind it. So it is the whole idea where we're trying to analyze it. And all large traders of every kind look at large time frames to make decisions, particularly institutional traders. And we're looking at the daily, like I said, and then I trade on the 1 minute. Now let's just take a look here at some options. This is the options newsletter. This is a newsletter service that I offer. The trades are emailed to you. This was done on Friday, October 7th. This was the 360 SPY puts. It expired on the 14th. Okay, so let's actually go look at the 360s. Wait, what day was that? The 7th. Here. So market closed here, gap down, rallied, dropped. Take it over, see where we were, around 371 and change. So I called the 360 puts. It expired the 14th. Boom, got the drop. Actually, here's the gap that I was talking to you about here, which flipped. So this closed here, gap down. This is a gap down that rallied. Anyways, this was a good call, though. You see where we fell into it. And you could have held this for longer. Cost was $5. Number of contracts was 15. Risk was 7,500. Sold at 11. Profit was $9,000. Return on investment 120%. Cost for the beginner trader risk was $5. 2 contracts. Risk was $1,000. Sold $11. Profit $1,200. So again, you can take 1 contract. 1, you could have paid $500 for it. 2, you could have paid $1,000 and still had a return on investment of 120%. You could have made more. Again, I did not hold this all the way down because I'm looking to get in and out, but I just want to show you where this went and take it over. This actually went all the way down in here, broke 350 within the period. So that was a nice call. That was the SPY. Let's look at another one here. This was Apple, and I had called this last week. Actually, you could still be in this, but this was a nice trade. You could still be in this trade, actually, which is crazy. I called the Apple 142 strikes, expires this Friday, the puts. Cost was $350, 20 contracts, risk was 7,000, sold at 8, profit was 9,000, return on investment 129%. Again, 3 contracts with 1,050, sold at 8, 1,350. This is taking the trade and getting out into the move, but you could still be in this because it really doesn't expire till Friday. Not that you should hold it till Friday, but we could fall off again this week. So again, I called this here on the 3rd, I think it was. Yeah, November 3rd, 7:40 a.m. Called it, closed here, gap down, got the drop, boom. But you could still be in this trade. This trade is still through the strike. For a beginner trader, you can open up an options account with $2,000. For a beginner trader, for a day trade account, you can open up a prop account. You should have at least minimum of 5,000 with a 10-to-1 margin. Retail accounts are going to need 25,000 to trade on 4-to-1 margin. And if you want to do options and open up a starter account, which is a cash account with $2,000, then I would set your risk accordingly, be in 1 trade at a time, and set your risk within those parameters. So, you know, if I call 3 options trades on one particular day, for example, with the market, then you're only going to do 1 or 2. You have to be careful if you have a small account. That's the difference. But it's all about having a trained eye. You're looking, you're focused. Like, I'm very focused. I pretty much decided I was doing Apple when I rolled out of bed. I saw it, I loved it, I rated it, but I didn't see anything else I liked better. And actually got a little bit, it was better earlier, actually, when I got up early, but I still liked it. It was still like a gap in the open, and it set up and we did it and we're out. But anyways, you know, when you do something, do something, do something, do something. I've been trading gas for 14 years. I taught myself my own system. I teach the class once a month, which trains my eye every single month. I teach it on top of doing it every day. And I've had the business for 10 years. My eye is, I could do this in my sleep, okay? The problem with traders is they are jump around so much and they never get good at anything. And they never train their eye to do something. And actually, if we have time here at the end, I don't know if we're going to go over. If we have time at the end, I'll tell you something I saw today in the market, which I didn't even think about. It's just my eye just saw it when I was running the room this morning. Again, traders never allow themselves this benefit of training their eye. And you're training your brain. That's what you're doing. You're training your brain to see something before it happens, because you're looking at it a certain way. but you have to learn what to look at. And that's the advantage of coming to me and taking a class. But traders will do futures and Bitcoin, and they will do stocks, and they will do a million different things and a million different strategies, and they'll have a million different indicators and Fibonacci's, and they will never train their eye and their brain to stick on one thing. And that's all that I do. And even though I do options, I'm doing them based on the gap. So it's really the same thing. It's the same exact thing. Doing a SPY put or SPY short, it's the same thing, okay? But being successful in the market takes detail and a certain level of precision. Detail matters. It can make a difference in making you a lot of money. It can make a difference in winning or losing. It can make a difference of having a huge week or a huge month, okay? It's about quality and accuracy. And again, you still have to have correct size, proper exit, good risk to reward. These are all basic things that everybody knows. Discipline, all the stuff that you hear probably, and that you will hear from everyone all week. Those are givens. That's the ABCs. Risk the same amount in every trade, use stops, don't blow up your account in one day. All these things are the ABCs. But it's about narrowing it down on the precision and the detail, because you really don't have to trade all day. And without a good strategy, you're never going to make any money with the market. And I think that's where people get frustrated too when they do jump around. But you've got to stick with one thing. And that's where you have to have the focus. So how much money do you need to do this? Again, margin or buying power is something that comes from the broker. So you can open up a prop account with 5,000 or less at some places. A retail account, you're going to need 25,000 for margin. You can trade options with a cash account anywhere that allow you to trade options. You buy puts, we're buying puts and selling them, and buying calls and selling them, okay? If you want to take my class, you can sign up for the class, learn the system. Then you open up a trading account. And again, if you want software, scanners, or any of that, you can talk to Jeff about that. You must have charts. You must have live charts. It's easy to find the scanners to see them. Because again, like I said, there's thousands and thousands of things on any given day that are gapping. It's the idea of focusing on the right one to do, to know that you're going to be able to do this one and then it's going to work, okay? And again, it's the idea of booking money. You book it, you chunk it out and book it. You take the trade, get out, book it. We're not long-term investing here. I'm getting the move and the drop if I'm shorting. I'm getting a rally, I get the rally up and I'm out, boom, if I'm long. That's it, okay? But if you want to do this for something on the side, it's a convenient way to make money because you can trade from home. And even if you're at the office, you can do it. Many people have it on the app where they can actually place trades on the app. And it's just so convenient now to trade in this electronic world. But it's getting the good trades, the risk to reward trades that you need, and then thinking about, again, like I said, what your lifelong goals are. If you really, really want to do this for seriously, then you need to take it seriously because life's just getting more and more expensive. I mean, with inflation and the things that today's, like I just said, mortgage rates could be over 8% by the end of the year. We have to continue to survive and exist. And we want to exist in harmony. We don't want to feel like we are skimping and saving and skimping all the time. That's not the way that it's supposed to be. Do I think that eventually prices will go back down? Not necessarily. I think this is a different type of inflation that we've had in the past. And I think that we're in a different world now since COVID. So we have to find a way to make things work. And we want to live happy lives. And we don't want to worry about money. And I've seen far too many people worry about money. And I'm doing my best to help people and teach people, but I do charge for my information and for my time. But you've got to take it seriously if you want to trade. You must, or you're not going to do well. Learning how to trade before risking your money is so important. It's an important factor in becoming a successful trader. You've got to understand that. But you can empower yourself to trade. You can do it. People are having a very good year with me. It's been one of these years, like I said, where shorting was the right way to go. We were short lots of times the market this year. We've been short many, many stocks. I do prefer to short in general, but I think that this year has been very advantageous to short. And even though a lot of people think that we're going to hold here, that we're going to hold the October 13th lows and everything else like that, I disagree. I disagree. So we could be in for a very wild and volatile end of 2022 and then eke out a couple of days between Christmas and New Year, maybe for a a rally into a Christmas rally into the very, very end of the year or something. Like people talk about a Christmas rally. It may be 2 days. It may be 3 days. It's not going to be the whole month of December. That's for darn sure. You know, so you have to keep that in mind and think about it. Here's some testimonials from people. Anyways, I did say this before, but nothing in life that is great comes without taking risk, and I think that's important. So if you'd like to learn my system, it's a 26-point checklist, and the key to the system is the 26 points. This is how I'm able to predict the moves of stock banks so accurately, including the market. It's a rating system. I get up in the morning, I rate the gap. I rate the gap. I do this every morning. I never skip it. Okay, it's very important. The better I am at getting the rating right, the faster I'm down, the more money I make on the live day. So the Golden Gap rating system is a 26-point professional bearish gap rating system. The purpose of this system is to help you evaluate which gap to trade each morning using a checklist. Again, the checklist tells me where it's going to go. So the class I teach is once a month. I only have one more class between now and the end of the year. It's in December. It is a class on how to find pick and play professional bearish gaps. It's December 10th and 11th. Now, the class is online. You can be anywhere in the world and take it. The class is $69.99, and it's 9 a.m. to 5 p.m. Eastern Time, 2 full days. It's always on a Saturday, and it's always on a Sunday. If you'd like to sign up, you can email me at melissa@thestockswoosh.com. Now, I am doing holiday specials. So I did a Black Friday sneak peek just this weekend for my marketing list. So I'm offering that for this webinar. If you think you want to join, you can sign up for the Black Friday sneak peek now if you want to start trading and start joining before the class in December. So I'm doing 2 specials. One is for the options. If you sign up for the Gap Options newsletter annual subscription, the Black Friday sale is normal price is $69.99 for 12 months. The Black Friday sale is $59.99. You get it until the end of 2023. So actually you would get 1 bonus month. So you would get 12 months plus till the end of 2023, and you would also save $1,000. I'm also offering the Gap Options course free with this Black Friday special. So this is $59.99. You get on the newsletter all the options newsletter trades at the end of 2023. You get the Gap Options course free. That's in December, and you would save $1,000. Can you use the system with futures? Well, again, you know, why would somebody choose to trade futures over options in the market or day trading? It's, you know, I think futures are just a cheaper way of trading the market. I don't think there's any advantage to trading futures over doing trades on margin or options, just because of the fact that I think people do it because it's cheaper. So you can use my system to rate the market gaps, and that'll tell you the direction is going to be to take a futures trade. But I think most people trade the futures because of the type of accounts you could open with futures, where people find that to be less expensive, but it's really not any more advantageous in my opinion. But yes, you can rate the gap in the market, and that would tell you where the market's going to go, which will help you trade the futures. But I don't do that, okay? Now, the Golden Gap course class Black Friday special I'm doing is a Golden Gap course tuition. It's the combo, which is $74.99. You get the Golden Gap course, which is normally $69.99, plus the Trends course. Both these classes are in December. And if you sign up for the Golden Gap course combo Black Friday special, you receive the live trading room free for 1 year and the Gap Options newsletter free for 1 year. This is huge. You basically get the room free for a year, the newsletter free for a year, the 2 classes, and it's $74.99. So again, you have time. This is the Black Friday special, but if you want to get in and start trading this week, then you could sign up for this. I'm doing the sneak peek and start trading in the live room this week and start getting the options trades this week. You know, when you're thinking about things you want to spend your money on between now and the end of the year, spending money on yourself for education, for trading, if this is something you really want to do, you have to go into it and you have to say, I'm worth it. This is something that's an investment in my future, and it's an investment in yourself, just like you go to any other school. I'm actually moving. I'm moving in less than 2 weeks, so I'm super duper busy, but I've been working on finding an apartment, a different apartment in New York, trying to look for a long, long time. It's an investment, you know, and like it's an investment to move. You have to pay for movers. You have to pay for this. You have to pay for that. There's so many things in expense, but it's an investment in myself because I'm looking to improve my life. So, I mean, anything that you are looking to do to improve your life, whether it's get a new job or learn something new or go to school or, you know, buy a house, all of these things cost money. It's just the way the world is. But, you know, they pay off in the end. It's about having an optimistic attitude and believing in yourself. And as I said earlier, hard work is part of it, but just working hard is not enough, because there's too many people out there when you're trading the market on any given day that are against you in your positions and they want your money. When you're trading, it's a zero-sum game. There's always one winner and there's always one loser. And if you want to be on the winning side, then you have to believe in yourself. You have to put all the odds that you can stack in your favor, every single one. That means having money to trade. That means believing in yourself. That means following a good mentor that knows what they're doing, which would be me, for example, in the live room. It means having a strategy and rules that you follow every day. It means staying within your risk parameters. It means everything, you know. It sounds great to make all this money, and yes, it is possible. But I think too many people think, I'm just going to do it, and I'm going to learn it like in a day, and take a cheap class, and then I'm going to make, you know, $100,000 in a month. It's not like that. While there were some people that made a lot of money on those Reddit stocks that happened, like we're talking now 18 months ago now, so long ago, those things are 1 in a million. It's like winning the lottery, like the Powerball. What's a Powerball? Is a Powerball over 2 billion yet? It's getting close. Like the Powerball that's coming up, I guess it's Tuesday night or Wednesday night, the next Powerball, because it didn't hit. It's some crazy number. Like, yeah, you have to think realistically about this. And once you start to really think realistically, then you can actually make all of your big dreams come true. But it's getting it down, the nuts and bolts of it, to understand really what's involved and the commitment of it. And part of the commitment is financial. Any questions here from anybody?
We had a question on the date from YouTube, but I typed it in when you said what it was. So, but Zola wanted to know the date of your next course. So
December 10th and 11th.
Awesome. Okay, that was all the questions we had.
So think about 2023. It can be your best year yet. It's a good time. It's the holidays to start getting organized. Again, if you did not have a good year this year, do not beat yourself up about it. There were a lot of traders that didn't have a good year this year because they never expected the market to do these things. Inflation, the Fed, interest rates, all of it. You can turn your year around even with 2 more months left. You can. And the sooner you get into positive, good footing with your trading, the better off you're going to be. The sooner that you'll really be able to realize your dreams and all the things that you want to happen. Any last minute questions from anybody here?
I have a special request for you, Melissa.
Oh, go ahead.
Will you help me pick the next prize winner? I need a number between 1 and 9,419.
29.
Ooh, that's a low number. I'm glad I found the easy way to get around this spreadsheet. Krishna K is the winner of the next prize.
Congratulations to Krishna.
Cool. And hopefully he's in the US because Trader Tax Accounting, if he is going to do his taxes for him. It's a value of $750.
Wow, congratulations. That's so nice to give out prizes.
Yeah, for sure.
Thanks so much for having me, Beth.
It's so good to have you. So Melissa at thestockswoosh.com to get signed up for that class. Love having you, Melissa. Thank you for coming in.
Thanks for having me.
All right. Thank you. All right. Do this. Okay. Okay. And then for the winner of that prize, usually I just wait until Krishna, I'll be dropping you an email with some information about kind of claiming that. And we'll get that over to you. Let me go ahead and make myself the presenter for a second. We do have a little bit of a program change I'm going to tell you about right now. Unfortunately, our next speaker is Oscar Carboni. Well, I mean, not unfortunately. Unfortunately, he doesn't have power. It's really what I'm trying to say. We're gonna hopefully he'll have power from the Nevada power grid in just a little bit here. We're gonna make a little bit of a schedule change. So if you're tuning in to watch Oscar, if you're one of the Omniacs, our new time for him is going to be in 2 hours. So at 4 p.m. Eastern instead of, is that right? Right now it's almost 3 p.m. Eastern. he'll be right after Barry Burns. So hopefully he'll have power by then. I do want to say very, very huge thank you for Martha Stokes. She's going to speak in just a second now, but she's going to speak quite a bit earlier just to kind of fill in the gap. And that's really, really awesome. We appreciate it, all that kind of good stuff. You should be able to see my screen. If there's any problems, I'm sure the control room will let me know right now. I do want to say thank you right now to the CMT Association for sponsoring today's event. They've sponsored our events for about a year now. It's been a good partnership. CMT is a hugely well-respected organization. We're happy to be part of them. And they actually do market analysis. They basically run an accreditation program. And actually, if you're trading as part of your vocation or your business, or you want to move into a business where you're trading, maybe you want to help work for a bank, a CMT chartership or a CMT designation would actually really help with that. And you can find more information about CMT at the cmtassociation.org. But they're a very, very good sponsor of MetaStock, a very long time running, well-established, super good organization. Actually, Martha Stokes, our next presenter, is a CMT. So it's a very, very good mark of honor, I guess. I mean, they do a great job. So for us, MetaStock, we've been using MetaStock all day. It's been rated 29 years in a row as the best software in its price category. It can help you scan, it can help you test, it can help you do forecasting. You can do real-time alerts and commentaries, and it all starts at about $59 per month. You can get a free trial if you go to metastock.com/conf-promo. If you have any questions about MetaStock, give us a call, 800-882-3040. You can also visit us at metastock.com/sales chat. And also, I forgot to mention this, but we just gave away a prize. If you're watching us on YouTube and you want to be eligible to get the prize, go to our website. Kelly's going to put a link in the YouTube description right now. It's metastock.com/tradersconference, traders-conference. If you put that in there and you fill out a registration form, you could also win a valuable prize. So anyway, metastock.com/comp-promo. So there you go. Bill says, can you post the speaker schedule for the rest of the day? I will actually put the link in just a second for that, Bill. So thank you for that question. But let me get us moving on. Our next presenter is Martha Stokes. I do want to say huge thank you for Martha. She's going a little bit earlier so that because Oscar can't go. So hopefully that'll be we can give Oscar a chance to speak a little bit later. If not, we'll have her come in on a different day. If Nevada Power can't deliver in power, we'll work it out. Martha, though, does a great job. As I said about a minute ago, she is a CMT charter holder. I think you can correct me if I'm wrong on that, Martha, but Martha's great. I really like her style when she comes in. She looks at charts, she tells you what she thinks about them, and I just really like the way kind of she does their presentations. She does a really, really good job. She's been a friend of mine for, oh my gosh, a long time now. And she's going to do a great job. So she always does. Let me go ahead and make her a presenter. Martha, how are you doing? I can see your presentation, Martha.
We'll put the camera on. Thank you.
Okay.
And I've got my staff here helping me get ready early.
Yeah, no problem.
I'm good to go. Can we see
Thanks
me?
for stepping up and coming in a little bit early. I can see, here, I can send a webcam request. I can't see you right now.
Okay, hang on, I've got it.
All right. Perfect.
Okay. Great.
Thank you again for coming in a little bit early. I really appreciate that.
No, I'm happy to help you out. Okay, today we're going to talk about supercharging your trading profits, featuring Martha Stokes, me. And I'm an educational company. I am accredited with the SEC, which is very rare in the industry. Everything that I talk about is about teaching you and training you and not a recommendation. I do not think that recommending stocks is a good idea. Everything is copyrighted and the charts are presented in this format is from MetaStock, and we thank them very much for their permission. So this is who I am. I'm a chartered market technician. I've been a member of Market Technician Association for a very long time. I'm also the CEO and co-founder of TechniTrader. I authored Cycle Evolution Theory, How to Identify Evolutionary Cycle Deviations, which was a landmark change in how everyone analyzes cycles. It was hugely appreciated by the CMT Association. My second thing that I provided to the CMT is Relational Technical Analysis Theory. Again, hugely well received. Most CMTs are using it now because it's very important. We're going to talk about that today and how relational technical analysis is different. And I have authored over 40 stocks and options trading courses, and they're all available through TechniTrader. We also have a free bonus at the end of the presentation, so hang in there. Okay, TechniTrader just was endorsed by Shark Tank's Kevin Harrington. It's a big deal for us. There were hundreds of different educational companies that, and most of them in finance. And he chose us because he thought we were the best. And so we're very happy to have that endorsement from a very important billionaire. Supercharge your trading profits. Trading stocks or options should be about, and you can take notes, making high profits with minimal risk, a trading process that anyone can learn, an analysis of the stock chart that takes only a few minutes, a method that ensures a precise entry, a method that gives you the best exit, best entry and best exit, an easy, simple way to determine market condition and trading conditions, which are something, it's not market breadth or any of that. I have a completely different process I developed when Howard and I had a trading floor and we had traders that we needed to help them get through the early days. All of the above ensures you are trading technically rather than emotionally, because most of you trade emotionally. Today, we are going to learn how you can have this kind of trading experience. So many traders settle for 10 cents or 25 cents. I'm often shocked. Profit per share, netting them a meager income to a loss that they are not aware they are taking. Some swing traders take profits of less than $100 a trade, and that is pathetic. Neither is enough to make a living on. And many people want to do trading as a business right now because you want to work from home. You have the opportunity to do this. The IRS allows a certain trading as a business status, which gives you all kinds of opportunities. Traders start to take shortcuts, rely on recommended stocks, or just grab the first stock in a news feed. Don't do that. Don't. Today, we're going to learn how to trade profitably with less stress and less work and make much higher profits on your trades. The goal is to make more money on every trade. MetaStock charting software is superior. It is an excellent tool for faster, easier trading using the TechniTrader methodology we'll talk about today. So, you've learned about candlestick charts and technical analysis and MACD and RSI and all the other indicators and all these strategies. This is all good stuff, but you're missing that one piece of information that separates you from the professional trader. You've all heard about the professional traders making 6 or 7 digit incomes, and I know a lot of traders who do, both independent and professionals. And some are my students. But retail traders lose more money than they make. It is a statistical fact the SEC has investigated, and it's on their website. What you need to know to make supercharged profits professional traders take for granted is explained in this webinar. So buckle up and get ready for an amazing experience, a look into a world few retail traders know about. So 80% of the market is hidden from you. Even if you have a day trading platform, level 2 or whatever, it is hidden from you. 80% of the market you can't see until end of the day or after the day. So you're trading with retail traders and small funds managers. You're not trading with the pros. This is what you need to do. It's happened to you. You look around trying to find a stock to trade and you come across a stock that has a huge gain seemingly out of nowhere. And you ask yourself why you never find these stocks until after they have run or gapped hugely. It's right there in the chart. It's right here. With the TTQA, we have a shift of sentiment that has occurred. And there has been accumulation going on right in this area. And then the pro traders come along and they push that stock up, tempting the HFTs. The the HFTs gap and run. Now, I know a lot of you have heard that dark pools make huge runs and huge volume. Wrong, misinformation, they don't. And I'll explain more later. You need to learn how to read the charts to identify dark pool buy zones. When you can quickly recognize dark pool buy zones using relational technical analysis, you will dramatically increase your profit potential immediately. Relational analysis includes some aspects of the fundamentals in the stock chart that are embedded in how and what is going on. TechniTrader developed 5 specific indicators for MetaStock only and a market condition analysis explorations of 7 to help you analyze the market using MetaStock's excellent charting software. So you want to learn these patterns and see how they work, because a lot of times I'm reading on the internet, I'm going, are you kidding me? Because I'm hearing these things that are just not true. Dark pools do not disturb the trend. They try to get in on the penny spread. Pro traders use penny spreads. They don't, and then they tease the market to get things to move up. The dark pool is a huge profit area for professional traders. They make all kinds of money. Dark pools are ATS venues in which the most powerful market participant group transacts their business, the giant buy-side institutions. Hidden from the exchanges, 100,000 to 10 million share lots orders are bought and sold. These huge orders are not displayed on retail day trading platforms. They are hidden. That's why they're called dark pools of liquidity. And you need to be trading with them. The SEC has determined, and this has been around for 20 years now, that it takes an average of 10 minutes for the dark pools to collect enough small lot orders to fill their large lot order. That's why they're on the dark pools. So you can't front run them. You can't scalp them. You can't see them. However, the data is in your charts. All you need is MetaStock charts with TechniTrader's hybrid leading indicators and the MCA explorations that I developed many years ago that still work amazingly well. Buy-side institutions manage over $93 trillion in assets worldwide as of 2022. It was in 2019 over 100 trillion. That's a T, not a B. T. That's a huge amount of money. And that's why the markets are so important to our economy and your future. Because if you don't learn this stuff, you will be left behind. They create the opportunity for momentum in a unique way. Buy-side institutions do not disturb the price trend, but hide their activity in plain sight. If you know what to look for, and if you have charts and explorations that use the TechniTrader hybrid leading indicators. Professional traders create the momentum runs after dark pool buy zone completes. These two groups control over 80% of all the activity in the market, and you are constantly trading against them. So we have a dark pool buy zone, that's a shift of sentiment, and then we have a huge gap up that occurs, and the dark pools start selling and smaller funds start selling and causes the stock to go down. So what happens is you need to get in early to enjoy this huge gap, and the pro trader footprints are there on the chart, and the accumulation, they're sitting and resting. And what they do is they do exactly what your gurus, your retail gurus that everybody loves, and they're all famous, some of them are on TV, whatever, they recommend a stock. Oh, buy this stock, buy this stock. All right, it's going to go up, it's going to go up. Of course it's going to go up. He's famous, and you all love him, and you believe him because the stocks do go up. But the buy side does the same thing. They do the dark pool quiet accumulation over a period of time, and then they release that information. Oh, by the way, we've been accumulating XYZ. And so the pro traders get in, and the pro traders cause the triggers of the HFTs. The HFTs, if you don't know, are the automated high frequency traders. They used to be called the SOS bandits, but in 2002, the Congress decided to take pity on the average retail trader who couldn't figure out fractions and change everything to decimals. The idea was an efficient market. Now it's an over-efficient market. The HFTs are automated. There's no human being at that desk. It's all algorithms. They're highly sophisticated. The the computers they use are anywhere from $1 million to $10 million. And so if you hear about algos and you can write algos, you got to be careful because your algos are very basic. They're red light, green lights. They're just the change of that, but they're not the algos that the HFTs use. And the HFTs sniff around social media and they sniff around the retail news and they sniff around anywhere that there might be some excitement. And they also follow the pro traders. They gap up hugely, knowing that you will hear that news after the effect because everybody else heard about it earlier. And they gap it up and then they sell into your buying. And that's why you lose money because you're chasing stocks. Here's a buy zone. This is what they look like. The range is very specific and it holds the price within that range. And they usually have a center line where most of the ticks of the largest lots occur. So when you learn about this and how this ends, because we usually have 3 hits, 1, 2, and then a third one, and then it will break out because they usually complete within that period of time. So when you study these charts and you analyze these, and plus there's a few swing trades in here as pro traders set up and get in and run up. And you have confirming indicators telling you that, yes, this is dark pool buy zone. The dark pools create the bottoms of the market. They create the platforms of the market. If you don't know what a platform pattern is, then you need to learn what it is. It's a sideways pattern that is a buy zone. There's a specific range and they have the lows and the highs and the stock will, if it falls through that, then it'll come right back into the zone. If it goes above it, it will come right back down into the zone. And so you have this pattern that occurs over time. They're usually associated with earnings seasons. So they're between the earnings seasons that these patterns form. And we're going to see a lot of them because the retail side has been terrified by all the bad news. Oh, interest rates. Oh my gosh. Inflation. Oh my gosh. Oh, the world is coming to an end. Blah, blah, blah. It's all pandemic rebalancing. And all the industry reports that I read and everything show that the supply chains are being repaired, everything's getting better, and it's settling down. So we will see a lot of platforms that form and a lot of basing bottoms. We're already in a bottoming market, although everyone does not believe that. If you have heard of dark pools, the information you were told is probably wrong. The buy-side institutions are present in every exchange around the world. In every market, commodities, futures, options, currencies, bonds, credit stocks, and derivatives of derivatives and swaps. They dominate the market entirely, but their activity is not lit to the public exchanges. The buy-side institutions use the dark pool venues to transact their business of buying and selling millions of shares of stock or other assets over extended periods of time. Their goal, never to disturb the trend up or down beyond their buy zone range. So the special orders trigger when it hits a certain price and it hits a penny. They hit for the penny. So there's very little disturbing of price. I'll show you how that works in the SEC Midas in a minute. So they're very, very subtle. And when you learn to see where they are in the chart, it's very easy to see once you learn what you're looking for. It is also important to know that dark pools are permitted to delay the reporting of their orders during the day until after the end of the trading day. So intraday is blind. Intraday has 20% of what you need to know to trade. So if you're day trading, you're trading very blind and you have no idea what's going on the buy side because it's not lit. And you need to be aware of that. There's a lot of people out there saying that it is not. And the only way to wait is to wait until after the market closes to see all of their reporting of their orders after the market closes. Why do they do that? Because they don't want HFTs front running the institutions. The institutions control all of the 401ks and pension plans and long-term investments of this nation and many others. And the goal of the buy-side institution is to protect the assets of the middle class of America and other countries. And in doing so, they do a lot of support. Right now, the last few weeks, they've been supporting the market to keep it. Every time it goes into bear territory, pops right back out. 3 times we've been in bear territory, but it never stayed. It never went down into actual continuation of a bear. We never had a bear. We had an intermediate term correction, but everybody calls it a bear. But it wasn't, because it didn't go into that secondary factor of down again. Why? Because the buy-side institutions were ready for the ETF investors to capitulate. ETF investors are younger. they are new to the market and they hear all this bad news, so they start selling their ETFs just like the stocks. And that could cause a catastrophic collapse in the market. The derivative developers got together with the buy-side institutions, BlackRock, State Street, and said, what do we do about this? In 2018, they realized that the surge of ETF activity and all the buying that ETFs were creating and creating the new opportunities, even Bitcoin, you can buy anything via an ETF and you can sell it like a stock. That's sweet to people who were growing up in the Great Recession and their parents had lost a lot of money, and there was that they had to do the redemption clauses on their mutual funds or their index funds, and so they lost more money than they should have. So the new investors want to get in, buy an ETF, hold it, and if the market goes sour, then they want to sell. Well, the buy-side institutions are going, this is a recipe for a disaster. This is a recipe for a catastrophic collapse. If all the ETF investors sell, we have to sell our held trust stocks to lower the value of the index upon which the ETF is based. So they got a great idea and they had a strategy. And I've been monitoring it now for several months, and it is amazing. They started in April trying to support the market, not move it up, support it. And it's been a brilliant strategy. So we may not see as deep of a bear market in the future, only if they can't control and support the market. So every time it starts to go down, they pull it back up. Every time it goes down, they pull it back up, just to that level. Now people are beginning to say, oh, well, I've lost a little in my 401k, but I guess I'll hold because I think it's going to be okay. Oh, my ETF, well, I think I'll hold because it comes right back up and I've only lost a little bit and it'll probably return. And so they're doing a good job of it. Excellent job. Most retail and technical traders don't understand how dark pools work or why they work or why they're there, or what they have heard is erroneous and misleading. I have read several articles and I'm going, are you kidding me? But that's the way it is. So this is SEC Midas. You can go to the SEC website and you can check it out for yourself. And they have been monitoring the dark pools since they allowed them to be off the exchange, no lit liquidities versus the HFTs who are lit on the exchanges and provide maker-taker activity or market maker activity. And there was about 20,000 HFTs at the start of the pandemic, but we've lost about half of them. They went out of business. Your dark pools are the purple line. Sometimes they'll move that up a little bit. And then you have your wealthy individuals that are a management that's holding that down. This high activity here, this is HFTs. HFTs create vast, huge swings. So do memes groups. If you have a million or 2 million traders that get all ready at lunchtime and they all trade the same stock, they can move it. They can move it, and that has happened. So, and this is a millisecond. The professional side trades on the millisecond. It's so fast that your eyes can't catch it. It's so fast. It's going because they're going 60,000 times in a millisecond. It's amazing. So you need to learn what a dark pool zone looks like. It looks like this. Why buy zones form? They form because the dark pools control the entry price because they have quantitative analysis from their CFAs and their CMTs that work for them, and they determine the foundational and fundamental value of that stock in a range. And they keep it tight when they're accumulating anywhere from 1 million to 20 million shares or however much they decide they want to do. Each company is different. Where buy zones are located on the chart: bottoms, platforms, intermediate term, trends upward. Only on the upside. They do rotation, but that's at the top when a stock is peaking. They never hold through the highest high. They start selling ahead of time. So you know if they're selling, you should be selling. How buy zones will impact various trading styles. Right out of a bottom, you're going to have an acceleration with a lot of swing trading activity. If they go into the platform market condition, then you're going to be using positional platform trading. That's not positional SARS. It's a platform that forms over several weeks to several months, and you buy it. This is a great style that I'm the only one that teaches it. if you're working full-time, or if you have a young family, or if you're really, really busy, but you work from home, or you just still want to trade the market a little bit, you don't want to do long-term investing, you've got MetaStock, but you can't afford or don't have the time to do it every single day, then position trade. Position trading, you buy a stock and you hold it, and you hold it for huge gains, 20 points, 50 points, 150 points. So it actually makes more money than day trading, because day trading, you're in and out, and you take losses, and the spreads are so narrow that it's very hard to make that kind of money. In any given market condition, there is a profit zone. The profit zone occurs after the buy zone. And this is where most of the highly lucrative trades for swing trading or day trading occur, because the momentum, what we have is we have a compression of price, keeping price down over a set period of time. Keep it down, keep it in this range, keep it in this range, keep it in this range. And all of a sudden the buy zones, the people buying in that zone say, okay, let's release it. Let's let the pro traders move it up. Let's get going. Well, that's like a spring. You have all this liquidity being pulled from the market, especially small caps. I know all of you love to trade the big caps and all the companies you know, and oh, I just love my Apple phone, so I want to buy Apple. Oh, I just love my Tesla car, so I want to buy Tesla. But big gains are in small caps and IPOs. Why? Because the percentage of shares held by the institutions in those smaller new companies that are going to be big companies someday is 90 to over 100%. And if there's more buying in that buy zone over time, that creates a liquidity imbalance. So when the pro traders start trading, that stock skyrockets. Do you understand that? Do you understand why momentum is happening? Because that's a critical part of understanding dark pool buy zone and how you use it. Because you will see a lengthy period of time, and then you say, okay, now I can get in and do my swing trading or momentum trading or velocity trading. The buy zone is that place where the giant lot institutions seize control of price without disturbing the trend. They will always be sideways. It will be a consolidation. It will be a sideways. It will be a platform, which is a very controlled range. It may even be in a trading range, which is a very wide looping activity, but it will always be sideways. Why? Because they are controlling price to the penny. They're triggering a zone where they want to buy, and their traders are some of the best in the world. And they sit there, and the pro traders, when I talk to my pro traders, they say, the most exciting thing in the day is when I strike the half penny. That means their huge lot order filled on the half penny. Yeah, they're trading half pennies to get a little more spread on the professional side. So this is very exciting, very intriguing activity that you never get to see or hear about. This is what I teach in my courses, because the students who learn this stuff have a much easier time, and they're able to start making money more like a professional makes. When accumulation ends, pro traders set up to trigger HFTs. So there's a mechanism in place. So when they're supporting the market and they're just pushing it back up and pushing it back up. Today was a push-up day. Today was a support day. Today was, okay, we've had some down days, and we want to support that market. We think there's going to be more selling. We're going to support that market. And it's right there in the charts. You can see it. And they will support that market. Then the pro traders will go, oh, let's do a swing trade on this, see if we can tempt an HFT. And then suddenly you have momentum or velocity run. So that's what you want to check for. It makes trading far more fun, and you have less is more. If you have a strong run up and you have a big gain of 10 or 20 points on 1,000 shares, you don't have to trade 14 stocks to do that. HFTs gap and run the stock. The retail crowd always chases it. I see it all the time. Retail crowds are chasing it constantly. So they're always in late, and they're trading with scared money. I've lost so much money. Oh, if I just hold it for 2 minutes, then I'll make some profit. Oh, I'll take 10 cents off. You're worth more than 10 cents, right? You're worth more. How much are you worth an hour? How much would you expect to get on a wage or a salary per hour? Now double that. That should be your trading expectations, not these penny things that I see all the time. And it's because you're afraid, because you've lost money, because you don't see what's going on. You're missing that 80%. You need to be able to identify that so you can go in confidently. Because when you make money and it's simple and it's easy and you follow the process and you do the trading parameters and you watch the rules that I teach you, you have that methodology under your belt, then it's easier. More is less. You make more money per trade. You trade less often. You have much smaller losses and you have more and more solid trades. Your confidence goes up, your self-esteem goes up, your trading gets better, and that's what it's all about. The reason you're not as successful as you deserve to be is because you don't understand the inner workings of the market, the structure that holds the market together and causes these huge runs of the HFTs. This is an HFT run really fast. You can't chase it. When you get in here, they're going to start selling at a certain rate. And so you're liable to get into a whipsaw trade. You go, gosh, darn it. I thought that was going to be a good trade. And it's a whipsaw trade again. Because you need to get in sooner. You need to know how to identify this and see it so that you will make the good profits. Because you deserve to make as much money as the professionals do. Don't you? Don't you? So let's take a look. These are not dark pools. Who makes wicks and tails and has what I call the hysterical chart? The hysterical chart is a chart of scared money. Retail traders buy in here, maybe they get in here, it comes up and then it comes down, they go, oh, I better sell, I'm losing money. Oh, and so there's this hysteria that goes on because they're trading emotionally because they're trading with scared money. They've lost so many times and they've lost so much capital that they have this pain that they can't endure even with a small loss and they can't hold. So they lose money and then it sinks that down. This is not a dark pool. Also, look at the high bars on the TTQA, the TT quiet accumulation. This differentiates large lots from smaller lots. These huge spikes do not occur with dark pools. Dark pools have very low bars. Why are the high bars smaller funds managers and why are the low bars dark pool buy-side giants? Because there's only 20 or 25 giant buy-side institutions and there's 10,000 or 20,000 smaller funds. So the longer bar represents more trading activity. The shorter bars show the dark pools that are accumulating and using a lot size of maybe 2 million or 5 million. So their bars are lower. And so this is a strong indication that right in here, now all of a sudden, your wicks and tails shrink. And the price gets very stable. It stays within a very narrow price range. If it falls back out of it, it runs right back into it. And we have a few smaller funds selling here as well. That's why we have wicks and tails at all, because they're using a VWAP order. And volume weighted at price is the most dangerous order of all. It caused a May 2010 flash crash. And you have to be very careful using VWAP because it is not as you expect it to be. It creates a flurry of activity that causes whipsaw action. So we have dark pool quiet accumulation going on in here, pro traders moving this up. Then we have a little sideways pausing, another little platform where they're hiding their buying in here as they moved it up. And then we have a huge run up. This was MEMS. This is not dark pool accumulation. This is the MEMS group. All this little, we have this little guru out there. The SEC is investigating it. It says, okay, everybody, let's kill a hedge fund today. Oh yeah, that's so funny. And they buy. And then the HFTs are also in here and they start selling and it goes down. And then it goes down and down. And a lot of retail traders are losing their shorts on this. And then pro traders and a few smaller funds are in this. They wait, they sit and they wait. Because they know the memes group will be back. And then they drive this up again. This is a spike of volume caused by VWAPs. and caused by a huge surge of volume activity from retail traders all trading the same stock between the noon hour, which is a 3-hour span in our market, and between the West Coast to the East Coast. And so these are memes groups, and they're retail traders, and they lose a lot of money because this is a huge whipsaw intraday, if you looked at it intraday. So we have a shift of sentiment pattern where we're going from the smaller funds to the dark pools buying it, pro traders get in, and then we have this big run. But you have to be prepared to exit as the pros do. And you watch that on intraday, because the pros, the last 5 minutes of the trading day is probably the most important part of the trading day. Why? Because the pro traders have their own auction going on. Did you know about that? Yeah, maybe you didn't know about that, but yes, the last 5 minutes of the trading day is an open cry auction, and the professional traders get in there and they go back and forth in a peer group, and they're trading like crazy. So how that ends at the end of the day tells you a lot about the first of the day. Barring any retail news, it's going to cause the HFTs to gap or whipsaw stocks up. So are we understanding this? This is the professional side. This is what's going on the pro side. You learn about the retail side all day long, but if you don't learn about the professional side, you're going to struggle. If you learn the Technotrader methodology, you have a decided advantage. Dark pool algorithms are computer-generated order flow over extended periods of time. Their patterns and price range are precise and they repeat. So the quantitative CFA decides what the price range will be. The traders set the triggers. They have professional traders. They are not using AI. They are not using algorithms. The buy-side institutions are too smart for that. Computers are not that intelligent, and you need a professional trader who is excellent at his job. And he has the price range, and he sets these orders in. The TWAP order establishes it, time weighted at price, average price. So it's a timed mechanism. And any time that there's a problem in the market, that order is paused. And those are called voids. When all the orders pause, that can cause a void in the market. So the dark pools are not going to allow their orders to be going down. A lot of you use limit orders thinking, oh, I'll get a better buy, I'll get a better price, I'll get a better price. All of a sudden you're in a stock and it's going down and you wanted that to go up. The professionals and the buy-side institutions are too smart for that. They don't use those orders. Repetitive price action by dark pools allows Technotrader students to prepare for sudden momentum or velocity moves that follow dark pool accumulation. This gives our students an edge. They can enter the stock before the HFTs gap or run the stock up hugely. This is a millisecond chart. I find that most people find it fascinating. And you can see that the liquidity doesn't look like much. And by dark pools, because they're controlling the price, and they're slowly pulling off smaller lot orders to fill their giant lot orders. And then HFTs fill the queues with huge number of small lot orders, but they fill the queues so high that it triggers the automated computers that are the market makers of the New York Stock Exchange and NASDAQ. They're all automated now. And it triggers those to gap the stock up because there's too many buy orders and no sell orders, and huge volume surges. And the VWAPs that the smaller funds use all the time also cause these huge surges and they cause gaps. So none of these orders are filled until about here. And those HFTs automatically cancel these lower orders. As the computers force the price up, they cancel their orders. So they have the market open at a high for the day, and then they start selling. Our students are able to trade with the professional traders, and they just love this. So we have a community, and we have discussion groups, and the pro traders contribute quite a bit, and they really enjoy it. Plus, I spend a lot of time in my discussions and commentaries to help the students. Instead of chasing stocks that are running faster, our students are sitting back, enjoying the ride as the stock runs up with huge gains. It's just such a relaxing and enjoyable way to trade stocks. Retail traders miss the buy zones because they use outdated candlestick patterns and price indicators. You can't find the dark pools with price indicators. Price and time indicators were written prior to the dark pool ATS venues, which started in 2002. Price indicators do not reveal dark pool activity because dark pools do not disturb the price. Dark pools do not move price in huge gains. Most retail traders chase HFTs and professional traders after price has already moved. Relational technical analysis with hybrid indicators on MetaStock charting software reveals dark pool activity. This analysis is simple, more efficient, and superior to the old ways. I kind of cringe when I have a new student that comes to me and tells me, well, I took this course and I took that course, and I'm like, oh. And because we're taught all this stuff from the 1990s. It's not 1990 anymore. It's not 1999, and it's not 2000 anymore. It's 2022. And the market is completely different. Completely different. That's why I always update all my courses every single year. Every single year we update them. So a gap up, HFTs, and then a run. Small funds go up. Oh, retail traders jump in. Oh, it's going up. It's going up. It's going up. Oh, a whole crash. And this happens too often. That's why in my retirement, I'm trying to help you. So we have an HFT gap up, and smaller funds, VWAPs, trigger and push the price up, but only so far, because there's a sell zone from the dark pools, because this happens to be a topping action, and it takes it down and down and down. So you want to also watch for the inverted TTQA, which warns you that these buys, they're not buying anymore, they're selling. They sell well ahead of any topping action. Under market condition analysis, this is so imperative because it tells you what's happening before it's evident on the indexes. The indexes lag so much nowadays, this is critically important. Understanding where to find the profit zone is not rocket science or some magic get-rich-quick scheme. It is about using more sophisticated analytical tools that take the guesswork out of choosing stocks. Technotrader students are able to quickly identify the shift of sentiment chart pattern, which means dark pools have taken control of price. And when they take control of price, either for buying in accumulation mode to create a bottom that will have a momentum and velocity run very soon, or as they start to sell, as they know that the company has reached market saturation to a market decline phase for whatever they're selling or whatever they're doing, and all businesses have cycles, and they're different for each particular market and each particular stock. The dark pools control the price, and they have taken it. As a Technotrader student, you learn to use modern hybrid indicators to reveal dark pool activity. These are far more complex indicators than have been presented before. And we wrote these specifically for MetaStock charting software because it's an excellent software. You are in the stock before price moves. You have to learn to get in before price moves, not after. To help explain this, we're going to review a market participant cycle and how it creates the profit zones of the dark pools. So very quickly, some of you have seen this and some of you have not. Buy-side institutions create the bottoms. Sell-side institutions are banks and financial services companies such as Goldman Sachs. They often drive the market down. Recently, in this year, the banks have been trying to drive the market down, and the buy sides are going, nope, we have more money than you have, and we're going to keep this supported so we really don't enter a really nasty bear market. We're going to get through this pandemic, and we're going to save millions of Americans' 401ks from crashing. And that's the battle that's going on. There's a war between the buy side and the sell side institutions as to what they should do. Sell side wants to make a lot of money selling stocks short. Buy side institutions want to preserve the integrity of the middle class of America by keeping 401ks in a reasonable level. You have wealthy individuals and family trusts. We have a lot of billionaires And they don't trade the market and they don't invest for themselves. They hire the best money managers in the world. And those money managers are part of the buy-side institutions. They also form the bottoms. There's been money moving in flow funds. I watch flow funds all the time. $35 billion came in last week. $35 billion came in last week. Does that sound like a bear market to you? Independent traders are the professional traders who've gone rogue and they're independent. They work for themselves or they've created a company that they work for. And there's lots of them. No, they don't go on the news. No, they don't go on Oprah Winfrey. No, they don't go on Jim Cramer. You never hear about them because they're too busy making money. They don't share their secrets. They don't share their strategies. Proprietary and professional pro traders are mostly on the buy-side institutions, and banks have they have floors full of traders. And I've been on those floors, and it's very interesting to see what they're doing. Now, the banks are struggling because their pro traders want to work from home, and the banks say, no, you have to come back to work. And the professional traders go, well, if we have to come back to work instead of being able to work from home, so we don't have to help your junior traders because we're tired of babysitting the junior traders, we're senior traders, we're the best in the world. So they become independent pro traders. So we've had a surge of more independent pro traders, which is awesome because you can track their activity. Corporations haven't been doing buybacks. They had a massive buyback between 2018 and 2020. And when they do buybacks, and there's talk that they're going to be doing buybacks again in 2023, so we can expect some nice runs from the buybacks. They're going up because buybacks are intended to move the price up. Corporations also invest in IPOs and smaller companies, not always to take them over, but sometimes to take them over. So they do not trade themselves. They don't have professional traders on staff. They either, for their buybacks, they use sell-side institutions to do the buybacks, their bank of record, or corporations go through the buy side and can buy through the buy side institutions, some activity there as well. High frequency trading firms are the HFTs. They are maker takers or market makers. The oldest ones from the early days are now their status is market makers. So they make the market whenever it's going to go down, and they sell short before the market opens, establishing a position, and then they buy to cover to slow the selling down if it's a panic sell. High frequency traders that are maker takers are early morning, pre-market. They gap the market up or down. Your small funds are all kinds of things all over the world. We have sovereign funds trading on our market. We have nonprofits. We have foreign funds. We have smaller funds. Any fund under $3 billion, that's a B, $billion, is no longer considered a professional side. The SEC decided that these smaller funds were actually retail because they don't have the credentials, they don't have the knowledge base, and a lot of them are actively trading their accounts and they're losing money right and left. A lot of them are trying to trade against the hedge funds or with the memes groups and whatever. So these smaller funds are no longer are required to do their quarterly reports as the buy-side institutions are. So they're considered retail, but I still have them as part of the 80%. 80% of the market is controlled by these groups. Retail, individual small lot, and odd lot investors, 20%. You are trading with these groups. I can guarantee it. Unless you're a TechnoTrader student, you are trading with these. I want you to trade with these groups. I want you to trade when the corporations are doing their buybacks. I want you to trade with the pro traders. I want you to get in with the buy-side institutions for your longer term holds. I want you to just watch the high frequency traders move it up and be a very happy camper. So market condition analysis. Market condition analysis. Most traders who are not my students assume I am talking about market breadth or market indicators. I am not. Market condition analysis is my own creation, and I have not gone public with it. It incorporates quantitative and relational technical analysis and a screening process of all stocks and derivatives traded at that time on every single day. Market condition analysis is able to reliably indicate where dark pools are active, if they are buying, also known as accumulating, or selling, also known as rotating, to lower inventory or distributing because of redemption demands. When dark pools halt their activity, which is also known as a market void. So I have 7 explorations that do this work for you. How many stocks are moving with strong momentum to the upside? How many stocks are moving with strong momentum to the downside? This gives me the bias of the day. Are the large lots and professionals on the buy side or the sell side? How many stocks are being quietly accumulated by institutional investors using dark pools? This tells me how active they are or if there's a void. How many stocks are in bottoming formations? This tells me market structure. How many stocks are in consolidations? How many stocks are overbought in trading range patterns, which would turn down? And how many stocks have platforms that are slowly trending upward? This gives me the market condition as well as the market condition of what market condition we have. So this is an example of your market condition analysis MCA explorations that come with the Technotrader methodology course, and it's just awesome. You can see that we have the these are all the market condition analysis. This is the numbers for the day. This was the results for the day. 7,733 stocks were analyzed, and it gives us an idea of where we are. And I can analyze this, and I give this report out every morning. And students learn how to do this for themselves. And it also shows the ranking of that company. And you have a list of stocks that you can trade from with specific buys and entry signals with confirming indicators that help you trade every single day that you wish to trade. So market condition tells you who is in control of price. Is it dark pools? Is it HFTs? Who's controlling price? What technical patterns are most prevalent at that moment? How price will behave at resistance and support. If you have a bottoming market condition and you have dark pools that have been accumulating and they pause that accumulation and pro traders have taken over, what's going to happen? Anybody? You have a spring and suddenly it's released. You're going to have the bottoms have blasting momentum and velocity runs. What trading styles will work best? You know, are we swing trading? Are we position trading? What do we need to do? What entry and exit signals will work ideally? I can tell you that certain market conditions are ideal for certain springboard or resting day patterns, and other are for different kinds of entry signals. What indicators to use? We have the 5 leading indicators that I teach, and they're all based on following what's going on the buy side. Most of the time, that's what my students need. What we do is we tweak the period settings for different trading styles. Market condition analysis also reveals which market participants are active at this moment, which market participants are sitting on the sidelines waiting, which group is dominating the price action, how does price behave when that group is in control of price, and how does volume react when that group controls price. These are all important information, because when you have this information, suddenly you look at the chart, and if you're a musician, you would go, oh, this is sheet music. Or if you were a programmer, you'd go, oh, this is code. Suddenly you can read it. Profit zone. Each market condition has a different type of profit zone. There are 6 different market conditions: bottoming, trading range, platform, moderately trending, velocity, and topping market. Moderately trending up and velocity up and down. This is just up to down. This is down to up. This is a wide trading range, and this is your platform that dark pools usually create. Technotrader students learn these market conditions and how to find dark pool buy zones in each one. This enables them to buy with the pro traders for easier trading, higher income, and less risk and stress. You can learn every strategy there is on stock or option trading. You can learn every indicator, candlestick, buy or sell short signal. You can take every seminar, webinar, and read all the information available for free on the internet. But you will not be as successful as you deserve to be until you understand the catalysts behind the technical patterns you're trying to find and trade stocks. The catalyst behind sudden price action is most often dark pool activity that began several days to weeks before the sudden momentum run and gap up by HFTs. Momentum develops due to underlying giant lot buying, which removes liquidity slowly and incrementally over time, causing a compression pattern. Accumulation is a slow process. This requires spatial pattern recognition skills and hybrid leading indicators defined. So I want to show you, this is dark pools moving it up a little bit. Then you have your momentum runs. You have your small activity, small funds and retail scared money with the wicks and tails. I'm scared, but I get 10 cents on the dollar. Okay. Retail scared money, and then HFTs gap it up. So you have activity that is going on that is hidden. And by analyzing the indicators and analyzing the price action, you are able to determine who's in control at that price and when you should get in earlier so that you can ride the runs up, and earlier so you can get into this professional trader entry signal at end of day, and then allow it to run up and gap and sell with the HFTs. Shift of sentiment is a specific pattern from the TTQA indicator. This indicator was written specifically for MetaStock users by TechniTrader. TTQA defines when a shift from large lot selling to large lot accumulation starts. It is seen in both candlestick patterns and how the short-term bottom is formed with a shift of sentiment pattern and hybrid indicators. HFTs search for the dark pools giant share lots hidden on ATS venues. Often the HFT automated trigger order accidentally trades against the dark pools. This happens. This creates a temporary one-day sell down, which reverses the next day. A volatile price action is called by HFTs, not dark pools and pro traders. So if you have a whipsaw day, you'll be able to see why on the charts, and you can avoid it in the future. The shift of sentiment occurs prior to the HFT tree run, always. Candlesticks appear volatile until you learn what to look for in price patterns. Momentum runs are created by dark pools' hidden accumulation as liquidity draw begins to impact price action. A higher buy zone will then form. So this is a shift of sentiment pattern right here. They're selling, and then there's a quiet accumulation. These are smaller funds capitulation, and then there's a small buy zone right in this area right here. And this is what we teach you to find. And then there's a setup here for the stock to move up, and it did today. HFTs are just the opposite of the dark pools in terms of price action and candlestick patterns. HFTs are trying to force price to move quickly and in large volatile or velocity intraday patterns. Gaps are far more prevalent in recent years than in prior decades. Huge gaps and extraordinarily long candles are the primary candlestick patterns from HFTs. So when you see that, it's not dark pools. Smaller funds, as well as retail traders and investors, often chase HFT activity without realizing it. HFT candles are typically 1 day or 2 day events, usually just 1 day. Market condition analysis report and market open report. I write these reports every day. Market analysis, what is going on with the indexes, what is going on with the rest of the broad base of stocks of some 7,000 stocks. Market condition analysis reports the 7 explorations, all of the different explorations that I talked about earlier, and then I am able to assess what's going to happen and what the analysis is. Are we going to be biased up, down, neutral, or shifting? Are we going to have strong or weak short-term runs? Because if you're a swing trader, you don't want to enter if the energy is too weak. Trading conditions, who's in control of price and who can do that? Morning open report, I look at the stock index futures. That only tells you how the market's going to open. My bias and energy and analysis tells you what's going to happen for the rest of the day. And I also provide professional side pre-market and retail pre-market activities, because a lot of my students want to know what's happening on the professional side. How many millions of shares of stock are they moving in Apple or whatever? Technical analysis chart of the day, I always provide one chart that's an example of patterns for my students to study, and a chart analysis of a stock that I'm probably suggesting consideration of a watch list or something that's specific about a pro trader setup so they can study that. So, and I also include the professional news in my reports so that my students know what's going on the professional side. Because if you don't know what's going on the professional side, you rely on the retail news. Don't rely on the retail news. It just creates emotions. It just creates random decision-making instead of proper decision-making. And weekly, I tell you what the flow of funds report said. Last week, it said 35 billion moving into money market funds, which will be placed this week. And so we can expect a little upside. So Dark pool buy zones, the liquidity draw on the dark pools creates its own internalized momentum. Price stays in the buy zone area, controlled by the highly sophisticated order types used in dark pools. Then suddenly the stock gaps up or runs with huge momentum. Most swing traders miss these opportunities because they don't know how to recognize and use them. Learning to identify these patterns before they move up is important. The key element to high profit trades, low risk and less work. So we have dark pool buy zones. We have a pro trader. It gapped down and then it moved up. That's a pro trader activity. Get in here and then wait, or you can get in here with this pro trader setup and then run up. But once it's up, you got to get out. Pro trader setup, up and get out. This webinar is just a snippet of the training TechnoTrader courses teach. Our education is unlike any other. We are credentialed professionals and with an educational background. If you do your homework, you will find this is very, very rare in the stock trading education business. What you already know is a great beginning. Are you ready to take the stress and frustration out of trading while increasing your profitability? Trading dark pool buy zones is far superior to anything you have ever learned before. So you can use what you've learned, but let's make it better. Take your trading to the next level. This is a professional trader's 6-panel trading. That's what they do, 6 or 9 panels nowadays. So I just thought you'd find that interesting. Okay, you want to visit TechnoTrader courses. We have these little mini courses that you can take that show you how our training works on our student site. We have a site for people who want to know about TechnoTrader, and then we have our hidden student campus, which is only open to students. And it is full of all kinds of information, but you can take any of these mini courses. You just click on, go to technotrader.courses, and you can just start watching any of these, and they're just a lesson format, so you can see how it works. And for our webinar special today, we have it available till November 14th. This is a $99 course. We're offering it for free. You use the MetaStock-NOV 2022. Apply that coupon as your checkout, and you can have free access for that course for 1 week. And that goes into the high frequency trading, which I talked a little bit about today, but it will expand on that knowledge. So everyone has an opportunity to take advantage of that. So I'll take any questions the last couple minutes that I have. I'm trying to stay on task. Jeff?
Sorry, Martha. I'm trying to type this link so that everybody can have it. But we do have a lot of questions. The first one that I'm going to ask is one from Brian. Brian wants to know why the SEC allows dark pools to exist.
Dark pools allow them to exist because before that, the SOS bandits were front-running the institutions who can manage and control all of the 401ks, pension plans, and all the long-term investments. They are the fiduciarily responsible entities for the great wealth of the middle class of America. And if they're front-run constantly, then their orders designed to buy a price at a fundamentally solid price level or price range for that particular stock was being front-run all the time. When we went to from fractions to decimals, I don't know if any of you were around in those days, but if you were, the spread shrank dramatically. So that became a problem for the dark pools. The SEC approved the alternative trading system venues for them in 2002, along with the decimals, which Congress enacted, not the SEC. And it has made for inefficient markets in the way that it's too efficient. So the dark pools are hidden there so that they can transact their business fundamentally solid price range and not be front run, so that the other traders and retail traders and memes groups can't take advantage of their large lots, which they could before. It is a way of protecting the middle class wealth of America, and it's very important that they keep on there. So the SEC has watched it. They don't get a better price. They're not getting a better price. The SEC has followed this for years. They set it at a penny spread, and they wait for the price to move into that zone, either up or down, and then they strike the penny. So they are not getting a better price than you, and that's why the SEC allows it. Next question.
Okay, yeah. Mark would like to know if this works for any international markets. Actually, I'm sorry, Stefan would like to know if this works for any international markets.
It will work for your larger markets. It will work for Hong Kong. It'll work for Singapore. It'll work for the London markets. It'll work for the German markets, any of your larger markets. If the market is really small, you have to remember that the US stock market is the largest in the world by such a huge amount. If you took all of the other stock markets in the world and put them all together into one stock market and compared it to the US stock market, we're still much larger. So you need to pick any of those markets that are fairly good sized for not compared to the US, but compared to the rest of the world. Yeah, any of those will work.
Perfect.
Because our institutions are buying their stock and making them into ETFs or putting them into mutual funds for you. Yeah.
And Mark actually wanted to know if it would work with ETFs, like
yes,
DIA
ETFs,
and SPY.
Yes, it works with ETFs. But remember, with the ETF is based on an index. So what you need to follow is TTQA very carefully, because the price is not important on the ETF. It's whether they're accumulating or not that will cause the index to move up or not, because the index and the ETF are in sync with one another. They're married together. If the index goes up, the ETF must go up. So they'll buy more shares of stock to fill those ETF units. If the S&P 500 goes down and it's an ETF based on that, like the SPY, then they have to sell some of those shares of stock, and so to adjust the ETF. So the ETF will always follow the index. So what you need to do is, if you want to trade ETFs, especially the Qs and the SPYs and the DIAs, diamonds, you want to understand the index value fluctuation that is going on, and you can also use those indicators with the indexes. Yeah. All right. So that's how you do it.
We're running out of time, but I think we have time for one more.
Okay.
Can we apply this knowledge to Forex trading?
Forex trading is a totally different market. You can, but always remember that Forex has layers of the market. So what you trade on is the retail side, and the banks are trading on the other side. So it's a different analysis, and if you need to structure your interpretation slightly differently. Yeah.
Another question, same vein. Will it work on futures for Tom in YouTube?
Yeah, they will work on E-minis, yeah.
Okay. And would you recommend it indirectly for options? In other words, finding the underlying. David wants to know. I know. Yeah, I promised one question like 5 questions ago.
Yeah, I always tell my options traders, watch the stock and watch the TTQA and all our other indicators. I just showed you the one because I didn't have time. As you know, I'm going over. I'm so sorry. Yeah, then you can choose the options and the option contract that you want. The stock drives the option, not the other way around. I have a friend who's an options market maker, and she would laugh because people would try to say, well, the option market knows that the market is going down. She says, no, that all those puts that buy puts that the professionals are buying, that's because they have a 5 million swing trade on this stock that you picked for me to trade, Martha. And I said, oh, really? She says, yeah, there's all these puts. So that's their insurance policy. So if you see a lot of puts out there, large puts, that's insurance against a huge buy order. That's not the options market thinking the market's going down. No, that's professionals insuring their 5 million dollar order on the buy side. So there's things to learn about that.
Perfect. Thanks, Martha. I want to encourage everybody that's in the room. I've typed in the link in the chat, but go to technotrader.courses, apply the / how to exploit high frequency trading. Just click on the link, put in the coupon code, and make sure to get that free access to that course. So thank you, Martha. Really appreciate it. So awesome that you're able to step in a little bit early. I do appreciate that as well. You're great job today. I appreciate it.
Thank you. Bye-bye.
Bye. Okay. All right, there we go. Let me go ahead and just take control real quick here. Make me the presenter. Show my screen. And we'll say thank you to Stocks and Commodities Magazine. Stocks and Commodities, as I've mentioned a few times already, has been great sponsors and supporters of the trader summits and the conferences that we've been doing for over a decade now. And actually, I don't think it's over a decade. I think it's 9 years. So maybe I'll wait until next month or until January, and then it'll be officially over a decade. But they've been such avid supporters and sponsors of all of the events that we do. They've done 17,000 trading articles, 1.3 million subscribers. They've been making it since 1982. If you do an extended trial for $69 today, you can get 5 months of Stocks and Commodities just thrown into that. If you spend $300 or more, you'll get a 2-year subscription just as part of it. And we don't actually pay for that. That's given to you by Stocks and Commodities Magazine. So really appreciate the work that they do with us. Of course, we're MetaStock. You know, we've been talking about MetaStock all day, but it's been rated by the readers of Stocks and Commodities Magazine #1 for 29 years in a row now. We've talked about how it can help you do scanning, test market ideas. Scott Brown showed the forecaster and the patented forecaster early. All of that starts, if you're here in the US, it actually starts at about $69 per month. We're going to give you a buy one, get 3 free. And you can do that at metastock.com/conf promo. You can do that at metastock.com/sales chat, or you can give us a call at 800-882-3040. So, Kelly, what I would like you to do, Kelly, is I need your help with picking out another winner of a prize. Are you ready?
Oh, I am ready. Let's do this.
All right. So what I need you to do for me is to pick out a number anywhere between 1 and 9,419.
5,807.
So 5,807.
Yes.
Do you remember how I used to just scroll and scroll and scroll
yes,
through the Excel spreadsheet? I found a much better way to do it because I can tell you that actually you just type in A and the column name up in the top left, and it'll just take you straight to where you're going. So this is the winner of this prize is Mr. Simmons. I believe it's Mr. Simmons. I just have a first initial of B. But shall I tell you what he won?
I would love to hear what he won.
This one's kind of interesting. This is a cool one. So we're going to give Mr. Simmons a free copy of Norm Hallett's Disciplined Trade leather-bound gold leaf journal.
Oh, shoot.
It's a value of cool. It sounds cool, right? I had to go look at the image, and I wish I would have put it in a place where I can put it on screen real quick. But it does sound pretty cool. And I actually wonder if you'd notice if I was a winner too. Anyway, no, it's a cool prize. It's a Golden Boss journal. It's normally $129, and I'll reach out to you with how to claim that prize directly. So we'll look for an email from me, and we'll kind of get that out to you. So there you go. The November code does not work. MetaStock-November 2022 deal. If that's not working, I will get you the support email for Technotrader. So there you go. Any case, this is not our next presenter. That was our but he's coming up. I hear he has power. Our next presenter, though, is Dr. Barry Burns. Dr. Burns has been working with us for a number of years. I like his 5-pattern methodology that he uses. I like his analogy that he takes the stocks that he's interested in trading to court. I love his backstory. And if I keep going, I'm going to give you his whole presentation. So I better save some of it for him. But Barry, it's good to have you on here today. I'm going to go ahead and make you the presenter. How are you doing?
All right, I'm doing great. How are you doing, Jeff?
We're doing very good.
There we go. How's my audio now?
Sounds great.
Good. All right, let me see if I can bring up my appropriate window. Let's try that one. Oh, that looks weird now. Okay, let's try that one. How's that look? Can you see the slide?
We can see the slide. It's in the presenter view, and I don't know if that's just because you haven't hit go or whatever, but we can see your slideshow.
Yeah, but you see more than the slide?
We see the numbers like 1, 2, 3, 4, 5, 6, 7, 8, 9. Like you haven't started the slideshow basically.
Oh, okay. Let's see. I switched over to, let me refresh it here and see if that helps. Okay, how about that? Didn't make any difference?
I don't notice a difference, no.
Oh, it says screen sharing is now paused. Oh, okay.
Okay, good.
Let's try it again here. So I think that's the, oh, I see. It went to this. Yeah, it keeps going back to,
just click on the little drop arrow and change the screen itself, but don't hit the play button. That pauses it. It's weird, but it's the way GoToWebinar works.
Oh, on GoToWebinar?
Yeah, and in GoToWebinar where it says show screen, click the down arrow there to pick a screen, but don't hit pause.
Okay. Hold on, let me do this. So go there. People can see your screen. Click to stop screen sharing is what it says now.
Have you, in the slideshow, have you just hit, have you started the slideshow? Because I can see the slideshow, I just don't, I see the outline of it too on the side.
Right, yeah, if I go down here to click to start the slideshow.
I think that's all we need to do.
Okay, I did it, but it's not showing up.
No.
It still shows the same, right? That's because it says it's paused.
Oh, yeah. Okay, so click on the, where it says show screen under the sharing option of GoToWebinar, click on the, it'll either be a pause button or a play button. It's right above where it says show screen.
Yeah. And when I do that, it goes, then it makes, then it makes PowerPoint go back into this mode and it stops that mode. That's weird.
Let me do this. Yeah. I understand what you're saying. I'm going to make me the presenter.
Okay. You know what? I think there's.
Okay, and then I'm going to show my screen. Now I'm going to have you start the slideshow.
Oh, okay. It started.
Okay. Now I'm going to change you back. Sometimes you have to do weird stuff to make this work. Now I'm going to have you share your screen again. It's still in the stupid presenter view.
Yeah. Okay, let me try it a different way. I think I get an idea here.
Okay.
Let's see here. Show application. Okay. Show just a window. Maybe if I show the monitor. Let me try that. Change it to monitor instead of showing the application.
Okay. Stop touching it. It worked. Now go to the next slide and let's make sure we don't run into like the present. Can you just go advance one slide for me? Okay. Well, you're good.
So that was it. Okay.
Cool.
Yeah.
I'm out of your way. It's your turn.
Oh, let's make sure that we really mess up technology here. So let me see if I can show my webcam.
Yeah.
Good.
I can see it.
Yay.
I can see. I'm trying to read all the book titles back there.
Hi, me. Okay. Well, that'll take you a good 45 minutes.
All right. It's all you. Your turn.
Mostly comic books. Okay. I'll make sure I still finish on time, though. So, all right. So, hey, welcome, everybody. Thank you for hanging through the technical difficulties there. Appreciate it. So today what I'm going to talk about is, let me bring my slide or my presenter thing across here under the camera so that I'm at least somewhat looking into the camera. So yes, as you see, trade timing strategies for entries and exits. Going to focus on that. Just a little bit about me. I'll make this quick. So there's my ugly mug. I'm Dr. Barry Burns, owner and founder of Top Dog Trading. I'm a published author. Wrote the book Trend Trading for Dummies, published by Wiley & Sons. And our good sponsors here today, Technical Analysis of Stocks and Commodities Magazine. Highly recommend the magazine, by the way. I've been a subscriber since, long time, and I love the magazine. Look forward to it coming every single month. And also just happen to continue to receive Reader's Choice Awards from their subscribers, and very happy for those. And I've helped other authors write books, work with a lot of different exchanges, etc. There you go. I'm not going to spend too much time talking about myself today. And since we're in a multi-speaker event, I'm sure some of you have seen this legal disclaimer before, but people tend to come in and out for different presenters, and so I want to show this again. Very important. Highly, highly, highly recommend you read it. I'm not going to read every word for you, but just, you know, I know a lot of people don't read them because they think, oh, it's just legalese, but think of it as your education, because really that's what it is. It's there to protect you. It's there to be the foundation of the rest of your trading education. So very, very important. In fact, think of it this way. We're required to post this before our presentation. So that should show you how important it is. And really another way to look at it is keeps you away from the hype of trading, because unfortunately there is a lot of hype in this industry, and it keeps you rooted and grounded in the realities and what to expect. So I've got this timed out very well, so we're going to be fine with our timing, even though I got started a little bit late. No worries there. But I want to make, since I'm live here with you, I want to make this as personal as possible. And even though I have a pre-prepared, is that a word? Good thing you don't have to know English very well in order to trade well. Even though the presentation is pre-rendered or whatever, I can still modify it for you as an audience. And I do that by spending more time on certain topics, less time on other topics, depending on what you need for your trading. So I really want to be here. Each audience is different, and I want to be here to help you with what you need. So if you would, type into the questions box, what are some of the problems and struggles that you're having that you would like help with? Okay. So go ahead and type those in. That's not a rhetorical question. Very, very interested to see what you are struggling with and what you'd like help with, so that I can give you some real specific help. And hopefully here in 43 minutes, you'll have some solutions to some of the challenges that you're going through. All right, let's see. Not seeing any questions come through here yet. Let's make sure I'm looking at the right place. I think I am. Oh, that's just chat. All right. Okay. Not seeing anybody. Wait, I think I am seeing something change here. Let me look over here. There we go. Okay. All right. It just, you know what, there might be a little bit of a delay here. So that's it. All right. So thank you, my friend Augustin. Did I pronounce that correctly? I hope so. Committing to one trading system. I get it. That's, yes, that is a common issue. In fact, I had that one myself when I was in the early years of my trading. I belonged to a trading club, and we had different speakers come in every other week, and every one of them seemed great, and they would teach us their thing, and I would try their thing for a couple of weeks until the next speaker would come, and then I'd try theirs. And that's a really, really good one because, you know, it takes time. I mean, again, anti-hype here. It takes time to really learn how to trade. And if you keep jumping from one system to another, to another, to another, you're not giving yourself time to really learn that one. So fully appreciate that. Michael, time to entry, time to exit. Perfect. You're at the right place then. We're going to help you with that. Wendy, I have a hard time letting go of bad trades. Yeah. So these are all common issues. And that's one thing to take out of this is please understand that what you're typing in here is not unusual. You're not an unusually bad trader. There's nothing wrong with you. Sometimes people think that, but you know, and those of you who are not answering, I'm sure there's a lot of you who can resonate with these answers and say, oh yeah, that's me too. Yep. So, right. Having a hard time letting go of bad trades. Good one. Oh, Q says tops and bottoms timing. Oh, okay. Timing. Yep. We're going to talk about that as well. All right. So thank you very much for participating there. It looks like we just had a little delay. We actually did a survey on this a number of years ago and surveyed thousands of traders. And then I collated the responses and put them into categories. And here's what they came back. The top problems, struggles, frustrations people were having was, Alfred typed in another one here. Help with understanding which time frame to use when. Oh, Michael, capital management. Okay, now they're coming in. So I guess we were just having, like I said, time delay. Well, here are the most common ones. they came back as a result of the survey, which was very, very a great sample of traders. So, and I kind of put them together in general categories, as I said. So here's number one. People would say, well, I enter the market. So let's say I buy, and then I get stopped out right away. And then right after I get stopped out, the market goes back in the original direction of my trade. Very, very frustrating. So I got my professional education at the Chicago Mercantile Exchange, and my mentor there, I remember the very first day of my mentorship with him, and he said, Barry, retailers are often right, but at the wrong time. And this is exactly what he was talking about. So another one, getting out of big moves too soon. So, well, there you go. All right, who mentioned that? Wendy. Or, oh, no, it's the other way around. Okay. So there you go. That's the other side of it, right? One side is letting go of losses soon enough. The other one is, oh, I'm in a winning position, but I'm getting out too soon and not making the big profit. So that's often a common one. Getting stopped out too often. Not knowing the best place to exit the markets. A couple of you referenced that in different ways. Trading a trend that doesn't follow through. So you see a trend and you're like, okay, market's going up. All right, boom, I buy. And then it seems like just about the time that I buy, well, that's exactly the time the market decides to turn around and go the other way. Almost like someone's looking over your shoulder and saying, oh, Zanabu just got in. And so let's call the exchanges and tell everybody to turn the market around. Okay, Tom getting written. Now we're getting all kinds of them. Thank you, Tim. Rolando, David. Okay, so lots of them coming in now. So anyway, these were the top 5. Now, obviously, there's many more, and some of you are typing in others, and I appreciate that very much. Thank you. But these were the most common ones. And so again, if you are having any of these problems or any of the other ones that are being typed in here, take this as evidence that there's nothing wrong with you. You're not uniquely bad at trading. These are common issues, and I myself have had to work through every single one of these issues. And the good side, or the good part of this, is there are answers to every one of these problems. So keep hope alive, because all of us who are professional traders, we have worked through these issues and come up with solutions. So my trading methodology, as briefly was mentioned, and I'm going to go deeper into it now, is I'm looking for measuring the energies of money flow in the market. So I refer to them as energies. So, and to me, it all comes down to follow the money, honey. Follow the money. So more than what's announced on news or the people on the entertainment financial shows or whatever. And some of them are actually very smart. But what moves the market is ultimately the money, for whatever reasons, because there's going to be reasons. There'll be catalysts, there'll be news, there'll be rumors, there'll be gossip. But I just want to follow the supply-demand imbalance. That's what I really want to follow. So the 5 energies that I look for are, number 1, trend. You might want to write this down. This is an outline of my entire trading system. So trend is the first thing I look at because, well, it's binary. It's either up or it's down, or it could be sideways. So if it's sideways, I don't want to trade. So there's not going to be a trade. So if I'm going to trade, I either want to be long or short, bullish or bearish. And so that's why trend is number 1. Number 2 then is the strength of the trend. Now this addresses issue number 2, or issue number 2 was, how do I know if the market's going to follow through? Trading markets that don't follow through, trading trends that don't follow through. Cycles is energy number 3. This addresses the issue of timing your entries, your tops, your bottoms, when to get in, when to get out. A lot of different comments about that. The 4th energy is support resistance. So support resistance levels, we're all familiar with those. Floor trader pivots, Fibonacci levels, previous swing highs and lows, whatever they might be. I consider these an area of a potential blockage of that energy. So you've got demand coming in, buy, but then you see a price level that everybody is aware of. And now the market participants think, I don't know if I should keep buying because in the past, this is where the market kind of topped out. And so then you get less buying potentially. And the fifth energy, and perhaps the most important, is the fractal energy. And this is what I refer to as multiple time frames. And we did have somebody talk about that, choosing time frames. So very good, excellent, very important. You are 100% right. So that is energy number 5. And I use that as a filter. And by the way, I go through these all. In fact, when people take my course, at the very end, if they learn everything, there's just a 5-step checklist. And that's it. Half a sheet of paper, 5-step checklist. It's these 5 energies. Just go down, check them 1, 2, 3, 4, 5. If you got all 5 bullish or all 5 bearish, you take a trade. That's it. So now we need instruments for measuring these energies because, well, who's to say what trend is? Who's to say what momentum is? Who's to say? So I don't want to trade by gut. I don't want to trade by emotions. I want objective, rule-based trading laws. And I want them to be measured mathematically. So the instruments I use are all very simple, by the way. I don't use any proprietary indicators. You don't have to buy any proprietary stuff from me. So for trends, and by the way, I've purchased a lot of it. Some of those proprietary things are actually very good. So I'm not saying they're not good. It's just that I just like to keep things simple. So for trends, I use a moving average. Specifically, I use the 50-period simple moving average. Is that enough to make money with? No. But we don't make money with just one tool, one indicator, one moving average. It's 1/5 of the system. And so it starts moving the odds a little bit, like 20% in our favor, but I'm not going to trade with 20% in my favor because that's still not a high probability trade. It's one piece of evidence. Then momentum, I use a momentum indicator. Okay, genius, right? Rocket surgery here, folks. Okay, then number 3, cycles. Now here I use an oscillator, and I will show you how to get that for free here at the end. Everybody can get that. Support resistance, the usual suspects again, nothing proprietary. Previous swing highs, previous swing lows. You can use Fibonacci, floor trader pivots, whatever you want. And then fractal energy. Now this one's a little more specific. So this is multiple time frames. So I'm never trading with just one time interval. Now I do day trading and I do swing trading. And you can use a lot of different time intervals. There's no magic time frame, but you want to make sure that within that time frame, there's at least enough liquidity to get filled well, get a good price, and not get too much slippage. So that's the key. But you don't want it to be so fast that you can't mentally keep up with it and enter your trade without having enough time to analyze the trade effectively. So now, I set my time frame. That's the trading time frame. That's where I'm looking for my patterns, whether it's head and shoulders, double tops, wedges, trends, etc. And then what's really critical is I look at a time frame that's 3 times that length. So for example, if it was a 5-minute chart I'm trading, then I'll look at a 15-minute chart as my fractal chart. I like to call it my confirmation chart. And that 3-to-1 ratio is very important. Because if you make it any more than that, then whatever you're comparing on that longer term chart, it's going to be lagging too much and will not inform an immediate decision on the short term chart. So we do this all to establish probability scenarios. So very important that you understand in trading, there is no certainties. We never know what the market's going to do. In fact, one of my favorite slogans, I don't know where this originally came from. I heard it in Chicago. I'd give attribution to it if I knew who originally said it, but the word that I heard around there was the market can do anything at any time. And I have learned that the hard way. The hard way means losing money. And it is very true. Regardless of what my technical analysis says, what CNBC says, what my best friend says, what my, the greatest trader in the world I know says, regardless of all that, the market can still do anything at any time. Very important to have a proper perspective on the market. The market is not a tame purse puppy. The market is an untamed, wild beast. You never control the market. So what I do, my approach to the market, again, is perspective, which is very important because having the right perspective then determines how you trade. So this is where, by the way, some people who are A personalities. I'm not saying this is true of all people. It's definitely not true of all people, in fact. But sometimes people have A personalities, very domineering personalities. Some people have been very successful in business. I find that they have a very hard time with trading effectively. And I've trained over 20,000 traders now, so I've got a lot of experience. And so they're very successful in another area of life where they were the boss. And so they, for some reason, think, oh, well, I'm successful at business, so I can be successful at trading as well. But trading is a very different animal. I'm going to carry over that analogy because you're not in charge. You can't make anything happen. You have no employees where you can make things happen. You can't wheel and deal. So the market is it's more like surfing. They're big, huge waves. You're not going to control those waves. And of course, even in market terminology, we talk about price waves, Elliott waves, things like that. So now that I think of it, it's actually a pretty good analogy. And that all that money, again, it all comes back to money. The money flow of those waves, it's going to happen. And I can't control that. And I can't fight the current of currency. God dang, I'm coming up with some good stuff here today. Thank you for that. The current of currency, I can't fight it. I gotta be like the surfer who goes with the flow. And it's another analogy that I have used before. It's like dancing. Okay, and we're just gonna follow the partner. And together, we move beautifully together. But if you fight your partner, then it's a mess. You're stepping all over each other's toes. You get hurt toes. You get broken nails, and it looks clumsy and it's horrible. Or another example that I've used in the past, because I do martial arts, is Tai Chi. So I love Tai Chi. And as I've learned to actually do combat Tai Chi, you're flowing with the energy of your partner. In fact, we don't even call them enemies. We call them partners. Even though the person's trying to hurt us, we're just flowing with their energy. And that's what trading is like. And so so the proper emotion, now when you talk personal attributes of trading, is not fighting. I know people use analogies of fighting for trading. And I don't think that's really the proper mindset. The proper mindset more is one of harmony and understanding that the market's going to do what it's going to do. And when I say the market, I mean the market. It's international. There's all different institutions. There's sovereign funds. There's mas and pas. There's hedge funds. There's all these different things, and all over the world, all different data speeds. People trading all different time frames, trading all different theories and concepts. And we're not going to be aware of all that on the micro level. So the best we can do is just take it at the macro level and see the big waves of the money flow and go with the flow. So it's very much like the wisdom we apply to life. Go with the flow. The things that we cannot change. You can't change the market. Okay? So how do we do it? All right. So now that I've given all my little philosophical preaching, how do we do all of this practically? So we know that the market can do anything at any time, meaning there is no certainty, meaning you should never say, oh, I can't believe the market did that, or the market shouldn't have done that, or that's not what's supposed to happen, because nothing's supposed to happen. We're trading probabilities. So one more thing I just want to say. One of my favorite trading psychologists said that he defines trading as managing uncertainty. I love that, managing uncertainty. So we're trading probability scenarios. So how do we determine a probability scenario? Well, I've already alluded to it. At each entry point, I ask myself how many of those 5 energies I previously listed are aligned, all being bullish or bearish. And I give each trade up, or get each set up a score of 1 to 5. Okay, higher the score, higher the probability. Make sense? And I liken another analogy. I love me some analogies, as you could tell. So now, and I love mixed metaphors. Oh, I'm the master of mixed metaphors, the triple M. That's me. Just call me triple M, master of mixed metaphors. So now we're going to use another one, taking each trade to court. So I look for these 5 independent witnesses, each one of these 5 energies of money flow, which are all, and this is the key point though, independent. That's the operative word of this statement. Each one of these aspects of money flow is uncorrelated to the other 4. That's a core part of the system. So if I was using like 5 trend indicators, that's no bueno. That's not what we're doing here, because that would be like saying, well, back to our analogy of the court. Let's say somebody is accused of stealing bananas, and they get some witnesses up there, and one witness says, yeah, no, he didn't steal the banana. All 5 of them say he didn't steal the bananas, but those witnesses are his girlfriend, his brother, his best friend, his cousin, and his mommy. Okay, so those are not independent witnesses, right? They all have a relationship to that person. They all don't want that person to go to jail. So, did he steal the banana or not? We're not sure. But if you had 5 witnesses who did not know the accused, and those 5 witnesses did not know each other, and they all say, yeah, I saw the dude steal the banana. Well, the guy is probably going to go to banana jail. Okay, so that's the key here, is you can't just choose any 5 indicators or 5 moving averages or 5 anything. You've got to really know what these things do and what they are. And again, mathematically, by the way, what is an indicator? An indicator is a mathematical function. And so that's what's important to remember. That's why it's subjective and rule-based, but you got to know what it means and how to read it and understand it, and when it's useful and when it's not useful. Okay, we don't have the time to get into all those details today, but that's absolutely critical. And again, that's the anti-hype. You can't just, one of the ways I see people trying to learn to trade is they just take a chart and they'll put an indicator on there, maybe a couple of them, and see, well, which one seems to work the best by just eyeballing it. And then they'll switch out one, put in another, switch out one, put out another. It's crazy. Okay, that's not how trading works. So we need 5 independent witnesses to establish a preponderance of the evidence. Then we take the trade. Then we have a preponderance of the evidence. The odds are on our side. We have a probability scenario, but the market, and I don't even like to say we could be wrong. I almost said that. It's not that we're wrong. It's just that, well, the market didn't follow through this particular time. And so as part of a system, a trading system does not just mean you've got some indicators and some moving averages and you're looking at candlestick patterns and maybe volume or whatever you put on there. That's not a complete system. Complete system includes money management. Your money management rules should make it so that you mathematically can never blow out a trading account. When somebody tells me, oh, I blew out my trading account, I know they weren't trading a system. Because a system, and they weren't trading it. Maybe they had it, but they weren't trading it, because a trading system has a built-in money management program that'll mathematically get more and more conservative so that you cannot blow out your trading account. And of course, risk management is a subset of money management. So we have a place for our protective stops, trailing stops, targets, all of that. Okay, and hedging, by the way. So our last presenter talked about options. By the way, I love what you said there. Thank God. By the way, she did a good job and she said some great things there, but it is absolutely true. The people who trade options before they learn how to trade stocks or FOREX or futures or whatever, I think that's a huge mistake. I think it's very, very important to understand the underlying market. Let's say it's a stock, because that's what moves the options, not the other way around. So very, very important. And I trade options pretty much every day. I teach options very much. And our first step is always, let's look at the overall market, and then let's look at the individual underlying. And then that informs us to go look at the options that we want to trade on that, if we want to trade on them. Anyway, a little off track, but I was just so excited that she said that. Okay, so now let's put it all together. So now you've got all the concepts, all the theories, all the philosophies. You heard my preaching, and now let's see what it looks like. And let's see if you could see this. I'm pointing at stuff, but you can't see that. So let me bring up my little drawing tool spotlight. Now let's see if you could see that. There we go. Okay, so hopefully you can see my spotlight now. So here's how it looks. And I'm going to have to look at my other monitor. So sorry, I'm looking away from the camera, but I want to look at the same thing you're looking at. So how do we see this visually on charts? Because I know you all like charts, and so do I. So 5 energies. So number 1, trend. What direction do we want to trade? Now, trend, we don't only want to trade in the direction of the trend, but there's another nuance there. Dollars are in the details. We want to trade early in a new trend. So it's not just trend, it's early in a new trend, because as we've heard, the trend is your friend until the end. So at the end, it's not your friend. So at the beginning, it is. So here's how I do this. I have my wave counts on here. And by the way, these are not Elliott waves. These are my own wave counting waves that I put together. So for lack of a better term, I call them berry waves. So we got wave 1, 2. So that's a first retrace in the trend. And the reason we have the waves is to actually determine how early or late we are in the trend. That's the whole function of waves. That's why they exist. So wave 2 is the earliest you can get on a retrace on the trend. So we're early in a new trend. Number 2, momentum. Here's the momentum indicator. Boom, cranking on up. Momentum is the strength of that trend. So are you in a weak trend or a strong trend? I don't want to trade just any old trend. Trend is just direction. But again, I want the money flow to be strong behind it. The market could just be meandering up on mom and pop trades, and there's not a lot of energy, there's not a lot of money behind that. So it could stall out very easily. So no, we want big money coming in. We want smart money coming in, and we want power behind that move. So as you can see, boom, it created a nice big move, and that's because momentum up. All right, so step 1, early in a new trend. Step 2, strong trend with momentum. Step 3, is it time to enter the trade? And this is my timing indicator down here. It's modified stochastic, as you can see. We put in a cycle low, and the key to this is the little, see the black line there? That's %K, and we're looking for this little pattern right here. I call that a mini divergence pattern, where we have a low and then a higher low right there. And that gives us incredible precision to nail the final cycle low. All right, support of the 50 SMA. That's energy number 4, support. And then we go to our fractal energy. Remember, it's 3-to-1 ratio, 10-minute chart, 30-minute chart. And I know people ask about this all the time. Nothing magical about a 10-minute or 30-minute chart. You can do this with any time intervals you want. You can do it with daily charts. You can do it 60-minute charts, 1-minute charts, as long as there's enough liquidity within that time frame. And the thing I look for here is momentum. So momentum on the fractal time. So, and that's here. To me, this is more important than is the trend in the direction of the trade on the longer term time frame. All right, because again, I want strength here on the 30-minute. I want strength here on the 10-minute. That means I've got strength on 2 different time frames. That represents 2 different groups of traders who all bring in a lot of demand. So when you get strength on the short term, strength on the long term, that creates a strong market. And that's what we want, follow through, reward, right? That goes toward our risk reward ratio. Okay, so now let's focus, now that you see the big picture, let's focus on pinpointing market highs and lows for entries and exits. So I'm going to show you the solution for my cycle indicator here. And going to give you the right indicator and the right inputs or parameters. So you might want to take notes here. You're welcome to take a screen capture of this slide if you'd like to. So what we're going to do is we're going to use the good old-fashioned stochastic indicator. Remember, I said I don't use any proprietary indicators. There's good ones out there, but I just happen to use very common things. So, oops, let's go over here. So now I change the settings though. I do not use the stochastic in its default form. So if you bring up MetaStock here, then you go into the parameters, the tab, and I change, here's %K, so time periods to 5. That's the key one. That's the most important one. Slowing I changed to 2, %D I changed to 3, moving average method is simple, and line color, that's just purely your personal preference. Okay, leave that there for a second. Very important that for the purposes I'm going to share at least, that you use these parameters. This is what we are using to time our entries. In fact, I will tell you, I use this to enter my trades on every single type of trade I take, whether it's a trend trade, a reversal trade, a triangle trade, any type of trade whatsoever. I'm using this to enter. Okay, so, and then, also real quick here, when you go over to horizontal lines on this tab, I set them, and this is important as well, 20, 50, and 80. 20, 50, and 80. Okay, I'm not sure. I don't think it defaults to those numbers, so you might need to change those as well. Okay. All right, so now let's put this together. So again, very important. Remember what I said, we don't just use one indicator to trade. No one indicator will make you money. If they did, we'd call them money makers instead of indicators, but we don't. We call them indicators. Why? Because they indicate. They do what they promise. So we're using the right indicator and the parameters, but by itself, and I have to emphasize this because I get this all the time. I've done this presentation before, and people think, oh, the secret's in this indicator. It's not the secret. It's 1/5 of the 5 energy methodology. It's an important one, but we got to put all 5 of them together. Okay, so what are the others? Well, we use it strategically with the trend. So we trade in the direction of the trend early in the trend. Number 2, we only trade cycles that have momentum, because you can have cycles that don't really go anywhere. A cycle low can be put in, but the market doesn't really go up that much. It will go up a lot if you have strength behind it or momentum behind it. And again, momentum on the higher time frame has to be aligned, which I call the fractal energy. Okay, and second chance pattern or mini divergence pattern, that little wiggle on K there, the higher low on K I showed you. Okay, I call those, that's one, I call that a mini divergence. And a mini divergence is one of 6 second chance indicator patterns that I use for entries with the modified stochastic. Okay, so now these second chance patterns indicate a momentum shift at the top or the bottom of a cycle, because the stochastic indicator actually is a momentum indicator. Remember what I said, these indicators are mathematical formulas. And when George Lane created the stochastic indicator, he created it to mathematically measure the momentum of money flow. And we're going to do that at just a very, very small macro level within 5 bars, because we're using it just to find the top or the bottom of a cycle for our entry. So we look for the mini divergence. And like I said, there's 5 other patterns that you can use as well. So, but today we've only got 13 minutes left, so we don't have time to go into all of those. But let me show you the basic idea. What we want to avoid is being into a downtrend like this, where we get a lower low, lower high, and then we go short here, thinking, oh, we got a nice retrace in the trend, but then the market goes back up and takes out our high if we went short here. This is what my mentor called about being right, but at the wrong time. All right, you were right to trade a downtrend, but this was not the right time. So here's our time axis down here. Shouldn't have shorted that time. You should have shorted at this time. All right, so that's what we want to avoid. So how do we do that? Well, here's what we do. We look for these little momentum shift patterns on K. Okay, K is the blue line right now. So we get price, or the 50 MA is angling up, so we got an uptrend. We got a little bit of a lower high, lower low on price, higher low on K. There's our little momentum or mini divergence pattern. That's my final cycle low in an uptrend, and up she goes. Okay, you can do this on reversal trades too. That was a trend trade. Let's look at a reversal trade. Now, I would only take a reversal trade if the market had already been trending down for a long time and the trend is no longer my friend. So we got to bring that back in. So we can trade extended trends, but we trade them against the trend when the trend's no longer your friend. So if it's been going down for 5, 7, 9 waves, all right, I'm going to look for this puppy to reverse, lower low on price, higher low on percent K. There's my little mini divergence, and that's the time that I want to get into the trade. And the trend eventually reverses. Trend is always and must always be a lagging indicator by definition. Again, I'd go into the detail on that if I had more time. And sometimes you can use this on markets that are just contracting, going sideways for a while, because markets cycle through various types of iterations. Sometimes they trend, sometimes they don't trend. So if you want to look for a time when markets are consolidating and about to start to trend, then look for that higher high on price, lower high on K, and that's the right time to get into a new trend trade before the trend is actually confirmed even. So let's summarize high probability trading. So number one, we're going to wait for the alignment of the 5 energies to put the odds on your side. Acknowledging it's still just the odds, but over a large sample of data, if we've done our statistical analysis, then the odds work out and we make money. But any one given trade means nothing, absolutely nothing statistically. So we have to know where our protective stops are going to be. We have to, I put in hard stops, by the way, to address, I said I would address some of the questions that came up here. So when I put in a hard stop, what that means is that I am literally putting the stop into my execution platform. Where do I place my stop now? Well, I've just shown you how to find a cycle low. So in fact, let me go back here because I do want to address these questions that came in. So if I'm going to look here at this cycle high and I'm going to go short there, my protective stop will go 1 penny pip or take above the high of the highest bar here. That's all I need, 1 penny. And when I say I put in a hard stop, I mean in my execution platform, I actually put in an order to exit the position, to buy. All right, all the contracts that I went short, 100% of them, I'll be out right there. And it sits there so that I don't have to think about it and I don't have to get emotionally involved. And it's there. If it gets hit, it gets hit. Because, and here's another thing for you, stops go where you're wrong. So what do I mean by that? I don't like to use the word wrong, but again, let me put it this way. If the reason for your trade no longer exists, then your trade should no longer exist. So the reason for the trade here was this cycle high, looking to start a new downtrend coming out of consolidation. So if we broke this high, well, then the reason for my trade no longer exists, and that's why my protective stop goes there. And then my trade will no longer exist because I'll get hit on my stop, which is a good thing. But look at the risk. The risk is very little. It's like the range of just 1 bar, the range of that high and low. But look at the reward. And that's what we're doing with all of these trades, making the risk very, very minimal, very minuscule. Okay, so going back to this, we already talked about that one. Oh, and here, if you want to, like I said, my system's actually very simple. So it could be, we've got a 5-step checklist for those who want to trade it. But just if you want to write down what the whole system is, there it is in 1 sentence. That's my whole system in 1 sentence. We're looking to get in early in a new trend, energy number 1, that is strong, that's momentum, at the right time, that's your cycle highs and lows, with support at your back, that's support resistance, whether you're buying or selling, confirmed by the bigger scale, that's your multiple time frame. All right, so it's very robust and adaptable. So this, we get these kind of questions all the time. Well, what kind of markets can I use this on? Pretty much anything. The only thing that I wouldn't trade this on would be, well, penny stocks, pink sheets, things with very low liquidity that could be manipulated, pump and dumped. So, but stocks, commodities, options, currencies, futures, even cryptos. I trade cryptocurrencies, and I use the same methodology. Same methodology, no difference. It's universal. Why? Why is it universal? Because we're just measuring supply-demand imbalances, really. It comes down to that. Money flow. And that's how all these markets work. They're all auction places. And again, you can use it for pretty much any time frame you want. I'll use it for investing. Now there I use monthly charts. Swing trading, for me personally, I use daily charts for that, but you could use shorter time frames if you want, like a 60-minute chart or something. A day trading, go down to really short time frames, whatever your favorite time frame is. That's up to you. I have some information about that if you want it. But the magic is not the time interval. Okay, there is no magic in choosing the right time interval. There are some, in fact, I'll be happy to share if you want to send me an email. I'll give you my email here in a second. And I wrote some blog articles about how to choose the best time interval for you and for a given market and for an account your size. Those are the three things that come in. Somebody asked about that, so I wanted to make sure that I answered that since I promised I would. And the methodology is simple. I mean, my gosh, we're counting to 5. Now, there is something else that's super duper cool, and that is what MetaStock has added to all of this. So everything I've shown you up until right now, you can trade on any trading platform I've ever seen. Okay, there's millions of trading platforms out there, and yeah, you can apply all of this to any of them. Now, MetaStock can take you to the next level because I've worked with MetaStock directly and with their programmers and engineers, software engineers, and they put together something that no other trading platform has. So look at this. This is just outrageously awesome. So number one, if you get the add-on, there's a Top Dog Trading add-on, it will automatically plot the numbers. You might have wondered, well, where do these numbers come from? Well, you could manually type them on, or you could just, in your imagination, type them in. But with MetaStock, the plugin, it'll actually plot those down there for you automatically. So you'll know where in the trend you are, how early or late you are in the trend. And again, these are not Elliott waves. That's why they don't stop at 5. Elliott waves, you can only do a max of 5. And if it goes beyond 5, well, then all of a sudden they recount. So with Berry waves, we don't recount waves. So you can go beyond 5. Now, it just so happens that 5 is the average. So once we get into a 7 or a 9, oh, now we're looking for what? Trend reversal trades. And then down here, we've got this ribbon. This ribbon just tells you what the trend is, up or down. Okay, well, that's not rocket surgery. And then here's the cycle indicator, our modified stochastic. Oh, and then this is awesome. This is the commentary over here. So again, nobody else has this. No other trading platform has this. So it'll come up and it'll say, oh, okay, we've got a wave 9 reversal short. Well, there's wave 9. See where that little blue diamond is there? That's when this popped up. That's what this commentary is referring to. It's that spot right there, that bar. And it gives you all kinds of great information. So we have a wave 9 high, 50 MA angling up, %D. So there's rules to all of this, but all the rules are programmed into it. And then commentary. And here's where it tells you everything. So again, I won't go into it. In fact, I think we might have a little more presentation coming up after this to give you some of the extra stuff here that is extra cool. So we'll see. I think Jeff's got a little extra presentation here. He's going to show you some more. But so this gives you, again, okay, the setup is this. The confirmation is that. Your entry, where's your entry? Where's your initial stop? Where are your targets? I mean, seriously, talk about objective and rule-based. It's fantastic. So, but I want to give everybody something free for joining me for this hour. And by the way, this is my email address. So because I don't really have time for questions, I don't think, we'll see. I'll leave that up to Jeff. But this is my email address, Barry@topdogtrading.com. So feel free, everybody here is welcome to email me. I love to receive emails from people and help you. And I'm going to give you one of my favorite trade strategies I call the rubber band trade. So I want you to start making some money. And I'm going to do it with one of my simplest and most effective trade strategies. And I'm not going to charge you for it. I'm going to give you a little mini course, 100% free. Don't even have to put a credit card down. Gives you the complete rules for where to enter and exit. The little course is called How Pros Trade Different Than Amateurs. And the cycle indicator, see some questions have come in about that, but I'm going to give you all the details in a recorded webinar. It says follow-up webinar, and it is, but it's recorded. So you can watch it anytime you want. It's about a 45-minute video, okay? Again, free. And that shows you how to set it up on your charts and how to trade it, etc. Get all that stuff by just going to topdogtrading.com/free. Okay, so Jeff, let me turn it over to you, my friend. And I believe you have a few other things you want to say here and show people.
I do. I just want to verify I have the correct settings for the stochastic Augustine was asking for. 523, right?
I'm sorry, say that again.
For the stochastic settings that you use, is it 1253?
12? No, it's not 1253. It's 523.
523.
Yeah. Oh, I see. Yeah, the 2 is.
That's what I meant. Yep. Okay. And Alfred wanted to know if you had any books that further describe the system you're talking about today.
Yeah, I read a book called Trend Trading for Dummies, published by Wiley & Sons. And so it is in there. You can get it wherever better trading books are sold, including Amazon.
All right. A huge thanks, Barry, for coming in, helping us out today, doing a class. We did have a comment earlier that says, thank you for all this valuable information. It is very much valuable. So actually, I read that a little bit wrong, but that was the gist of it. Thanks for coming in. We appreciate it.
Well, my pleasure, as always.
Thanks, Barry. And yeah, I'm going to talk a little bit about the system and the methodology now. So always really good to have Barry in here. Let me go ahead and make myself the presenter. Let me go ahead and do this. Hey, and there we go. I do love the 5 energy method. I kind of wanted to show you how it exists and how it looks kind of like on a chart real quick. And then we don't have a lot of extra time, but I think it's worth it. So right here, let me go ahead and click on no. Not exactly sure what we're doing, but let me go ahead and kind of zoom in just a little bit on this chart. And I want to point out that it's automatically drawing kind of like your support and resistance levels. It's automatically doing the wave counts. It's automatically looking like right here. If I'm going to zoom in a little bit more on this, actually right here, see a little bit of a bio right here. This is a rubber band trade. This is actually the trade that Barry was talking about, that you can get that free course at topdogtrading.com/free. But if I highlight on this, again, it's going to come up with the expert commentary. Let me go ahead and kind of get it and move. Okay. Anyway, I can't get it to move. Anyway, it'll give us an explanation about what was going on. There's an HTML file that you can load, and it's going to give more actual things. It's not exactly moving to where I want it to be, and I'm not going to kind of belabor the point. It's a very, very well-rounded add-on, and it's going to help you with all of the 5 energies that Barry discussed. You can actually do scans. The scans that you can scan for are patterns for new trends, momentum-based trends, long trends, reversion to the mean, and triangle pattern trades. And with all of the patterns, it's going to give you a complete description of what's going on, exactly what you should be looking to do with it, and very, very well-designed add-on. This add-on itself is only $500. Here at the event, we're going to do $399. If you need MetaStock, we'll include a copy of MetaStock. We're going to back it with our money-back guarantee that I've been talking about all day. And you can order it at metastock.com/conf promo. You can call 800-882-3040. You can also go to metastock.com/sales chat. So again, $400. If you like it, you can keep it. If you don't, you get a full refund on it. You have 30 days to evaluate it. So perfect risk-reward environment for you to be able to look at things. So take a look at it. 800-882-3040. You can also go to metastock.com/conf promo or metastock.com/sales chat and take advantage of that. So, okay. Well, actually, let's talk some commodities during this break. There is Oscar. Oscar is going to be with us in just a minute. Okay, I'm going to have you help me out again. We're going to give away another prize. I'm not going to let another opportunity to give away a prize go by. So, Kelly, are you ready to break in here? Okay. So let me tell you what we're going to give away, and then we can kind of figure out who the winner is next. So the prize that we're going to give away is Wendy Kirkland. And her, not her as a person, we're going to give her Wealth Building Weekly newsletter out. This is actually, if you're going to get a year of this, it's $468 if you subscribe to this. It's a complimentary subscription to her flagship trading newsletter. It features a list of every stock that Wendy Kirkland's weekly system triggers, and is on the verge of having a rally. So, and with that, you'll get specific trade analysis is posted online every week for you to look at. So get a year of picks from Wendy Kirkland. Kelly, let's figure out who won that prize, should we? Okay, so what I need from you is a number between 1 and 9,419. 0487. Okay, this is we are going to reward somebody for registering early with Wendy Kirkland's thing. So this the person that's the winner of this is a person by the name of Lewis B. In, let's see if I have a country. Oh my gosh, a Lewis B. in a country that I don't have actually. So Lewis, I'm going to send you an email at your Gmail account on how you can claim that prize. But congratulations on winning that. Thank you for the help, Kelly. Appreciate the assist. All right, cool. And now I'm going to talk about how awesome Stocks and Commodities Magazine is. And they are awesome. They've been supporting the Online Traders Summit since I started doing them. We've been doing them for about a decade now. It'll be a decade, I think, in January. So they're great. They help us advertise it. They help us get the word out. They've been publishing consistently since 1982. Got 1.3 million subscribers. Did you know that if you buy Barry Burns' add-on that we just talked about for $300, you can get 2 years of Stocks and Commodities included? Yeah, if you do just a subscription for MetaStock where you buy a month, we'll give you the second and third month for free, and they'll give you 5 months of their magazine. So that's all included. I want to be clear, they actually do that for you. we don't pay for those prizes. It's just something that they give to you as part of their sponsorship of the event. And it's really, really cool. We appreciate all the work that they've done to support our events. They've been great. I love these events. I think they're awesome. And they've been supporting us since day one. So we really, really appreciate that. So, of course, with MetaStock, I've been talking about MetaStock all day long. We talked about scanning and testing trading ideas, and Scott Brown earlier today talked about our patented forecaster and all the statistics that it does. You can get your extended trial right now if you go to metastock.com/conf-promo. If you want to talk to one of our friendly sales guys, you can give us a call at 800-882-3040. Or if you have questions and you want to stay tuned, because we have Oscar Carboni talking. I certainly understand that. I'd love to listen to Oscar. But you can go to metastock.com/sales-check. So there you go. I'm going to go ahead and talk a little bit about Oscar. Oscar is somebody that our marketing guy, Greg Lewis, calls a force of nature. He is very dynamic. He's a great presenter. We love listening to him just because he's very, very entertaining. He always has some pretty good ideas about what's going on in the market. I understand that he both has power right now and he has internet. So those are two things that are going to be very, very helpful for him when he comes to do a presentation with us. So let's go ahead. Oscar, how are you doing right now? I can hear you, Oscar, but I can't hear you. I still can't hear you. I don't know if you can hear me, but what I would, let's see. I do show you broadcasting. Is there a mute button on your microphone? Or on your lapel somewhere? I'm assuming you can hear me. Sometimes what we would recommend is just unplug your microphone and plug it back in. Actually, what sometimes works is there's an audio tab on GoToWebinar. And if you go to that and click no audio and then audio, sometimes that'll be enough to fix it to work.
Testing 1, 2. Are we good?
Got it. Yeah. Double thumbs up good. So we can see you.
At this moment, I don't have internet. I'm using a hotspot because the electricity has come back on, but not the internet yet. Let's hope this gets through.
Yeah, no, I can hear you fine.
Jeff, thank you for inviting me. Traders, if you waited for me at 3 p.m., my apologies. We had an outage in the whole neighborhood, and I just got back up and running. Again, I don't even actually have internet. I hope this makes it through the next hour. But what I wanted to do is present to you what I see as technical analysis that's very important today and tomorrow for the election, what we should be looking at and what we should probably do if the election goes plus or minus, negative, positive, however you want to view that. So that's what I'd like to show you today. Jeff, thank you once again. Much appreciated. Love doing these MetaStock conferences with you. And thank you for my Omniacs out there. If you stuck around 2 hours to wait for me, but you know, sometimes the best things are worth waiting for. So, Jeff, how would I now remove this big, it looks like a big picture of me on my screen so I can show.
Well, sometimes that happens, and I just usually move it to a different monitor. Like, you could turn off your webcam too, but I don't think there's a huge reason to do that.
So I think we'll leave it on for now, unless I start getting throttled down by T-Mobile or something.
Yeah, we can hear you and we can see you fine. I don't know how to, and I can see your screen. I can see your notepad, but I don't know how to. Sometimes it does that to me, where it's just all you can see is your face, and I don't know how to fix it.
Okay, so I think we're set, and I will try to help all of us out to see what should happen with this election tomorrow. So let me say good morning, good afternoon, good evening, traders, and welcome to Short-Term Trading Live with Oscar Carboni. Thank you for your patience. Remember, never trade without stops. These markets are extremely volatile. Do yourselves a favor. If you're ever going to trade anything, stocks, commodities, ETFs, cryptocurrencies, put your stops in first, okay? Now, let's take a look. So I wrote some notes, and I painstakingly went over many charts. I mean, dozens and dozens of charts leading up to this webinar. And those charts brought me to a specific place. And I'm going to go over each of those charts with you and hope to take you to that very same place with me. That place basically is an indicator of what we should do next after this election tomorrow. So welcome to an election electrified driven market, because that's what we have right now. Does not matter technical analysis, a trading system. This is all about the election today and tomorrow. Much of the election, or much of the action that we will see this week, is completely election driven even after the election. Let's see what analysis is current, what we can make use of following the election this week. I won't bore you with selling you a system or trying to offer you a system. I'm just going to show you, hopefully, some really good tricks or tips that you should use moving forward this week, because it will be volatile. Currently, we have certain technical setups, which mostly have been pointing towards the downside in U.S. indices like E-mini, S&P, NASDAQ, Russell, Dow Jones. The bigger picture, as you can see, is they've been pointing lower. The rallies have been sold into, and we end up back lower. So the big picture has been that for the last few months. In fact, since January 4th this year, the landscape has pointed us lower technically. The recent data that we have mined through suggests, this is, by the way, data about elections and markets. This is not Republican or Democratic. They're, if you will, they're politicians, we're traders, so let's not go there. It's just about market data, okay? The recent data we have to mine through suggests Republicans, when Republicans have power, big money, 401k funds, BlackRock type fund managers, they tend to plan for the upside and trade for the upside, using the data that I was able to mine through. The same data suggests that if Democrats gain or retain power, the funds tend to plan for the downside. So now that we know that, we need to go to the charts and see if it goes up, what should we watch out for? And if it goes down, what should we watch out for after the election? After today's session with me, if, and now there's three ifs there, if somehow the current technical landscape changes after this election, and tomorrow the market looks different and it starts looking bullish, we will have a pretty strong handle technically on what to look for and what to expect moving forward. If the landscape stays the same, which is probably more likely, then we will know all the technical areas to sell short or react at. So let's let the market tell us what to do, and we will react accordingly. So I am going to bring you right now to a weekly chart. Actually, let's not even go there yet. Let's go here first. We'll do that a little bit later. Let me take you, because I've worked on so many charts, I want to show you a bunch of them. Let's take you to the beginning of this year. Right up here, The Russell 2000, we had a massive head and shoulders, right? You can see the left shoulder, head, right shoulder, which led into a bear flag. Then somehow a small bear flag within a bear flag was formed, and we gave out a projection, 1698. The market carried through that projection, basically right down to 1698, if you will. This was the low right here, 1698. And then it rallied out, came back down, put in first leg of a double bottom, rallied up, back down, second leg of a double bottom, maybe a triple bottom, depends on how you want to look at that, rallied back up. So we see a picture of mostly down. Inside this big red channel is mostly down with head and shoulders, which are bearish, and flags, which are bear flags at the moment, which are bearish. And then there's this. We keep running into the 200 bar moving average, that green average right there, and stalling at the red line as well. Boom. All right, so we ran up to the average again recently, and we stalled again. So what do we have to look at now? If the election comes out, whatever the market deems bullish, whoever wins, if it's deemed bullish for the market, likely that would be Republicans, but let's keep that out of this. We should go through the 200 bar moving average, through the resistance, and then you can start using the 200 bar moving average as a buying tool. If the election goes in the way of bullish market. If things stay the same, we're going to use that exact same average to sell from, because it works, proven all the way back here when it started to go down. So that's one chart I looked at. And I said, okay, I see some analysis there telling us certainly lower, but what would I do if, let's say, the election proves to be bullish? I'd wait to get above the 200 and that red resistance line, and I'd start buying pullbacks to those areas. So something you might want to take some notes during these charts, because each chart might have a little something on there for you to hopefully gauge the markets by. So that was my first chart looking at the Russell, and I said, well, let's just go keep looking at other charts. You pull up the S&P. What works in the S&P for the election? I'll show you right now. What was in vogue was the 200 bar moving average. For a while, it was stopping the market, but the 120 bar moving average seems to be way more programmed into Wall Street's algorithms. So here's what we need to watch out for. What you have right now in the E-mini S&P, same thing, basically, as any other market that's a U.S. industry. We have been going down lately, like the Russell. So you're inside of this red channel moving down. Makes sense. It stops cold at this 120 bar moving average. This is absolutely written into temporarily for now. Everything changes quickly and morphs. What Wall Street's using lately is the 120 bar moving average programmed into algorithms. You can tell because the market either holds it perfectly, or when it breaks it, it starts a new trend and starts working its way down. All right, so it breaks it, gets back up, can't get above, gets back up, can't get above. Same thing here. And then we get below the 200 bar and down we start to go. All right, so let's go to now. Now we are bouncing in between the top and bottom of a big bear flag. At the top of that bear flag is your 120 bar moving average. We've already hit it 2 days ago, 3 days ago, and have dropped. So what does this tell us? This tells us if you are going to trade E-mini S&P after the selection, these are the things that you should be looking out for. A, you've got to get above the bear flag, this blue bear flag. Get above that. Beautiful. B, you've got to get above that 120 bar moving average. Then you've got to get above the 200 bar moving average, and then above the resistance. All of this has to be done first. Needs to get above all of that to become bullish in any way, shape, or form in the E-mini S&P. So these are the things in E-mini that you should watch out for. The 120 is your trigger for now. If it hits that and drops, that's your trigger. You keep selling there. If you can get above that, the 200 is your trigger. Once we can somehow get above 200 in that red resistance line, bingo, 4,800 S&P, here we go. Not calling for that at the moment. We've got an election coming. I promise you that election is going to mean so much to these markets. Now, again, the studying I've done tells me that if Republicans win, we are probably going to go up dramatically. If Democrats win, the analysis that we're looking at now will just follow in suit, and you can continue to use it for the next few months. It's important to see what I'm using because it's working really well. I mean, it's clearly in these pictures, you can tell well it's working, so that you can take advantage of this as well. So remember, S&P, lots of hurdles. Bear flag, 120 ball mover, 200 ball mover, and red resistance line. You get above that, and I'm sure Wall Street will start to get happy. So, of course, I've looked at many more charts than just those two. NASDAQ comes up. If you are trading the NASDAQ this week and you've got the guts to get ahead of that election, the 150 ball moving average was in vogue the last time I did a MetaStock webinar, and that's what we used on this very chart. In fact, every one of these charts are just continued from my last webinar. I like to use the same charts to show A, our projections, did they work? And B, what's most active right now? What am I using? What you could be using. So the 150 ball moving average, which is the blue average, was very, very strong for this market. As you can see, it held it here, but then when it broke, we started a new trend, which then started to cap us off at that average every time we get to it. It's capped off again here. And then we got, of course, down to the 50, and it took control. So we are not using the 150 at the moment. Now the 50 ball moving average is in vogue. So we go there. We look at the 50, which is in the driver's seat. This will be our trigger in the NASDAQ short-term trading now. We're going to do both short-term and a little bit longer-term trading in this little class or lesson, if you will. So the 150 ball moving average was in vogue, and Wall Street was teeing off of it. Now you've got to look at the 50 ball moving average, which will be coming in right up here after the election tomorrow, and look where it's riding along this resistance line, which is right now basically what's keeping the market from moving higher technically. So you've got resistance there. It's just the geometry that the market's working in, to be honest. Support and resistance is nothing more than market geometry. So the geometry is pointing lower, and it's riding along with that average. So if you're going to trade NASDAQ short-term day trading, your 50 ball moving average will be your trigger, which comes in right at the resistance. So it's a smart spot to trigger. If, of course, the news is bearish. If the news is bullish, you will get above that 50. 150 is then your test. You get above that, and there's only one last hurdle, our major resistance. You get above that line, and away you go. So I'm showing you what can happen on either side. If we wanted to discuss what I thought the election would come out as, the charts are pointing lower. I would say that about them. That's about all I know. The election could change all of that, but the charts are sort of pointing towards the election going lower. But we're not done with this segment, are we? Maybe things will change. So again, NASDAQ, your 150, not in vogue anymore. The 50 is 50 bar simple moving average. Keep your eyes peeled on that, and the red resistance line, which comes in somewhere near, if we want to look at a price, 22.90-ish. Let's move along. We have more charts to get through, and I don't know if I have enough time to get to all of them. So NASDAQ, another look. Short-term trading, just like the Russell. NASDAQ started off January this year with a massive head and shoulders, which told us the top was in. Of course, I told all of you that in many YouTube videos since then. It had broken down, tried to rally back up, and this is what I call a failed Oscarism known as a head test. You won't find this in any books or anything, but it's my brand, and I've shown it to you in many videos. When you have a head and shoulders, after you drop out of the right shoulder, as we did here, many times you get something called the head test. When that head test fails, the absolute signal that that was a head and shoulders is then confirmed. The head test failed to go higher than the head. It stopped cold at the 200 ball moving average. Interesting place to stop, and down we went. Since then, the 50 ball moving average has taken control, as we spoke about in the NASDAQ, but I wanted to show you the NASDAQ is very much like the Russell 2000. They started with a big head and shoulders, then a bear flag, and boom, and the 50 ball moving average takes over. So what would we do in the NASDAQ? As we spoke when we first looked at the NASDAQ chart, that 50 ball moving average and that resistance line that you see coming in that circle here is absolutely going to give you money if you sell it there, if the election results are bearish. Election results bullish, of course, you get above that, and maybe all the way up to the 200 ball moving average. So, of course, if you're a betting type of person, you'd have to bet on any of this happening. Me, I prefer to let the election happen and then decide what to do afterwards. Let's continue looking at charts. So next one on here is just one more quick look, if I remember. Oh, let's go to the transportation average. Oh, my goodness. So the transportation average has been wonderful for signals. After capitulation day, the market has topped, and the 90-bar moving average has been the darling of Wall Street this entire year. For the transportation average, the .DJT, the 90-bar simple moving average has worked the entire year. That will be your trigger. Keep your eyes on that. Above it, it gets bullish. Below it, it remains bearish. Of course, if you get above the 90-bar moving average, you can go up a few thousand points, but then you've got the big red resistance line to hurdle above. But I will tell you the 90 has been perfect with signals. Keep an eye on that for your Dow Jones transportation average. Next, the next chart I had planned to, well, the next chart I looked at for myself was back to the Russell again, because there's more on this Russell. We didn't really look at all of it yet. The Russell, of course, we know about the head and shoulders, blah, 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 all that stuff in the background, and that this voodoo actually works because everything else followed the Russell down as we projected it would. The 90-bar moving average absolutely is still valid right here in that Russell, right? The election's tomorrow. What's capping it from above has been the 200-bar moving average since December, or at the beginning of this year, since January this year. The entire year has been capped off with the 200-bar moving average. That is this teal average running down along all the tops. And that's also the high that we hit 3 or 4 days ago. So you are bouncing between the 90-bar moving average, very valid, and the 200. There is one last thing I want you to recognize in the Russell. There's also this major resistance here. See that red line? Starts at the highs when we put our peak in. Next run up hits it. We just about failed. We failed to hit it here, but stopped at the 200-bar moving average. This basically, you will trade in between these two averages till the election is done. And then I promise you, either the 200 is going to be what you want to be selling, or the 90 is what you're going to want to buy. There is a really smart signal right there for us when the election is over. There are many people who think that the election is an absolute sweep for Republicans, and that would be quite bullish, and everything I'm showing you is going to blow up, and all the charts are going to go much higher. But for now, I'm following what I see, and what I see is we're in downward patterns, downward trends with downward analysis, which could change, of course, with a crazy election. So remember, in the Russell, you've got a lot to get above. The 90-bar holding you right here. The 200-bar above that, resistance above that, and the whole thing could be a big flag. So let's keep these in mind because the election's tomorrow. This is going to happen right away, kids. Let's see what else we have. This is all going to boil down to one chart in the end, I promise. So next is T-bonds. New target in T-bonds, write this down, 111 to 109. When we were in the 138 area, we gave a target of 121 in bonds. We have hit that target. And many Omniacs know of these targets. If you weren't there for it, we don't make these things up. I could never make things up on video. It goes out to everyone in the world that follows me, and you can't retract. So everyone recognizes we had a target of 121. We are now new target 111, 109 in bonds. If you recall, during the first webinar I did this year for MetaStock, I put this bond chart. In fact, every one of these charts you've seen before. If this is more than your first MetaStock conference webinar with me, that bond chart, I showed you that it was a good moment when we crossed the 100 with the 200, and then it went bad. And once it went bad, so did the market. Now we are in this very steep channel, and that is your analysis on this. You don't need anything else. This channel is your analysis on bonds. It has stayed in this channel since 140, and it's going to stay in this channel straight down to 109. So keep your eyes on that. Nothing goes straight down, as you can see, but bonds basically make bear flags and drop further, and make flags and drop further, and that's what you should expect moving forward in bonds. Not quite tomorrow, of course, but over some time. What else did I have? I know I've got some targets on a few of these charts I came up with while I was doing my analysis. Here's an interesting chart. Look at the dollar index. Now, traders, if you are from any other country on this planet, I apologize for our president. I apologize for our nation. I don't know why we would hold back the oil and put you guys in such severe shock when our dollar is going up so high. The problem is we see inflation very little. We hear about it, right? You go to the supermarket, there's shrinkflation. Some things are a little more expensive. Only at the pump do Americans feel this inflation. Only at the pump. People can hem and haw, but I promise you, compared to anyone in Europe or almost any other country where their currency is going down compared to the US, we are in a heyday right now. And I apologize to you for our country not letting the oil out. I would let it out in a moment and knock down this inflation. I can't help you there, but I can help you trade. So the dollar index has been in this insane bull channel since it created a bull flag. But the interesting thing about this dollar is the 70-bar moving average. Look at the way it is just built into the algorithms. It is just there. If it gets there, so is Wall Street. They're waiting for it when it gets there, and they just attack. All right, so we know that's working. We're inside of a fantastic channel, and this is probably a bull flag, this green thing right here. This is most likely a bull flag telling us because they're still raising interest rates, we will likely still go higher in the dollar. Of course, the election could change everything, but this is what we have today, Monday. Now, the interesting thing again about the US dollar, you Europeans going to appreciate this, the 70-bar moving average, absolutely your trigger. Write that down. When you get to it, you can buy it. If somehow it breaks it, it's a whole new thing starting. That's the US dollar. Barring the pump, I promise you, Americans do not feel the inflation like this next picture. Imagine not having US dollars and having a euro currency. While the price of crude is ridiculously expensive, $93 a barrel today in crude. This is a disaster when you add in the high price of crude and inflation, because your euro currency is stuck at the 70-bar moving average, just like the dollar, but on top of it. And that is your trigger to sell, or if you get above, something new is about to take place. So Europe, if you're trading a euro traders, euro needs to get above the 70-bar moving average and above this red resistance line, and away you will go. However, that is not the pattern. The pattern that we see, as you can clearly see, is you hit that 70-bar moving average, down you go. So use the 70 on euro currency if you don't know what works well there. These are all daily charts, by the way. But again, your currency moving down like this with inflation and high crude, my apologies to you, Europe. I wish I could convince our president to let out some oil and drop this problem, but it is what it is, kids. Let's move forward. Let's get into some crypto for a moment. You know, I have mentioned and literally have had conversations with, found myself on the side of me standing on one side and 72 other crypto traders standing on the other. When I tell them that Bitcoin and Ethereum are absolutely tied to Wall Street, and Wall Street's algorithms are being used on Bitcoin and Ethereum, because Bitcoin and Ethereum both have futures markets, which are regulated. And I promise you, they have figured out algorithms which work with them. And how do I know? Well, Bitcoin starts out the year with a big head and shoulders, like NASDAQ and Russell, drops into a bear flag, like NASDAQ and Russell, and then proceeds to continue to dump after breaking the 200-bar moving average, like NASDAQ and Russell. Okay? They are connected. The Bitcoin, though, looks worse than Ethereum. Look at Bitcoin stuck in this massive flag, bear flag, or just a flat, if you will, massive plateau, and it is just stuck there. It did get above this red resistance line, so there's a teeny bit of light at the end of the tunnel, but it's just stuck in this big bear flag, this blue bear flag in a flat. And there is nothing good to say about Bitcoin at the moment. But Ethereum is performing better than Bitcoin. Let me show you that. Now, Bitcoin will have its move. 3 years, 7 months from now, Bitcoin will be at 85,000, I promise you. But we've got to wait for that. Look at Ethereum. Now, Ethereum, there's a little light at the end of the Ethereum tunnel. Yes, it had the big head and shoulders and into the bear flag and the big breakdown, like everything else on Wall Street, which has been tied to hedge funds with algorithms. They all look kind of the same, right? These charts are all the same, basically. They're all going in the same direction, except for the dollar index. But Ethereum has broken above this 18-bar moving average, and that seems to be when it wants to go up, like here. Got above the average, or at least I should say from here, gets above the average, and boom, nice rally. But then it gets below, and it tries, and it stays below. Well, now we're above, and we got above the red resistance line. And if you will, I know this isn't, you won't find this in any books or anything, but there's an Oscarism known as an F flag sitting right here. Look, let me point that to you. And that usually can stay bullish for some time. So now you've got what I call an F flag, which is slightly bullish for sure, in Ethereum, above the 18-bar moving average, and above resistance. So a little light at the end of the tunnel for Ethereum. Go Ethereum. I hope it can go up on its own. I own a bunch of it. You better go up at some point, sir. Once again, Ethereum and Bitcoin, my 5-year target has 3 years, 6 months to go. 85,000 Bitcoin. I'm not worried whether we'll get there or not. Analysis works really well. So what's next? Traders, I put NVIDIA in front of you at the last MetaStock Traders Conference. And I showed you I had something that I like to call my knock, knock, knock formation, if you will. And what that usually means is you cannot knock on a door in this business, commodities trading business, futures or stocks. You can, crypto as well. You cannot knock on a door this many times without an opening. So the NVDA comes down and hits this door, if you will, and knocks on it. Goes right up to the 90-bar moving average and hits the door. Goes back up to where? 90-bar moving average. Knocks on the door. Knocks again. Knocks a fourth time. Where's it go? 90-bar moving average. Drops down from that, knocks a fifth time, and when it knocked the fifth time is when I put this in front of you at the last MetaStock Traders Conference, and I told you there's just no shot it's going to hold. That's it. Now it comes down. And there was a bear flag sitting there, right? You can see the bear flag as well. So simple analysis told us this is going to break. Knock, knock, knock. It does break, and down we go. Well, that movement down creates this red channel that we're in. Big bearish red channel. The 90-bar moving average is your trigger on NVIDIA. It works like magic. Write it down, use it, sell that 90-bar moving average when you see it. And of course, if somehow we could get above it and stay above for like 3 or 4 days, it becomes your trigger to buy off of. That is your trigger for NVIDIA. So if you are an NVIDIA trader, that would be the algorithm, if you will, because they get programmed into Wall Street's algorithms. That would be the average that you want to key off of until things change. So one of my sayings is you cannot knock on a door, a stock door, this many times without it opening, and knock, 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 knock. It opened. We've got some other knock, knock charts going on in our spectrum of charts. I don't know if I've got any drawn up for you right here, but I think gold is one of them. So let's see what we have next. We looked at that. Let's go look at Zoom. Oh, another thing. Write this down, kids. In the last 3 webinars, this has been working for a long time now. In the last 3 webinars, the 55-bar moving average has proven to us that it is magic on Zoom. Magic. So I gave out a projection when we were at 126.44. And I said we would drop to 99.30. Well, you know what? We dropped all the way to 99.30. It was hit. Boom. Previous projection hit. New projection out. We were at 99.30 in my last MetaStock presentation. You can check this if you want to go back and look at the tapes. And I said we would drop to 49. Well, now we're at 77, and the target of 49 remains valid. So Zoom, ZM, down to 49 eventually, key off the 55-bar moving average. That is your key if you are a stock trader who likes to mess with Zoom. What else did I prepare for you cats? Now check this out. This is it. This chart says it all. Simplify what's going to happen, how you should trade, what the election may mean. Dow Jones Industrial Average, this is the market. It's as easy to read as the day is long because what's happening here is before your eyes. When that election's over, if you fail at the 200-ball moving average, you're done. If we get above the 200-ball moving average, it's something completely new. This is it. This is the one that says it all for short-term trading. For short-term trading, just watch this tomorrow. If we end up above this, away you will go. If you stop cold in this area, you've got your sell ticket. That is it. This chart says it all. This election has set the stage. This is set. The Dow is going to speak volumes. That is a key chart for short-term trading. Keep your eyes on that one. Now I'm going to start to talk about weekly charts. Let's go out a little further because after all the daily charts, I looked at all the weekly charts and everything that I've looked at brought me to one chart, sort of like the end of these daily charts brought me to this one, the Dow. The Dow says it all. So all that work we did sort of brought me to the Dow. The Dow says simplified. Look at that right there. That's about as easy on the eye as you'd ever want it to be. But we're going to go out to the weekly and we're going to start to look at those because there's a big difference. And let's go do that. Let's start here. Now we're going to take our eye off the short term, in and out, jumping in and out of trades. Monday, trade on Monday, trade again on Tuesday, trade again on Wednesday. Let's now pull this thing back. Let's start to look at the forest. We want to see the whole thing, right? I want to look at the whole forest now. NASDAQ weekly chart, 200-ball moving average. Wall Street's darling, we all know this. On the weekly. Look, 1, 2, 3, 4, 5 weeks have been spent around the 200-ball moving average. 4 of them below. I don't see the chart below the 200-ball moving average here. Or here. Almost anywhere. Not below. Okay. Your NASDAQ. This is going to be a big picture. It's something I've been following ever since the NASDAQ started trading, to be honest. I've got charts that go all the way back, and I always keep my eye on the NASDAQ. Of course, who wouldn't? And I like to always have long-term charts, which some of the charts I can pull up or literally have been drawn on for about as long as I've had the internet and trading programs that would allow me to put charts on computer. Used to be on paper in the old days. Thank God they're on computer now. So I literally have charts that go back forever. So I keep my eyes on so much of this so that if I see something different or if I see a repetitive pattern, brings me back and it makes me do some longer-term analysis to keep the short-term analysis in focus, and that's what we're doing now. NASDAQ, longer term, each one of these lines here, each one of these bars represents full week of trading. Full 5 days of trading is each bar, red or green. The other charts we were looking at, each one of those bars represented only 1 day, so it's fast term. Much longer term here. Very slow movement in your indicators, in your averages, and big movement from Wall Street when you hit these averages on the weekly. So that's your NASDAQ, and it looks to stay above that 200 pretty cleanly, except for now it's having some trouble with it. Look at the Dow Jones Industrial Average on the weekly. Same thing as NASDAQ, weekly bar. Each one of these lines here, or weeks, represents 1 week. So each one of these bars represents 1 week. You got under the average a little bit and took off, got to the top of the channel. Very active, boom, boom, jumped around. During COVID, you smashed through the 200-ball moving average like it wasn't there. Here we tested it but held. Here we tested it and held. 2008, it smashed through. But you do get through it, right? You get through that average sometimes. And when you get through the average, believe me, it doesn't look like this is large, but we are talking about a price of $23,719 at the average. It got down to $18,240. very big break under that average. So it's key if you break the 200 bar moving average on a weekly chart. So the Dow does break it. Luckily it doesn't stand there too long, but it certainly does break it. We've held it recently, and we rallied to the top of the channel, and it's election day. The top of that channel is either the top, and down you go to the bottom of the channel when the election comes out, or a breakout, right? It's an election, so I can't give you what it will be. I wish I could tell you what the election results would be, and I can tell you what to buy or sell. That's why I have to give you areas to pay attention to. So you need to pay attention. You can draw these yourself on your own computers. You're just connecting the highs. I cut through that high there because these two connected was smoother, and it connected to the third high, so that one breaks through. This is your trigger area in your Dow, and of course, this is your trigger area in the Dow. So if you just draw the same channels I'm drawing, you can kind of see what you should be looking for. The price that we're at up here, by the way, if you need a price, is somewhere around 32,967, 965. But you're going to have a lot of trouble there. This is either explosion all the way up, or that will top you out. The election is going to tell you that. Then you can react. There's more weekly charts, though. Transportation average. Now, another one. During COVID, big smash down. Huge breakdown, actually, during COVID. Tested it here recently. Rallied back up towards the top of the channel. Kind of looks like a bear flag to me. Wouldn't you want to consider this thing a bear flag? Right? If I looked at that, I'd go, well, nothing's perfect, especially with analysis, because it's a fine art, not a science. But I would think that this is some form of a bear flag. So it's, you got a bear flag forming at the top, possibly, of a channel. There's a lot of analysis going on here. You're holding the 200. There's an election taking place. A lot going on here, kids. So, best thing to do is use the 200 as your trigger, which is what I will do, and the top of the channel. The election will tell you which way to go. You just got to be brave enough to go after the election results. So transportation average broke down in 2016 twice. Broke through it in 2011. Broke through it in 2009. Broke through in 2008. Let's think about that. The Dow Jones Transportation Average broke the 200 in 2008. Again, it breaks it in 2009. It breaks the 200 bar moving average again in 2011. It breaks it twice during 2016. It breaks it during COVID. And it's challenging it now when there's an election tomorrow. So that tells me that looking at Dow, S&P on the weekly, you get some breaks through the 200 bar moving average. You got to be careful when you get down there. But let's go back and look at one more chart. Let's go look, well, two more actually. Let's look at the E-mini S&P. I don't think we've done that yet. So E-mini S&P, a little more stable. Right now we're testing the 200, broke it during COVID, but held it in 2016. Did break it in 2011 and 2009. So more breaks there. Now we're going back to the NASDAQ. This, my friends, is what all of those charts brought me to. Use this after the election for a sense of direction. This is absolute. This is what's happening. This is big. Now let's go back and look at this NASDAQ again. Now that you've seen all the other ones that often spend time below the 200 bar moving average, so you got to be careful when they signal, not the NASDAQ. This is a lot of time below the average because here you didn't even touch it. During COVID, it held, kids. During COVID, the 200 bar moving average did not get broken on your NASDAQ weekly. That is huge. So what could possibly break it? Nothing breaks the 200 bar moving average on the NASDAQ. Nothing except for 2008. That was it. And it was brief. That was it. Nothing else breaks the 200 bar moving average on the NASDAQ. Nothing. Except for where we are now. That's why I am telling you that this is big. This is your indicator. This is it. You don't need anything else. The NASDAQ weekly is going to tell us for the next few weeks if we're buyers or sellers. That is so absolute. That is perfect analysis. If you're a 200 ball moving average user, there's no better chart than the NASDAQ on the weekly to let you know if we should be buying or selling. That is what I went through in the last few days. Well, I'm always going through these charts. That's what I came up with, and I thought I wanted to share that with you. Now, there's a lot going on, and of course, we do a lot of day trading in between. So if you'd like to hang out with me, you can just find me very easily. Just go here to livewithoscar.com. Membership is absolutely free. Not even a credit card is required. It's livewithoscar.com. Do the login or register. If you, of course, you're not a member, you would register. You hit register. It's going to bring you to a page. It takes barely no information at all. Receive an email, send it back, and you are here at the Omni page. Once you've come to the Omni page, you can just join me in my live trading room. I'm there all the time. All of this is free to you, and then we can continue talking about these charts. Chat live with Oscar, and that's it. You're in there. There's Omni Boot Camp. If you want to know a little more about me, you can fill out a comprehensive application, and I can call you on the phone, and we can have a consultation. So the consultation site is here if you'd like to schedule a consultation with me. Barring that, I would be more than happy to answer questions for all of you. I don't have a program I'm looking to sell you, and I do have something called the Omni, Oscar's Market Navigational Indicator, which is a 4-day seminar held live in Las Vegas. That's not going to happen here during our little 1-hour webinar, and that only literally takes place in person for 4 people at a time. If you're interested in working with me, I promise you, it will. If you learn analysis the way I trade, it will change your life. You can go to Omni Bootcamp and fill out your comprehensive application. It's right there. It's simple. Of course, you scroll down, you click on any of these links, they'll all get you to an application. And barring that, I just hang out and trade and live my life doing analysis and let all the Omniacs around the world that want to hang out with me kind of look over my shoulder and trade with me. That's what I do, and that's what I'm basically offering here. I hope what I showed you, some of these techniques you'll be able to use moving forward, and I'd be more than happy to answer some of your questions if there's questions building up. I don't know. You let me know that, Jeff, because my internet, because I'm using the phone, I don't really want to open up YouTube and see what's going on there.
Yeah, no problem. Let's see. Actually, we have a lot of questions from, here's one from Michael and William. They want to know, how do you choose the periods for the moving averages you're using?
Well, you know what? The simplest thing to start off with is the 50 and the 200 ball moving average. And the only reason why I say that is because I grew up on Wall Street since I'm 18 years old. That's what they like. Who cares why? You know what I mean? Trying to ask why or trying to change those, it's like reinventing the wheel. Being that Wall Street loves it, sure, put it on your car and drive really fast. However, those averages will morph and change from time to time. The 50 and the 200 are very abstract, and they're larger type averages. What you'll notice is that Wall Street will get all the way down to like 14, 15 ball moving averages. The smallest thing you've ever seen that wiggle like crazy. The best thing to do to find out which average works is literally pull up a chart and find an average that stays out of the chart's way. In other words, you wouldn't want to use something like this as an average. Let's go change parameters. You wouldn't want to use this on something like this because it gets too involved. And we're looking at a weekly. If I bring you to a daily, you'll understand why I just said that. So let's go to a daily. You don't want to use short-term averages on daily charts because they get in the market too often and you just don't know what signals they're giving you, right? So instead, I'll start moving these averages around until I find something that looks suitable. And when I start to notice that it's out of the market's way and it's catching tops and bottoms without being broken, even this is spending too much time in the market for me. So I prefer to find averages. If I could draw one, I would say you want averages that sort of just barely touch the market and stay away. Those are the ones that you want to look for. And it's very simple to change averages and experiment, right? So you change them and you say, well, the 32 isn't working. Is it the 100, you want to stick with things like this, by the way. Wall Street, for whatever reason, and who cares why, thinks 100, 200, and 50 ball moving averages are golden. And then sometimes you'll see them get really small when markets get extremely volatile, and they'll do like a 21 ball moving average. Less often used, more of these are being used. But when the markets get extremely volatile, you can go down to smaller averages. But what you need to do is make sure that the average stays out of the market's way. And in fact, if we look at this, if we move this out even further, let's call this the 150. You'll see what I mean by that. Just stay out of there you go. Now you see how that average is just out of the way. Right? You see how it's just out of the way, but when you get to it, something meaningful will happen. That is an average I'd consider using. Anything else that, as I showed you earlier with that shorter term average, if it's jumping through the market, it's kind of useless. It's a guessing game. But if you can find an average that's doing what this one is, let me just move some of this out of our way. If you can find an average doing this, you found a good average, you lock it in, and you start keying off that average when you get to it. I hope that helps. Anything else for us, Jeff?
Yes, but I need to find how to unmute my microphone first. Amit wants to know, how do you know what timeframes to use in a chart?
So for me, because I've been in this business long enough to know better, I use daily, weekly, and that's about it. I stay away from any of the smaller time frames that give too many false signals, in my opinion. Well, let me say it this way: if you're going to use a 10-minute chart, you should be in a 10-minute trade, not a daily trade based on a 10-minute setup. You want to use a 10-minute chart, get in for 10 minutes, and then get out because the trade didn't work. You want to be in for a daily trade, use a daily chart. You'll do much better.
All right. This one, I think we need to read a legal disclaimer before I ask you. We don't recommend specific trades here. But Bala wants to know if you think a long straddle would be a good idea on SPY. I think that might be too much into the thing. Yeah.
Are you talking about a strangle or a straddle? So if you're going to do a straddle, great. If you're going to do a strangle by the wings, turning into a butterfly, so that you're not totally exposed. And I'm sure if he understands straddles or strangles, he understands what that means as well. So if you're going to be long the two options, great. Straddle. If you're going to be a strangle where you short those two options, spend a little money and buy protection above and below so you don't blow out.
Okay. Again, not a recommendation. Just for educational
if that's what you want to do, I'll show you how to do it without losing your pins.
All right. Rich says, great insight. Thanks, Oscar. Great insight as always. So, and that's the end of the questions. So,
okay.
I was going to talk a little bit about that course we did about a year ago.
Okay.
But I'll do that after we let you go. I want to say thank you for coming in. I'm glad we got you some power.
I can't believe I made it through with the T-Mobile hotspot. Hey, no commercial, but go T-Mobile. I wasn't expecting that to last this long.
All right. Very good. Thank you very much, Oscar. I really appreciate your coming in.
Okay, everyone, I hope that helps. I hope some of these techniques I've shown you, you've written them down and we'll use them because I promise you they're quite powerful. Now, the Omni that I actually teach, Oscar's Market Navigational Indicator, is much more complicated than this to look at, but just as simple to use. So if you ever do want to learn the Omni, you come down to livewithoscar.com and get in touch with me, and I'll discuss that with you. Jeff, MetaStock, everybody, thank you so much. I appreciate it.
Thank you, Oscar. Awesome. Thanks for coming. We'll see you again soon. All right, cool. And we did, as I was saying, we did actually record a training session with him. And I want to talk a little bit about that because he did such a good job with it. And we're going to do a little bit of a special because we're just throwing out the specials today. So again, we did a masterclass with Oscar. It's called the Trend Lines in Technical Formations that Mystique renewed. It was great. He pretty much went through how to put together trend lines, how to identify support and resistance areas on a chart, and how to spot a lot of the technical formations like the flags and the patterns. It was a very, very extensive course. I'd recommend you do it. And it's fully recorded. It's available right now. The normal cost on this would be $4.99. Here at the conference, we're going to do $150 off that price. So it's $349. You can sign up for it by giving us a call at 800-882-3040. You can visit us online at metastock.com/saleschat, or you can go to metastock.com/conf-promo. So there you go. And this is not he's speaking now, but we will go ahead and I think for this time around, let's see, my slides got a little bit disjuntled, but for this time around, actually, I think we talked about CMT last time. Thank you for their sponsorship. Actually, no, I think it was Task last time, so we'll talk about CMT this time. But before we do that, I promised I would not give away another opportunity to give away a prize. So Kelly, let me know when you're ready. Kelly. Okay. I was like, wait a second.
About that.
All right, let's decide on a prize. Let me go to my grab bag of goodies here, and we will decide on a prize. I like doing the prize first, and then deciding who's the winner. So on this particular one, what I think we're going to do is this is a market review that's given away by Melissa Armo. Melissa spoke earlier. Remember that, Kelly?
Yeah, it was a good session. I really enjoyed her presentation on gaps.
So with this one, it's live access to her message board, her trading, and it's a $50 value. So we're going to go ahead and give away 1 month access of her weekly market review. Are you ready to do that, Kelly?
I am.
Okay. Well, you know what I need. I need a number. I need a number between 1 and 9,000 something. Chats are, I'm getting notifications that are in the way. 9,480. What number would you like?
I think we'll go with the Fibonacci ratio this time. We'll do 6180.
6180. Okay. And that would be Jared S. With a Gmail account. So if your name is Gerald S., there's a good chance you just won, because I'm sure there's not a lot of people on this list that are named Gerald. So Gerald, I'm going to reach out to you with the information on that prize and how to claim it. But congratulations for winning. Thank you for the assist, Kelly. I appreciate that.
Hey, I'm always here for an assist.
All right, very good. Amit says, great job, Oscar. Oscar always does a great job. Rich says, great insight as always. Thank you, Oscar. We are really glad we were able to kind of get you in here. So thank you again. All right. I do want to say thank you to CMT and Stocks and Commodities for sponsoring. But today, for this session, I'll talk primarily about CMT. CMT has been a sponsor of the summits and conferences that we've been doing for about a year. CMT, if you're not familiar with them, they do accreditation. We're going to have them talk a little bit later in the week. But what really blew my mind about what they were talking about is if you trade as a business, like if you trade for with money, assets under management, having a CMT certification could really, really help you. If you're looking to trade as somebody with assets under management, they talk in great detail. Somebody's got a live mic. Oh, it's Jake. Jake, we'll see you in a second. CMT is a really good organization for that, and you can find out more about them at cmtassociation.org. But I want to say thank you for them for their sponsorship. We appreciate it. And it's such a well-respected organization. We're really, really happy to be associated with them. So there you go. And now let me go back forward a little bit to Jake Bernstein. Jake is a good friend of mine. I remember I used to live not too far, maybe 30 minutes from Jake. And we would always, seems like very, very frequently we'd go and we'd talk at these options meetings. Was trading options for profits up in Northern California. And then there was a Silicon Valley options group, two really good user groups, but we were in the area, so we'd go and Jake would talk about markets. And I was, he's such a smart guy, a great technician. He's written a number of books around technical analysis, but I always enjoy Jake. I consider him a really good friend of mine, and I think you're going to enjoy him as well. So Jake, let's go ahead and bring you on here. Jake, how are you doing?
Jeff, you're going to make me cry.
That's the goal.
I'm doing real good, and you're the only person I know in the business who still looks as young as they did the last time I saw you 20 years ago.
Well, that's very nice, but I think you're missing all the gray.
Well, we don't want to talk about the gray. The gray is going to make you look distinguished, right?
I'm happy that it's gray. I wish more of the shingles would stay on, but I need to fix. Okay, so I can see your PowerPoint.
Okay, let me get my pointer here. 1 second, please. And how about my pointer? Can you see that?
Yeah, yeah, that's cool. I like that. Everything's coming through. I can hear you well. I'm going to get out of your way. It's all yours right now.
Okay, hang on 1 second. Just let me get rid of this little toolbar here.
Okay, yeah.
1 second, please. It's been a while since I used GoToWebinar. Okay. So thank you, Jeff. Thank you, everyone at MetaStock. I really appreciate the opportunity to speak to you. When I made my first trade in the summer of 1967, and that's 52 years ago, things were a whole lot different than they are today. There were very few sources of information. The information wasn't really that good. And I started to read a book called Modern Commodity Futures Trading, modern at the time. And in that book, they showed some charts. And on the charts were these lines they called trend lines. And the lines were drawn perfectly above the highs and below the lows and channels. And I looked at it and I said to myself, this is really easy. Anybody can do this. They talked about flags and pennants and all the rest of that stuff. And let me preface what I'm going to say by saying this. In this business, you have to find what's right for you. There are many, many things you can do. And just because I don't use something or say that something doesn't work for me, doesn't mean it won't work for someone else. I found my spot. It took me 15 years to become an overnight success because I made every mistake in the book, the same mistake that so many traders are making these days. The situation now is the exact opposite of what it was back then. There are virtually no commissions now. There's trillions of sources of information. Go to the internet and punch up day trading and you will get, literally speaking, 1 billion responses, 1 billion hits where you can get information. You get a piece of profitable, powerful software like MetaStock, and there's 100 indicators there, if not more. And you look at the indicators and you say, wow, this is great. I'm going to use as many of these indicators as I can because the more I use, the better the answers are going to be and the more money I'm going to make. And that's part of the problem. The problem is that now, as opposed to 52 years ago when I made my first trade, there's so much information, it becomes difficult for traders to choose what they want to do. And you end up having to take someone's word for something, or you have to put it on the computer. So now that we have computers, let's use computers and let's use the powerful software that we have to determine, does something work or does something not? I always ask the question, are you a trader, a technician, a psychic, or an artist? Well, I learned the hard way, I can't be a psychic in the market. I can look at a chart, I can give you my opinion about the chart, but guess what? I'll be right maybe 50% of the time. I can meet a person face to face or on the phone and talk to them for 2 minutes, ask them 3 questions, and I can tell you with very high accuracy whether they're going to be a successful trader or not. So my intuition and my judgment in the markets absolutely suck, but my opinion about people is good and usually right because I'm dealing with objective data, data that I can see, data that's been tested in my mind. But when it comes to the market, I'm a numbers guy. I need numbers for everything. I need data for everything. I need specifics. I need clarity. I don't need interpretation. So if I teach something to someone, I want to be able to repeat the answers. In other words, I teach something to 100 people. I give them a chart, and I say, now go out and come back. Don't confer with each other. And unless everybody reaches the same opinion, the same conclusion about that chart, I'm not happy. It means that either the methodology is interpretive, which is not for me, either the methodology wasn't taught correctly, or it wasn't understood correctly, or I'm a bad teacher, or the person I'm teaching to has a learning disability. So for me, it's got to be specific and has to be absolutely clear. If it's not, I can't use it. I'm joined today by Brian Latta, who is a wonderful person, a great coach, a fabulous teacher, and has been able to take one of my concepts and turn it into something that's really productive and really specific and crystal clear, not subject to interpretation. So, of course, and by the way, stocks and commodities, if you want to learn more about me, I think last September, was it, that Stocks and Commodities did a 7-page interview with me. So today we're going to be talking about who we are, where the ideas we're going to talk about today came from. We're going to talk about the moving average channel. Brian's going to introduce the expansion contraction concept, which I believe is the first new concept that has been available in the markets in a long time. We're going to talk about understanding the elements, what it all means. We're going to show some simple applications and some trade examples and some of my recent signals. But of course, first, the absolutely, totally necessary, huge disclaimer, which basically says, guess what? You can lose money trading, in case you didn't know that. So we're going to start out very simply with a couple of ideas. And one more thing I want to say. I've been able to make a lot of money in this business. And at some point, when you get to be my age, 76, and I'm beginning to sound that way, by the way, you realize that you've got to give something back. And what does it for me more than anything else is when I get calls from people and say, Jake, you changed my life. I got one simple idea from you. I changed my attitude about the markets. I changed my mind about the markets. I changed my procedures about the markets. And that makes me very happy. And let me also say that it's really great that, Jeff, you and I still know each other after being in this business for such a long time, and that you continue to provide people with beautiful, fantastic software and programs they can use to improve their trading, as long as they have focus. So the skills that are needed for consistent success, for me, need to be clear and specific. All procedures and indicators, decisions have to be based on science, probability, and patterns. What do I mean by that? Let me give you an example. A lot of traders like to talk about the golden cross, the 50-day moving average crossing over the 200-day moving average. And they call it the golden cross because it's supposed to be predicting the future direction of the market. When they talk about the death cross, the 50-day going below the 200. If you do the right thing, you go to the computer and you program that into the computer, which is so easy to do these days. What do you find out? You find out that it's less than a 50-50 proposition. In other words, about 34% of the time, it's right. Well, it does make money in the long run, but in the short run, it will have many losing trades in a row. In fact, I believe the number is something like 17 consecutive losers. And I can tell you from experience that after 3 consecutive losers, people get frustrated and they won't trade a strategy anyway. So you have to understand that what you're looking at has to be tested and testable. If it's not testable because it's not clear and it can't be expressed in algorithms, then it's not for me. It might be right for somebody else. It might be right for many people, but it's not right for me. So you have to differentiate between an indicator and a strategy. An indicator, moving average, stochastic, ADX, RSI, momentum, you name it. They all tell you something about the market in its present condition. But in order to use them to make money, you need to convert them to a strategy. So the first step in any trading approach is an indicator, a pattern, and you have to be able to convert that pattern into a strategy. In other words, if then, if this happens, then do this. So I'm going to start out here by showing you a couple of ideas. Then we're going to turn it over to Brian. He's going to expand on those ideas. And then he's going to turn it back to me, and I'm going to show you a few more ideas of what's happening using primarily MetaStock charts. So we'll go to the next slide. So a little bit about me. Like I said, 52 years in the business. I'm a real trader. I really trade. I'm not a theoretical trader. I've written about 43 books. My work is purely technical. I don't interpret anything. I backtest everything by computer. I've taught thousands of traders all over the world how to trade, spoken at about 897 seminars. In fact, I think the last time I saw you, Jeff, was in, I think it was Singapore, wasn't it? I'm a member of the board member of the Foundation for the Study of Cycles. I've been on Wall Street Week, CNN, FN, CNBC, you name it. Was it Singapore, Jeff?
Yeah, I believe you're right. Yes, we were down in Hong Kong. I think it was Hong Kong, was it not?
Was it Hong Kong? Oh, you know what? I think you're right. It was Hong Kong, right?
Yeah, with Teresa. And yeah, that was great. That's a good visit.
You've got a good memory. That's great. So my methods are 100% objective and completely rules-based. I do not do analysis. It either is or it isn't. It's black or white, and that's all there is to it. So my methods are used by traders all over the world. I've got some very top newsletter writers that are clients who buy my research from me, individual traders, hedge funds, banks, and so forth, blah, 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 brag, brag, brag. Let's go on to the next slide. So I'm just going to go through this very quickly with some of the major ideas. Otherwise, you can read this on your own. So look, the bottom line is this. Unless you have a complete objective strategy, set up, trigger, and follow through, you're going to be like most traders. You're going to lose your money. And you're going to lose it fast, faster than ever before. You turn on your TV, you see the commercial. There's a man, he's sitting in front of the screen. He's got a pretty chart on the screen. It's a graph. It's got some lines on it, some indicators on the bottom. He's smiling. Around him, the kids are throwing stuff everywhere. The kids are going crazy. He's pushing buttons. He's trading. He's happy. And they want you to think that's how it's going to happen. But it's not going to happen that way. Most traders who come to the markets these days come to the markets because they want to day trade S&P. Amazing. They want to begin trading with the most difficult thing to do in the entire business. S&P is a very treacherous market. Day trading is the most difficult thing to do in town. Why would you want to do that? You want to start out with something that's going to give you success and give you confidence. But hey, people will do what they want to do. People will do what they're shown to do, what the TV tells them to do. So sometime, if you want, by the way, this presentation, I'm happy to provide it. I'll send it to Jeff, and you can get it from Jeff. Do you want to be responsible for that, or do you want them to send their email to me?
They can email me or you, whatever you prefer, Jake. I'm happy to give out my email address.
Okay, I'll send out the PowerPoint to you.
So
okay,
I'll drop my, it's jeffrey.gibby@metastock.com. I'll drop that in the chats.
Okay, good. So I'll be glad to send you the PowerPoint. So the bottom line is this. Oh, by the way, I wrote the five best-selling books on day trading from McGraw-Hill. Here they are. And here's something interesting, by the way. My last book on day trading was written about 10 years ago because I'm not a day trader anymore. It's much too difficult. I want to do stuff that's easy to do. The quality of time is the most important thing we have. So even though I wrote these five best-selling books from McGraw-Hill, the last one about 10 years ago, this one called The Ultimate Day Trader, I got a call from my literary agent a few weeks ago, and he said, "Hey, Jake, I've got a $5,000 check for you." I said, "Mike, $5,000 for me, I'll take it." I said, "Where did that come from?" He said, "It came from one of the publishing companies." I said, "For what?" He said, "For one of your day trading books." I said, "Well, that book's been out of print for 10 years now." He says, "Yeah, but they brought it back because so many people want it, because there's so many people coming into day trading. You're getting royalties again." Wonderful, fantastic deal. So what happened? During the pandemic, people stayed home. They got government stimulus checks. They had nothing better to do than trade and trade and trade. That's the good news. The bad news is most of them have lost their money because they don't have specific and clear strategies. So when you trade, and by the way, here's I get these really nice emails, sort of like this one. And this is really what it's all about for me, for people to say, you changed my life for the better. You showed me how to use this powerful software. You showed me what to do with it. You showed me how to make money with it. You showed me what I wanted to see all along, but haven't been able to learn because it's never been specific and clear. So what we do is this. If there's nothing else that Brian and I can teach you today, and I'm going to include Brian on this, I'm going to assume that he agrees with me. We use this model, or at least I do, called setup, trigger, and follow through. And if there's nothing else I can teach you today but this, if you can come away from today's presentation with this model and fit everything you're doing into this model, you will be very, very fortunate, and I will be very happy. So, setup. A setup is a pattern. There are literally thousands of patterns. Example, trend lines, head and shoulders, flags, pennants, key reversals, reversals, climax bottoms, climax tops, you name it, they're all setups. If you take most of these patterns and you put them on the computer and you ask the question, does this pattern have predictive ability? Does it predict anything? In 99% of the cases, you'll find out it predicts nothing. But if you take this pattern, which appears to be logical, it has what's called face validity, it should work, and you add to it a trigger. The trigger says, now, with this additional piece of information, I can go for it and have predictive validity. Example, we know that going back to 1900, all the way through 2021, we're talking 121 years, the pattern in stocks has been the price of the stock market Dow Jones early in January compared to October the 26th has been higher in early January over 83% of the time since the early 1900s, with variations in the theme during those dates. Now that to me is a powerful statistic. It couldn't happen by chance. Remember that since early 1900, we've had a number of world wars. We've had Desert Storm, we've had OPEC, we've had everything. We've had Republicans, we've had Democrats, we've had the Great Depression, we've had morons, we've had all kinds of stuff. And yet the pattern persists. But that pattern is not 100%. I need a trigger. I need something that says to me, the probability of this pattern reoccurring this year is very high because of this pattern, this trigger that I added to the equation and increased my probability of success significantly. But the third part of the equation is even more important, and that is follow through, consisting of three pieces of information. Number one, where is your pattern going to be wrong? In other words, your stop loss. Number two, where are you going to be right? What's your first target? Number three, how are you going to maximize that profit? And that is the key profit maximizing strategy. If you're the kind of trader who says, I just want to make $300 a day and go home, or like Donald Trump says, just find me 11,470 votes. You don't want to be that kind of a person. Because if you're happy taking $300 out of the market and going home, you're going to leave the big money on the table. It's all about the big move. And the big move happens after you reach your first profit target. So you need a setup, a trigger, and a follow through. All very important. And if you cannot, I respectfully submit to you, that if you cannot express what you're doing, your methodology, as a setup, trigger, and follow through, you are going to lose money, guaranteed. You'll keep on coming back to the market over and over and over again. You know, people say, in order to trade successfully, you need to have discipline. Well, sure you do. You need to have discipline. People say, Joe, you're never going to make any money if you don't have discipline. Go see a psychiatrist. Lay on the couch. Read Jake's first book, The Investor's Quotient, The Psychology of Trading. That'll help you get discipline. No. Where's discipline going to come from? Discipline is going to come from confidence. Confidence in what you're doing. Where's confidence going to come from? Confidence is going to come from results. So if you see something and you test it and it has a specific clarity to it, and you see it making money over and over and over again, you're going to have confidence. If you have confidence, you're going to have the discipline to do the trade. You do the trade. If you know how statistics work, you can be wrong 3 times in a row, but usually after that, if your strategy is good, you'll be right. You'll get confidence. Confidence will give you more discipline. You make the trades according to the rules. You have more discipline, you get more confidence, and it becomes a virtuous circle. So it's not about going to a shrink to find confidence. It's about finding a strategy that's going to give you confidence, and that's what this powerful software that you have does. That's what software is all about. That's what trading platforms are all about. They're not all about saying, I think I'll try this indicator today. Or you look at a chart and you say, I wonder what the stochastic looks like. Oh, the moving averages are bearish, but I'm bullish on the market. I'm going to look, oh, the stochastic is bullish. It agrees with me. Yes, I'll take the trade. That's not the way you trade. You trade with strategies that are clear and specific and can be expressed as algorithms. And if they can't be expressed as an algorithm, you have no use for them. It's that simple. So one of the things that I developed many years ago was called the moving average channel. And here it is programmed beautifully, displayed beautifully on MetaStock, showing the December corn, I believe. Is that December corn? No, it's the E-mini, the NASDAQ E-mini, or whatever it is. Doesn't matter what the market is. So the moving average channel indicator, very, very simple. And the indicator has a strategy with it. The indicator consists of a 10-period simple moving average of the high, an 8-period simple moving average of the low, and the price bars. And by the way, you'll notice I don't use candles, not because they're not pretty, but because they contain too much information. I'm a minimalist. I want the least amount of information I can have to make a decision, because I have found that, at least in my case, TMI, too much information, will cause me to make a mistake. So the rules are very simple. When I get 2 consecutive price bars below the lower part of the moving average channel, and then I get a trigger over here, I get follow through to the downside. Very, very simple. This one over here is what we're going to be talking about today. I'm going to let Brian take it over very soon, but I'm going to continue for just a couple of minutes. And by the way, Jeff, as Brian and I, the last speakers here today? Okay, well, I'm going to assume that we're the last speakers.
Did you have a question for me?
Yeah.
What is it? I'm sorry. I was getting distracted.
I'm sorry. Are Brian and I the last speakers?
Yes, that is correct.
We might run a couple of minutes overtime if that's okay with you.
I'm not going to kick you out.
Okay. That's what all the girls tell me. Okay, so we have 2 complete consecutive bars below the... I shouldn't have said that. I'll probably get in trouble. 2 complete bars below the bottom of the channel, and the trigger is right over here, and then we get the follow through. And there's specific rules for that, which are contained, and I believe there's a MetaStock plugin that has those rules as well. So that's the basic moving average channel. In and of itself, it's very effective. Now remember, I didn't say that all moving averages were bad. I simply said that moving average crossover systems of closing prices are not accurate. They will make money in the long run, but in the short run, they will kill you. So we don't use crossovers here. We're simply using moving average of the high and a moving average of the low. And this would be our setup, and this would be our trigger. In addition to that, there's some other features, and I've explained it more clearly over here on this slide over here, so it's very specific. But you can go through these charts and you can see something interesting, and this is another chart. You will notice this moving average channel, these 2 lines over here. Previous to a decline in the market, the channel width becomes very narrow. And previous to, or a leading indicator of a move up, the channel gets wide. Channel gets narrow, market goes down. And for many years, and I'd introduced this in the early 1970s, in the late 1970s, we noticed that this relationship, the narrowing of the channel and the width of the channel, were very good predictors of what the market would do, but we didn't have a good way to explain it in numbers. It was just a concept. And then, fortunately, I met Brian, who was able to take that concept and turn it into what we call expansion contraction. So the channel contracts and then it expands. And we found that this was a very good leading indicator of market activity and market direction. So, for example, looking at this chart, we have the moving average channel, which in and of itself is a very accurate indicator. 2 complete consecutive bars above the top of the channel, Williams above its moving average, like so, and you'll notice the trend just continues indefinitely, and here's the UST note. You will notice also that the bottom of the channel, or the 8-period simple moving average of the low, becomes support. And every time you come down into the channel or to the bottom of the channel, you have an opportunity to trade shorter term as a swing trade. So we were able to take that concept with Brian's incredible assistance and turn it into an indicator, which MetaStock has been able to put on their platform as well. And Brian and I have made this available to just about any platform that you want, because it's not about the indicator. We do want to give back, but it's what you do with the indicator that's important. So in this respect, the expansion contraction is just an indicator. You need to be able to take that indicator, which we will call a setup, and apply a trigger to it and follow through to it so that you have a complete trading package. So what I'm going to do now is I'm going to turn it over to Brian. I showed you a couple of charts. And as I said before, Brian is a fantastic coach, a great teacher, super individual, and he's got a beautiful speaking voice. So without further ado, I'm going to turn it over to Brian, and he's going to explain to you what these charts mean.
Thank you for that, Jake. On the expansion contraction indicators, you can see I have dubbed this as a zero lag dual perspective indicator, and it is based on Jake's moving average channel system. And as we get to the next slide.
Okay, hang in there. Here you go. I'm the slide boy today.
Yes, you are. So really, ideally, an indicator should accurately describe what's going on with price action right now, and the zero lag component of this indicator does take price action, multiple points of price from each bar, and compares it to the moving average channel values. So what we end up was price swinging up and beyond and expanding through the moving average channel, say in an uptrend, as we're showing here on this particular chart. The long-term shaded area in the background, Jake calls the cone and I call the cloud. It doesn't matter what you call it. It's just the long-term filter that gives us a perspective of how price is trading in relative position to the moving average channel. And it will contract in the strongest part of the moves up. And as we can see here, long-term, the cloud has stayed stable and shown bullish since mid-August of 2022. And continued to trade through the last few months on that. And so the longer term cloud coloring in the background is the trend component. Long-term expansion would be trend strong, and short-term expansion contractions measured by the lines, a second component. There's a red and a green line inside the cloud, and they're measuring the short-term swings above or below and up or down through the moving average channel. So we have a short-term perspective with the lines and a long-term trend perspective with the cone. So basically, since it's calculating on every bar, it's a zero lag dual perspective indicator.
Can I jump in for a second, Brian?
Please.
Okay, so there's different ways to use different tools. I like to use the expansion contraction when it changes from a red cone to a green cone, because it is very accurate in finding the start of a new trend. We're not going to try and pick the exact bottom or the exact top, but if you really think about it, the big money is made in the big move, no matter what time frame you're trading in. And if you had the discipline and you had the tool to be long this market from here, where the cone turned green, and stayed long throughout the move, trailing a stop, you don't really need too many moves like this in any given year or in any given time frame. Back to you, Brian.
Thanks for that, Jake. And I will at least go, the longest I've been in a trend on a weekly chart has been 18 months. So that can create some big moves taken on weekly charts. Being a little older also, I prefer to trade weekly charts and get in and stay in long-term trends on that. So again, the shorter the time frame, the shorter duration of the trade, but still work on short-term charts. I've actually have it trading on option charts, day trading charts, and even have some high frequency trading that's going on right now and still in the works on programming. But systems, if you want systems trading and how to develop them accurately, that's what Jake's done best. And I've just translated that in here into the coding that's taken a look at price changing through the moving average channel. And Jake's rules around the moving average channel also work really well with this as a system in itself.
And let me say one more thing, Brian, if I may. My rules are not subject to interpretation. So if you learn the rules, for me, the rules will be clear. There will never be a gray area. And if there is, we use the motto, if in doubt, stay out. But the bottom line of this whole thing is this. For me, and believe me, I've been around the block a few times. I've managed money. I've owned brokerage firms. I've been there. I've done it all. For me, as I said before, the bottom line is it either is or it isn't. It's a buy or it's a sell or it's a stay out, and it's not interpretive. So if people looking at my work can't reach the exact same conclusion about market direction, about buy or sell, about price, about target, then my work is no good, or they've got a learning disability, one or the other. Back to you, Brian. Sorry.
That's okay. Nope, and I'll mirror that. If you're not trading a system, as Jake says, with a setup trigger follow through, it's 100% rules based in advance, then the decision to get in or to get out or to gain or a loss is predetermined, which I really like. So this chart also is showing the short-term corrections in that same long-term trend in T-notes. So there were some periods where price dropped back through the moving average channel, of course, giving us set up with some of Jake's systems. And ideally, we want to know if price is making a correction, pulling back into the range, and then likely to continue, or is it pulling back in the range and likely to reverse? So short-term swings with the lines, long-term trends with the cones. And this is just an example of the long-term trend down in the NASDAQ E-mini here with the expanding cloud or cone. Okay, there. And if you wanted to go to the next chart, it's a second example of the short-term counter trend swings in the downtrend. Overall, the trend was down. There were periods where we were short-term bullish and again created some sell setups and Jake strategies to be bearish. And of course, we're looking for quantifying up or down, strong or weak for any systems type of trade as critical data.
Can I add something here, Brian?
Please.
Traders are under the wrong impression that the more they trade, the more involved they are with the market, the more money they're going to make. Think about this. It's one of those things in life that seems counterintuitive. As a trader, as a successful trader, you will spend more time doing nothing than doing something. I want you to think about that. You put on a trade, maybe over here, on the sell trigger over here, on the channel, on the sell trigger, on the expansion contraction, and you're going to sit. That's what you're going to do. You're going to trail stops. You're going to put in some orders to take profits. But if you're going to sit there and live and die with every tick, you are going to make a mistake. So believe me, in trading, if there's any one lesson I've learned in 52 years, it's the lesson that less is more. The more you trade, the less you'll make. The more you watch, the more you'll lose. It's not a question of how much you do. It's a question of when you do it and the quality of what you're doing. It's not a question of how many indicators are contained on a piece of trading software. It's a question of what you do with them and how you understand them. Realize the fact that the vast majority of indicators are based on price, and that's why they all look pretty much the same most of the time. It's a question of what you do with the indicator and what the indicator is intended to do. Example, stochastic. People say, oh, well, when the stochastic gets to be 85%, the market's going to top. Well, guess what? The exact opposite is true. Many times when the stochastic gets to 85% or 80%, and you have a specific pattern you're looking at, that will be the start of the biggest up move of the entire situation. So many times you want to buy markets that are quote unquote overbought and sell markets that are quote unquote oversold. But that's for another webinar. So Brian, you want me to go to the next chart?
Please. And I will add to that, right? I certainly don't take a trade unless I have either back tested and or forward traded, so I know the probabilities. So that would be from a database such as Jake's seasonal trading. We know the outcome before we take the trade. Or since I have 4 systems, 2 in retail currencies and 2 with stock options, long-term and short-term, that data in advance is known, so that we have a probability of reward before we take the trade, known from back testing and or forward traded ideally. So again, this, if you wanted to go to the next chart, this one is just basically saying what we're about to look at, where we're seeing the long-term long-term green lines rising. We're in the trend up with the cone increasing. And then I also drew the light green lines where the short-term expansion contraction was expanding. So when we're expanding up quickly, we will see that short-term or long-term, and those are identifying the strongest parts of a move up. In this case, on a daily chart, did last for several days and actually may go for a few weeks on duration.
And by the way, these are not some obscure markets. These are major markets. So we're not hunting and picking and trying to say, let's find one that works and show it to them. We don't do that. Brian, you want the next slide?
Please.
Here you go.
Okay, and then this is the same thing on the downside, right? We're seeing where we're in a longer term trend down by the cone being red, the long-term filter, trend filter, and then also the lighter red arrows are showing where the lines are expanding. So we have short-term expansion, long-term expansion, and we're in the strongest part of a move down when these situations are occurring, and there were 3 of them here, and they all lasted 3 to 5 days at a minimum, sometimes may go a few weeks on a daily.
And we don't pretend that this is the best strategy in the world. It's just something that works for us, that we think will work for other people as well. The most important thing to remember is this: we don't claim perfection. This is not perfect. It's going to lose money sometimes. But here's the thing. Most people who trade don't understand the nature of trading strategies. If you take a trading strategy and you program it and you look at the track record, here's what you're going to find. Most strategies, even the best ones in the world, will lose as much as 6 times in a row. The average trader is not prepared either emotionally, financially, or psychologically, which would be the same as emotionally, to lose 6 times in a row. After the second loss following a strategy, people are ready to give up on it. They're going to say, Jake's full of crap, his methods don't work. I've done this 2 times and it didn't work. So I say, do it a 3rd time. I did it 3 times, then it didn't work. Well, guess what? Even the best strategies will lose 6 times in a row. If you don't have enough money in your account to withstand that series of losses, that drawdown, trading is not for you. Therefore, I always tell people, before you begin trading a certain strategy, wait until it has lost money 3 times in a row, and then start trading it, because your probability is going to be much better. So Brian, are we done with this slide?
Yes.
Here's the next. Yep.
So again, right, I was just saying, if we're looking at confidence, which is a feeling, ideally, right, confidence does come, as Jake's mentioned before, from knowing the data from back testing and or forward traded results. Once you know the numbers, then I kind of joke about confidence. It's really not confident in your trading results. It's confidence in that the system will continue to repeat. So I did put on here the longer term trends with the quick notification on the left of the green rising arrow on the uptrend, continued with expansion contraction in the bottom left. that range did start to narrow, and then we switched to a downtrend. And as you can see, some of the times we're in a correction in the trend, and sometimes we're in the trend continuation. But as the characteristics of the cloud expand and contract, it gives us over 30 tradable characteristics that are built on the normal range, short-term and long-term price action.
And let me say this, you can use this in any time frame whatsoever, but don't make the mistake of thinking that the lower the time frame, the more money you're going to make. It's not about that, as I've said before, and I will say many times. I hope it's not redundant. In a little while, I'm going to show you this same strategy on a 15-minute chart, in case you're interested in that, but it will work in any time frame as long as you have the discipline to follow the rules. Brian, you want to work on this chart, or do you want me to change it?
One more chart, because the next one does, at least as a title slide here, if we're going through the 30 tradable characteristics, that's strong up, weak up, not trending, weak down trends, strong up, weak up, not trending swings, strong up and down. This also identifies either non-trending or consolidating patterns, and that's the next chart. When the range gets very narrow, we got both at the far right here, the non-trending pattern where the cloud and the lines get inside its normal range. That's with the gray horizontal lines, are using a mathematical calculation to determine what's normal over the long range. When we're in a situation where the cone is inside the lines, the smallest lines there, and the lines are inside there, we would be not trending and or consolidating, depending on whether the cloud was inside the range and or the lines were. But it gives us that not trending component, which is typically just in advance of a trend or a swing reversal. And on the far left, it describes the second characteristics when we do trade above the normal range with the cloud, where I've marked with the red and the green arrow to the left, a strong bull trend or a strong bear trend, or where the cloud or the cone expands beyond its normal range, which are the solid gray lines across there. So we've got strong up, weak up, not trending, weak down and strong down, long-term, short-term. Jake's divergence rules works great on the cone when we're making new lows and we're contracting, or making new highs and we're contracting. All of the setups that Jake's has with the trading rules work really well for this, because it was pretty much built on the expanding and contracting characteristics of the moving average channel.
And Brian and I have done a webinar on the expansion contraction. We'll give you the link to it in a little while, because we want to be specific. And as I've said before many times, and I will say again, if you can't put it in numbers, if you can't put it in rules, you're inviting yourself to lose money, because we're not psychic. We're not interpreting anything. We're not artists. We're traders. You're either going to be a trader or you're going to be an artist. And if you're not a trader, then, and if you are a trader, you need to have specific rules. It's that simple. Oh, now back to Jake. It's my turn. Great.
Thanks,
Brian,
Jake.
Thank you so much, Brian. Thank you so much. So let me show you guys something. People like to day trade. Here is a 15-minute chart of the E-mini S&P. The setup for this is the first 15 minutes. I take the high of the first 15 minutes. I take the low of the first 15 minutes, and those are my two specific buy or sell points. If I close above the high of the first 15 minutes, on any 15-minute bar thereafter, I get a buy trigger. I confirm that trigger with the cone. If the cone is green, it means to me the trend is up. I'm a buyer. My risk is closing below the low of the first 15 minutes. And then what happens? I have a target. My first target is 50% of this range. My second target is the full amount. And you can see what happened on this day. We continued. First, we went down a little bit. Discipline, discipline, discipline. Cone remains green. And by the end of the day, we have reached our profit target, which was right over here. We've doubled our profit target, and we're out at the end of the day. And I want to say to you this, If you're a day trader, you're a day trader. You are out at the end of the day. If you're not out at the end of the day, you're asking for big trouble. Let me show you another one. The cone, 15 minutes, first 15 minutes. But you'll notice, and this is the day session S&P, the market opened $2,500 lower than where it closed the day before. I have a rule. The rule is if it's $2,000 or more, I'm not taking this trade because the downside potential is limited. So on this day, no trade for me. And again, it's a rule that I don't break. And here's another one. First 15 minutes right over here. We closed above the high of the first 15 minutes, but look what happened. The cone was red. The cone did not confirm the uptrend, so no trade was taken. Very simple, fact-backed, rules-based. Here's another one. First 15 minutes. We close above the high of the first 15 minutes, right over here. It's confirmed by the cone being green. You can't see it really well over here, but the bar gets colored green and says it's okay to take this trade. And guess what? Our profit target was first half of 687 and then all of 687. And not only did we reach our first two profit targets, but we exceeded that profit target. And by the way, another rule, we have a profit target on every trade. Every time we hit our first profit target, we eliminate part of our position and we place a stop at break even so that we have no significant risk thereafter. We're trading to get out of what I call the danger zone. So there's a whole bunch of these over here and some more charts like so. So let's take a look at this one. Here's the E-mini S&P. Again, a sell right over here on the channel, a sell on the cone, and it continues pretty consistent with one exception right over here. A little bit of whipsaw, but otherwise you got the big move. As I've said before, and I will say again until my dying day, it's all about the big move. Look in the mirror and ask yourself the question, are you getting the big moves? What is a big move? If you take your average profitable trade, maybe your average profitable trade is $500. Multiply that by 10. If you didn't get any $5,000 moves, there's a problem. And if you don't have a problem now, you will have a problem because you're going to need those big moves to balance off many of the small moves that are going to be losing trades. Here's another one. It's the chart of the US dollar index shown earlier by the previous speaker. And again, notice the channel right over here. The channel holds very firm. Every move to the bottom of the channel, the 8-period moving average of the low gives an opportunity to buy. And the cone starts bullish here and stays bullish all the way through the move. And again, you've got to have the patience to sit and wait and give the market an opportunity to do what it's supposed to do. You can't live and die with every tick. And here's another one, the natural gas, which turned bearish right over here and has brought in a huge, gigantic move to the downside. And previous to that, a big move to the upside. And yes, there will be little things like this that lose you money. We don't claim to be perfect, but that's what really differentiates the winners from the losers in this game. The ability to take your losses, to have the money in your account that will allow you to take those losses and have the discipline to sit and take the next trade. So here's another one. This is coffee, a huge collapse in coffee futures in the last few months, turning negative right over here. And these little bars mean that this was not the lead contract at the time. So this is the daily chart. There's another one. In stocks, here's Boeing. As you can see, Boeing had caught the big move down right over here, and it's catching the big move up. Again, finding support at the bottom of the channel. And here is I think this is AMD. A huge bear market in AMD. And I want you to appreciate the fact that this daily chart, you're not back and forth and back and forth and back and forth. If you want to use the channel as a place to go short at resistance, you can certainly do that and say, wow, you got a small move, you made a nice profit. The bottom line is this is where the real money is made, and that's what differentiates the winners from the losers in this game. So we've got a few more charts like so and like that. And if you're interested in finding out more about us, if you're interested in the webinar that Brian and I did, click on the link to the Expansion Contraction website. You can reach Brian at this address. You can reach me at this address. Brian, any parting comments?
Thanks for that, Jake. Yeah, just for those that may have alternative chart platforms, Expansion Contraction, originally coded in Trade Navigator, has been programmed in Thinkorswim for TD Ameritrade, for TradeStation, for the Wealth 365 charts, for TradingView, and also for MetaTrader 5 on that for some of those. And I will be working on increasing that. Oh, even NinjaTrader too. I think I missed that one. So it's available for multiple chart services. Should you be using any alternatives, as I always have backups just in case of failure. So thanks, Jake.
Thank you, Brian, so much. But remember, ladies and gentlemen, it's not about the indicator. It's about how you use it and what you do with it. So even though this looks great on the screen and it's a wow and it's pretty and all the rest of that stuff, it's what you're going to do with it, and consider it to be a setup and a trigger, but it's the follow through that's super, super important. So Jeff, I'm glad to take questions if there are any.
We have a couple good questions, actually. Not a lot of questions, but some really good ones that I'm interested to know the answer to.
I like it.
Amit wanted to know, what are the 3 questions you asked to figure out if a person can be successful trading?
Now, question number 1 is, what is your greatest quality as a trader? In other words, what do you do well? So I ask them that question and see what they say. And then I ask them, what do you do poorly? What do you think you've been doing that has caused you to lose money? And number 3, do you want to trade short-term, day trade, or intermediate term? And based on those answers, I can make a decision as to whether they're going to be successful or not. So for example, if I say, what's your worst quality as a trader? And they say, well, my worst quality is I get in too soon and I get out too late. So right away, I know there's a big problem and their probability of success is going to be very poor. Or I say, what do you do well? They say, I really do well at day trading, and I have a rule: when I make $500, I'm done for the day. I say, well, wait a minute. Does that make any sense? You don't want to make just $500. You want to make as much as you possibly can. So if you're limiting your profits, what you should be doing is limiting your losses. So that's just a quick example. Next question.
Yeah, absolutely. Second question is also from Amit. So yeah, he had a couple of really good questions. In your opinion, Jake, what is the minimum amount of money you need in your trading account?
For stocks or futures?
He didn't specify, but I'm going to answer for him. Stocks.
I would say that if you're going to trade and give yourself a good opportunity to be successful, absolute rock bottom minimum $10,000. Minimum. Preferably $25,000. And don't plan to trade short term or day trade. Plan to trade intermediate term, or at least be in trades for 15 to 20 days, and use a strategy that's very effective and accurate, like seasonal trades. That's what I would recommend.
Now I have to answer it in futures. Yeah, you know I was coming. What if it's futures? How is the minimum different in that case?
I would say the minimum should be the same. And especially if you want to trade more than a few markets, but it would be at least $25,000. And do be prepared to lose most of that money. And let me say one more thing. A great trader once told me, in order to make money trading, you have to not care. As soon as you start caring, you have a problem. So whatever the amount of money is, if you can say, I don't care about this money, and really mean it, don't even think about trading.
I think that's always a good advice. Let's see. That's all. We did have Amit also said he was born in the summer of '67.
Oh.
And I was like, May of '74 for me. Caron said, I love you, Dr. Jake. And to which I responded, I love Jake, of course. And then that's about it. I think that catches you up to. I did tell everybody the moving averages and the Williams settings that you're using as well, and where they can pick up that indicator for MetaStock as well. So,
if you guys would like to learn about the webinar that Brian and I did, it's at the website over here, expansioncontraction.com. We are very dedicated to what we do. We're real traders. We do what we say we do. I teach what I trade, and I trade what I teach. And Brian, thank you so much for coming into my life. You've been a great asset to me and a very, very, very good helper.
Thank you for that, JK. I do have one comment, though, to answer the question about what would you ask somebody to see if they could be successful.
Okay.
Yeah.
And to that, I add, are you willing to do whatever it takes to make your system work?
Yeah, good advice. Good question.
All right, Deanna says, thank you, Jake and Brian. Great webinar. I want to say both of you, thanks for coming in, finishing up the day for us strong. That was a really good session. Brian, since I got you on the line, thank you for all the help in creating the expansion contraction for MetaStock. I know I had some questions that felt like probably they weren't from a programmer because they were from me, but I do appreciate all the work you did in terms of helping me get it up and running. Jake, thank you. Brian, thank you.
Thank you so much, Jeff, and I hope your family is doing well. Hope to see you again very soon. Thank you again, Brian, and everyone. Thanks for attending.
All right, thank you. Okay, let's go ahead and wrap up a little bit here. I do actually want to talk a little bit about, we'll go ahead and do this, and make me the presenter. I'm going to show my screen, and let me go ahead and do this. Oh, in addition to the expansion contraction indicator that you can grab for free, we actually did spend quite a bit of time. Wow, I'm getting that same thing where I get my face really big instead of the presentation that Oscar had. But we did actually put together some of his setup and timing trigger systems, and they're available for MetaStock at a very good price. So with this particular package, the setup and timing triggers 2.0, you get 33 commitment of trader systems and 6 technical systems. And as part of that, the technical systems, you're going to get an open range breakout. You're going to get a 5-bar moving average channel pattern, the moving average channel with the advanced declines, momentum moving average, power momentum, and stochastic pop. So this is a collection of systems that we developed with Jake from the work that he did. And the thing I like about them is they all incorporate setup, trigger, and follow through. So they're all very straightforward. You get a setup. After you get a setup, you get a trigger. And if that trigger, you have a follow through. And they really, really incorporate well into MetaStock. So here's the technical systems that are included. You get them listed here on the screen for you. This add-on's a one-time cost. It's normally $499. We're going to reduce that to a conference price of $399. If you need a free access to MetaStock, if you need a free trial to MetaStock, we'll include that. It's going to include a comprehensive user's manual and a 30-day money-back guarantee. So you can actually get that if you go to metastock.com/conf promo. You can sign up for that. You can also give us a call at 800-882-3040. And you can sign up for it there. Don't forget, you can also do the extended trial of MetaStock. I'll talk about that in a second. I want to do, actually, Kelly, before we close up today, I promised I would not give up another opportunity to give away a prize. So are you ready?
Let's go.
Okay.
Let's give away something.
Let's decide on a prize real quick. Oh, here, I need to, I'm not prepared. This will be a good one to do. We're going to give a 1-month subscription to Oscar Carboni's Omni Trade recommendations.
Oh, awesome.
Yeah, so it's normally $200 per month. We're going to give away 1 month of it. It gives you access to live access to his message boards, access to Oscar via his chat room, current access to his Omni, and live updates via SMS and text and email. So that normally is $199, and it's on livewithoscar.com. If you remember Oscar, you just talked. right before Jake. So, and he did a great job. People really like Oscar. Kelly, let's get prepared to update and find a thing. Actually, let me do, let's cancel. Okay, I need a number. That can be anywhere between 9,001 and 9,418.
Let's go big this time. 9087. 9087.
Okay, Larry Cochran. Oh, Larry C. So Larry,
oops,
you're going to win. We'll reach out to you in terms of kind of getting that prize. And let me just make a note of that. So I had to come and look for it in the video. Thank you very much for your help, Kelly.
Of course.
All right. We do have a question in terms of Ed Downs. What time is Ed Downs tomorrow? So if you are interested, like if you want to go see the schedule, you can go to metastock.com/traders-conference. To answer your question very specifically, I'm not sure Ed is on this calendar. Oh, he is. 4 p.m. Eastern time is what time he is tomorrow. But if you want to see the schedule, we've got another great lineup tomorrow. Actually, I should probably let's bring this over here and we'll kind of go through what we're going to do today. Now, if you're watching us on YouTube, I would recommend that you become a member of our prize list so that you can be eligible to win all these fabulous prizes. To do that, just go to metastock.com/traders-conference. Kelly's going to put that link in here. Tomorrow we have John Osborne, Wendy Kirkland. Oh, she does great. Rick Sadler is going to talk. Alexander Cole and Tyler Wood are going to talk about go, no go. Jerry Allison is going to be talking about traders' tax status versus investor and what it means to you. Todd Horwitz is going to talk about his portfolio, futures portfolio management. Ed Downs is going to do chart pattern engine tomorrow. And Peter Dalal, Silas Peters. Great lineup tomorrow. Again, if you're watching on YouTube, go to metastock.com/traders-conference and fill out the registration form so that you can get access to the prizes. So there you go. Amit says, in 2000, I attended a MetaStock presentation in Toronto. I think I was there, presented by what at the time was what I thought was an older gentleman. He probably was in his 50s. I don't know who that would have been. I mean, do you think it was Alan? Maybe. Sterling says, thank you all for your time and of course the knowledge you shared with us. Sterling, thanks for coming. I do want to say thank you. Actually, let's wrap up first. Let me go ahead and kind of get rid of this. Thank you, CMT, for supporting today's event. We appreciate that. That's great. Thank you, Stocks and Commodities Magazine, for supporting today's event. All of the add-ons that we talked about today are on discounts. You can get all of those at metastock.com/conf promo. If you just want to find out why MetaStock has been rated #1 in this price category for 29 years in a row, we're offering an extended trial where you buy a month and get the second and third month for free. That cost is as low as $23 a month to try the software that's we've been showing all day. So again, helps you scan markets. I love scanning markets, test trading ideas. You've got the forecaster in there. There's a reason it's been rated so highly for so long, and it's going to give you all those real-time alerts, commentary, signals. $69 a month here in the US, $23 a month with that extended trial. Metastock.com/conf promo, metastock.com/sales chat, or at 800-882-3040. We have a question coming in here. I missed a session. I want to go watch it. One of the things that actually, Kelly's already answered it. We offer the recordings for free. So go to the YouTube link that Kelly put in there, and you can just watch the whole session. Enjoy. Grab some popcorn. The name was Alan McNichol. So I think that's going to do it a bit for us. I want to say thank you to all of the great speakers that are speaking all week long. Thank you for all of you for coming today. I hope you enjoyed it. Hope you learned something. Hope we see you tomorrow. Make sure you go vote early, or if you have to vote late, take your phone and you can watch it while you're in line. So we'll see you though tomorrow. We have another great lineup, and we will see you in the morning. Thanks for coming, everybody.
Hi, Kelly Clement here from MetaStock. I hope you enjoyed today's video, and I hope you found it instructive and informative. If you did, what I'd like to invite you to do is go ahead and like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. So go ahead and like and subscribe, and keep on watching.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you.